Sí. Excelencia, Mr. Carlos Cuerpo, Minister of Economy, Trade and Business of Spain, distinguished country delegates, representatives of MDBs, partners from civil society, the private sector, and credit rating agencies, dear co-organizers, welcome to the Roundtable on Debt Pause Clauses. My name is Yara Saab, and I'm a program director within the Climate Emergency Collaboration Group. It's a donor collaborative bringing together the major philanthropies committed to the climate and development agenda. We're honored to be partnering with the government of Spain, the Children's Investment Hub Foundation, the Sustainable Sovereign Debt Hub, in the support of this important and timely event. My role today will be to facilitate our event and make sure our program runs smoothly. The push made today on the debt and broader financial architecture reform agenda is in large part thanks to Global South leadership in multilateral fora, and the call from affected countries through the credible voices such as the Bridgetown Initiative, the Climate Vulnerable Forum, the African Union, and others to make the case for innovative solutions on debt. While progress is notable, we must recognize that it has so far been incremental and has yet to deliver the systemic transformational solutions we need to confront today's polycrises. This is why genuine partnership with developed countries in making concrete progress with tangible results to prove debt relief for countries is key. It is no coincidence that we're meeting in Madrid today. We are here because of Spain's leadership on the reform agenda, and in particular, the personal commitment of Mr. Cuerpo to advancing concrete solutions on sovereign debt. Spain has shown that developed countries can play a constructive and catalytic role in building a fairer and more resilient financial architecture, and today's event is a testament to that. With today's meeting, we aim to hone in on one of those concrete solutions, to build a shared understanding around debt pause clauses, to promote their uptake and implementation across all creditor classes, and to mobilize global support for their adoption. This event, as you know, is being held against the backdrop of the fourth Financing for Development conference to be held at the end of the month in Seville. The last stretch of negotiations in New York on the final outcome document are currently underway in a complex environment. I think I can safely say that many of us are looking to Seville for a robust outcome with clear, tangible, and ambitious progress on the debt pillar, as well as on new alliances and coalitions of the willing of first movers as part of the Seville platform of action to demonstrate not just political commitment, but concrete policies and actions that send the right signals to all stakeholders. Excellency, you've seen since Spain's offer to host FFD4 the high expectations placed on the country as a trusted broker and a champion for the development agenda at the global level. In this sense, we really wish to thank you for your leadership and commitment and for your support of this event on the path to Seville. I would also like to warmly thank Marta Mulas, Senior Advisor at the Ministry, and her team for this great partnership and to recognize their support for this agenda. Before we kick off, it is my pleasure to introduce Mr. León de la Torre, Director General of Casa de América, a key institution that is associated with Spain's Ministry of Foreign Affairs, and who are hosting us today in this beautiful building. Mr. de la Torre, who has over 30 years of experience within the Ministry of Foreign Affairs, has served in different capitals in Latin America, Africa, and Asia. And I guess, to my understanding, is also a novelist, will kick us off this morning. Following his intervention, we will have the pleasure of hearing from Minister Carlos Cuerpo. Mr. de la Torre, over to you.
Good morning, dear Minister, authorities, colleagues. It's a pleasure to welcome you to Casa de América, the public diplomacy institution created 35 years ago to promote and reinvigorate our ties with the Americas in all areas, political, economic, cultural, you name it. Now, on the road to the 30th Ibero-American Summit in Madrid in late 2026, events such as this one we're hosting today make very much sense. Today's event, Road to Seville, Roundtable on CRDCs and Beyond, introducing debt pause clauses across borrowers' capital stack, is organized, as it has already been said, in collaboration with the Ministry of Economy, Trade and Enterprise of Spain, the Climate Emergency Collaboration Group, the Children's Investment Fund Foundation, and the Sustainable Sovereign Debt Hub. We bring together experts, government representatives, bilateral and private creditors, multilateral development banks, civil society representatives, and various key actors and stakeholders in sovereign debt management. The aim is to strengthen international dialogue and promote the inclusion of climate-resilient debt clauses and other debt pause clauses in the financial contracts of borrowing countries. The analyses and contributions from this gathering will, as it has already been said, will directly feed into the discussions of the 4th International Conference on Financing for the Development in a few weeks in Seville. And in the context of growing vulnerability to climate and external crisis, especially as the world order we know is vanishing or seems to be vanishing very quickly, these tools represent a crucial solution to provide countries with the financial breathing space they need. The current weak economic situation in Latin America, for example, urges us to move towards more resilient and sustainable financial mechanisms. It's essential to offer solutions that enable countries to mitigate the effects of such disruptions and ensure long-term economic growth. Spain, in collaboration with the European Union and multilateral organizations, has promoted initiatives aimed at strengthening the financial security of countries most affected by these crises. For this reason, debt pause clauses represent one of the most promising tools to achieve these objectives, allowing countries to redirect the resources in critical moments without compromising their fiscal stability. Minister, it's a pleasure to have you here again. I hope you will have meaningful discussions, and welcome to Casa de América.
Thank you, Leon. Distinguished colleagues, ladies and gentlemen, it's a pleasure being here today. Monday morning is the best moment of the week, so I'm glad to be here. Let me take first a moment to thank Casa de América, of course, for hosting us, and the co-organizers, as you can see in the slides, Climate Emergency Collaboration Group, the Children's Investment Fund Foundation, and also the Sustainable Sovereign Debt Hub. It's a pleasure, as I said, to open this roundtable on debt pause clauses, which we know have a lot of potential to help countries to free up fiscal space when needed, particularly to face critical situations. I hope discussions today will prove fruitful and contribute to the debate ahead of the 4th International Conference on Financing for Development in Seville just a few weeks from now, but which is starting already this month with these previous events. But let me begin by taking a step back and trying to look at where we are and what's actually needed going forward, and also what's at stake. Our journey to ramp up financing for development, as you all know, began a long time ago. Previous conferences held in Monterrey in 2002, in Doha in 2008, and of course in Addis Ababa in 2015, where the commitment with the 2030 agenda was actually institutionalized. However, despite the original ambition, progress towards the achievement of the SDGs, the Sustainable Development Goals, actually falls short of what was envisaged originally. Only 17% of the SDGs are on track. More than 1/3 are actually stagnating or regressing, including goals on poverty, inequality, and climate action. $29 trillion in sovereign debt burdens developing nations. 48 countries, which are home to 3.3 billion people, already spend more on interest than on education or health. And these are not just numbers. These are schools that are not being built. These are vaccines that are not being delivered. And these are opportunities to build a better world that are actually slipping away. Additionally, it is clear for all of us that the world has essentially changed since 2015, since the Addis conference. We continue to increasingly experience the adverse effects of climate change. We have faced since then a pandemic, an escalation in armed conflict, a cost of living crisis driven by the increase in food and energy prices, and also a resurgence of protectionism, of fragmentation in the world trade. And this actually also seems to be calling into question the benefits of free trade. Additionally, the very core of the multilateral action is being challenged, and our international institutions are feeling the strain. Today, even more than 10 years ago, a revolution in the financing for development is needed. Our international financial architecture must adapt or risk falling short of this moment. And for this purpose, Seville comes actually at the right time and provides an unparalleled opportunity to change this trend, to turn the narrative into action, and contribute to a renewed global financial framework that actually delivers. Spain is additionally a staunch supporter of multilateralism. We are honored to be hosting the conference, and we're also striving to make a difference of it. Specifically, we want to make sure that we deliver, as was mentioned already, concrete initiatives that are capable of making tangible, lasting progress on priority areas. To do so, the upcoming conference introduces a novelty compared to previous ones, what we call the Seville Platform for Action, or if you want an easy acronym to remember, Seville SPA. Our SPA will provide a framework for financing for development initiatives to be put forward, publicized, and also monitored over time. The main idea is to allow like-minded nations and organizations and actors, stakeholders all together, to work on specific measures as coalitions of the willings, making progress around common goals where we are struggling today to achieve broader consensus. Within this platform, Spain is already signaling 2 concrete initiatives that confirm our commitment to addressing debt and liquidity pressures. First, what we have named the Debt Swap Hub, which in collaboration with the World Bank, aims to bring together experience, technical expertise, and best practices to scale up and also improve the design and implementation of debt for development swaps. On this, Spain has extensive experience in bilateral debt swaps with more than 1.6 billion euros in conversion programs with 28 countries so far, and we believe there is a lot of potential in these swaps, not only to ease debt burdens, but also primarily to help vulnerable countries in towards more sustainable development. The second deliverable is what we call the Debt Pause Close Alliance. These are not easy names, I have to concur. But it's actually one of the flagships priorities for Sevilla and is the focus of today's event as well. We can take pride in the ground that we've covered so far in this area. In 2024, Spain approved a new policy by which all new sovereign loans and restructurings for low and lower middle income countries include debt pause triggers. And these triggers cover natural disasters, health emergencies, and as a novelty also, food crisis. Last month, we signed our first loan with these debt pause clauses with Rwanda, paving the way for a wider adoption, hopefully. In just 2 years, we have traveled from concept papers to live action and live transactions, a remarkable distance. Yet, we are still striving for mass adoption, which is where the real impact can be attained. And here is where we want to focus our efforts and where we want also to count on your support. In a context where many countries are facing the so-called silent debt crisis, scaling up debt pause clauses by both public and private creditors is crucial. What is our ambition on this front? To call on as many actors as possible, to commit to incorporating these clauses into their loan agreements and work together in a second step in the standardization of these clauses to facilitate their adoption by both debtors but also creditors. Transformational impact will come only when these pause clauses actually move from rarity to routine, and they're embedded in an automatic way in every new loan, bond, or restructuring that finances development. The incentive is mutual on this front. For sovereign borrowers, a pause clause secures classrooms, clinics, and clean water precisely when budgets actually become tighter. For lenders, it preserves long-term value by steering nations away from the cliff edge of default. Financing or financial resilience is a public good that delivers also private returns. The task ahead is challenging, and we count on your help to lay the foundations for these clauses to be widely and systematically adopted. Only by building a shared understanding, trust, but also technical coherence can we ensure that the debt pause clauses become an integral feature of all instruments that support sustainable growth. We have a lot of work to do between now and July. We'll be launching this alliance, the Debt Pause Clause Alliance, under the Seville Platform for Action, together with key international partners, many of whom are actually participating in today's event. The alliance will act as a coalition of the willing, first movers, I like that way to put it as well, and call on others through a political declaration, inviting creditors and debtors, both public and private, to commit to incorporate these clauses, these debt pause clauses, into future loan agreements. It will work to broaden eligible beneficiaries and expand the triggers beyond climate events to strengthen this collective resilience. Spain will call on fellow governments, multilateral banks, but also private investors to join the alliance. The broader the participation, the stronger the shared safety net, and also the greater the stability and growth that we can unlock for vulnerable countries. And let me just wrap up with 2 final messages. The first one is a word of appreciation for your work, all of you today here, for contributing and enriching this debate further. We need to have a strong technical background to be able to actually lift this to the political level as well. And this event is not only a reflection of our shared commitment, but also a demonstration of the importance of working together with a shared purpose. And my second message is actually very easy, is that you will allow me to actually ask you, if I may, to be brave, but also to be bold in what's to come. We cannot afford to miss the opportunity that Seville offers to build consensus, to push ahead with innovative approaches, and to make real progress towards the SDGs. We count on your insights, on your support, and on your drive to make Seville a success for the benefit of all. Thank you very much.
Thank you, Yara. Can everyone hear? Yes. Well, it's my absolute pleasure to start today's meetings with this first session on the structure and experience to date in official bilateral loans, the experience gained by countries that have started to offer these mechanisms to their sovereign borrowing counterparties in their official bilateral loans. So first on my left is Alberto Sabido, Deputy Director General for External Debt Management and International Financing, here from the Ministry of Economy, Trade and Business of Spain. Next we have Elliot Grogan, Deputy Head of the International Debt Division and from the Paris Club Secretariat Unit from Paris in France. Next, we have Christopher Bergens, Councillor from the Embassy of Canada here in Spain. So this is your home territory. Welcome. And last but not least, Rue Ferguson from His Majesty's Treasury in the United Kingdom, who is also the representative of the UK at the Paris Club. So I hope in this panel to give you a sense of the journey that the countries they represent have travelled in adopting climate resilient debt clauses, or actually in the official bilateral lending space, we can refer to them as debt pause clauses. So starting with you, Alberto, and maybe you can take it in the order that you're sitting. Can you describe Spain's path and each of your individual countries' path to introducing CRDCs and the reasons behind offering them, and how do they fit in your lending objectives into emerging markets, and how do you view any costs associated with their take-up from your country's perspective?
Thank you, Deborah. And it's a pleasure for me to be here today. It's an honor to share this table with these distinguished colleagues. As part of the organizing team, I think it's very encouraging to see how all together we're building momentum around CRDCs. So we are very happy to see that this event is a success. First, before answering your question, I think it's fair to say that UK and Canada were the pioneers of CRDCs, giants in many ways. So it was on the shoulders of these giants that a group of countries committed in June 2023 to analyze the possibilities to include debt pause clauses or CRDCs in our bilateral lending. So after that, we began a process of benchmarking, exchanging information with UK, with France, with other colleagues, in order now to see how we want to fit the CRDCs in our legal system and operational system. So we began a process explaining to our ministry what we were aiming to do, what were our intentions, and shortly after that, we had to go to our internal ministerial committees. We have two funds that are applying the debt post clauses. We have one fund that is devoted to internationalization. This is the FIEM. And we have another fund that is applying also the clauses. That is our FONPRODE. This is our cooperation fund. So what we had to do is to seek approval for these committees. And once we had the approval of these committees, we went to the Council of Ministers. And as the minister was saying before, in April 2024, the Council of Ministers authorized the inclusion of debt post clauses in our system. Regarding how the clauses fit into our priorities, I think the design of these clauses are very much aligned with our geographic and sectorial priorities. Regarding our geographical priorities, Africa and Latin America are key priorities areas. And within these areas, there are a group of countries that have a lot of pocket poverty. So what we do is to include not just low-income countries, but also lower middle-income countries in order to have the possibility to include these key areas that are in our geographical priorities. And regarding sectorial priorities, for us, I think we will develop this later on. Food security is a priority for Spain. I think it was in 2021 when we worked with the IMF in order to create the food shock window. So for us, the food security is at the very heart of our priorities. And I think your last question was regarding costs. It's true that the inclusion of this kind of clauses may have a short-term cash flow risk when they are activated, but I think that the funds that I was referring to before, they have a solid treasury, and we have also legal capabilities to increase credit if we need it in order to cover potential shortcuts. So as we see, CRDCs have more benefits than cost, so we very much ask many countries to introduce them. So I think I'll stop here.
Thank you. Elliot.
Thanks very much, and I mean, thank you also. Just to echo Deborah, for Spain for hosting today. It's wonderful. It's wonderful to be here. So, in terms of the French Treasury, so the French Treasury offers CRDCs in our concessional government-to-government loans from the French Treasury to borrowing countries for concessional loans. I was just briefly going to talk about maybe the three policy aspects that sort of made us comfortable to roll out these clauses in our lending facilities. So, I mean, the first is the French Development Ministry, the French Development Agency has a long history of providing counter-cyclical loans in instances when there's an exogenous shock to a country. The agency has historically provided loans into that country, recognizing the need to provide new financing in times of stress. So that sort of already built a bit of a bedrock from which we could work on as a sort of base understanding. I mean, secondly, I think the Paris Club in 2015 we had a restructuring agreement with Grenada, and that for the first time included what is essentially an early prototype for a CRDC that I'm sure Sebastian you'll talk about later today. And again, I think that was a good example and clause of getting comfortable with the concept of what a sort of potential exogenous shock that might hit a country where you've already got a loan, in this case a restructured loan, and where in the future you might want to recognize that actually both for the long-term debt servicing capacity of the country and also making good on your own credit that you're owed, that a short-term suspension of debt service payment is essentially in the interest of all. And so that, again, was an important policy milestone in 2015 that continued to get us comfortable with the concept of how these CRDCs might work. And then finally, I think also to echo the points made earlier, the work of the UK under its G7 presidency and the private sector working group, again, was very influential in our thinking and in defining very clearly potential clauses, how they might work, working through the potential implications of CRDCs, which meant that by the end of 2022, France was able to integrate CRDCs specifically in for climate, for exogenous climate shocks in our lending, and we were really pleased to be able to join the call for action in 2023 at the Paris summit. And so maybe just to come back to sort of what the policy objective is, I think we're hugely supportive and recognise that ultimately these are clauses that can be a win-win, or essentially are a win-win. They're helpful to the creditors because by suspending debt service over a short kind of predefined contractual period, you recognise that actually that's in your interest because otherwise you might not get paid and you might end up in a borrower country who might be going through solvency concerns, and it's in the interest of the debtor country. I'll stop there.
Christopher, so I remember working with officials from Canada and the IMF and ICMA on the early hurricane clauses that ICMA published, and Canada was very much the sponsor of those efforts. So what are your thoughts on the journey travelled?
Absolutely, and thank you very much, Deborah, and thank you to Spain and to the organizers of this event. Canada has indeed just in recent years collaborated even more closely with Spain on financing for development. Our previous Prime Minister and President Sanchez, particularly coming out of COVID, were very active in taking leadership in that area. I should say that I'm not an expert in this space, and I'm surrounded by experts, so that makes me feel a little humble. And what's ironic is that my new Prime Minister is, and I'm sure would be delighted to be here and talk at length about the fine detail, having been a governor of the Bank of England and Bank of Canada, and of course very active in climate finance. But maybe what I can do is just take a step back for a moment. As a mid-career diplomat, I like to still think of myself as mid-career. I started in the 90s, which was really the heyday of multilateralism. Canada played a key role in responsibility to protect the Landmines Treaty, the International Criminal Court. And it's very interesting to see, fast forwarding 20 years, and Minister Cuerpo made a lot of comments about the challenges to multilateralism today that I don't need to go over. But to see what, an example of a successful multilateral initiative in the last few years looks like, and I think this really is one. And it gives us a flavor, I think, of what multilateralism, successful, practical multilateralism will look like going forward. And in terms of the life cycle of this particular initiative, again, it's been on the books for a long time. Minister Cuerpo mentioned 2008. It really started to kind of gain traction at the G7 summit in 2018 that Canada hosted under the first Trump administration, where there were clear commitments to starting to work on some of these areas. Here we are about to host for the second time under a second Trump administration, the G7 summit. I wish I could tell you exactly what is being worked on in this area, but as a new government, we're working very quickly, and there are a lot of emergencies underway. But over that 7-year cycle, it's thanks to the working groups that have been established, to Deborah's work, to the the efforts to standardize some of the term sheets, to publicize across a whole panoply of stakeholders the value of this, and across organizations. So Canada has worked very closely with the IDB on this, and I know there are IDB representatives here. But there's also, been work at the G20 and elsewhere. And of course, we're very happy to announce in 2022 that this was now going to be our default mode for all our sovereign debt loans. And in 2023, we began to issue our first loans. And we've done four of them so far with Guyana, South Africa, Moldova, and Ecuador. And I think Ecuador is here today on the list, so I hope that they'll have some practical points to make. And I think the main message is that it's gone surprisingly smoothly. It's been very welcomed on all sides. And of course, we haven't had any triggers yet, but we'll see how that goes. And we're talking now about $500 million in sovereign debt loans. So that's a spit in the 29 trillion that was mentioned earlier. But we're starting to get there, and working with CARICOM has been very critical. Of course, it helps that Canada shares a lot of World Bank space with the CARICOM countries, but that's been really key. And just in terms of a couple last points, even though it's gone very smoothly, I think we think capacity building is an important other area, including potentially through technical loans and other areas. And in addition to spreading the message and continuing to collaborate across the spectrum of stakeholders, some of that capacity building will be important. I think I'll stop there for now.
Thank you very much. Ru, can I ask you to give the UK perspective?
Yes, of course. And we just want to echo the thanks to the Government of Spain, Deborah for moderating, and the other sort of co-sponsors, the Sustainable Sovereign Debt Hub and the Children's Investment Fund Foundation. So before discussing how we came to offer CRDCs, I think it might be useful to take like a brief step back and understand, again, building on...
I just did that.
a step back and a step back. And talk about the chronology of some of this as well. So I sort of noticed in one of the opening statements, the UK and Canada got some of the credit for, I believe, Spain standing on the shoulders of giants. And I think what we would say is that we were also standing on the shoulders of giants, both building on the ideas of Barbados and Grenada in particular, who kind of initially innovated these ideas, and we played our part in the puzzle as well. And so how we got to that point was in 2021, when the UK was holding our G7 presidency. And so we asked ourselves, given we had these initial scope of ideas, how could we increase the coverage and increase the implementation of CRDCs? And so in 2022, we announced that we'd be the sort of first on our ECA, UKEP would be the first to introduce CRDCs into its direct lending for low-income countries and small island developing nations to help with sort of their debts and climate sustainability as well, and providing liquidity at the time when there was these exogenous or external shocks. And we didn't just limit that to climate, we also expanded it to pandemics, given that was a major concern at the time and also ongoing. And I think what was also important is we not only introduced this for new lending, but we said we would cover the costs of legal support for countries who wanted to include CRDCs into their historical loans as well. And so from a UK perspective, I'm pleased to date that we have agreements with 9 countries to include CRDCs that have been either signed off or are currently in draft. So I think this panel and more widely with the other countries as well, we've been making a lot of progress. But we are keen to go further. I think the initiative of the Government of Spain in particular, the Debt Pause Clause and Alliance, is a real step in the right direction, as well as the efforts that have been undertaken in the 4 Ps call to action. But it's important to not limit this to official creditors. I think for this to work and to provide that liquidity, we have to have private creditors on board as well. And just to wrap up in a final point, we think, and relate to your question on costs, Deborah, we think that debtors should not be paying the costs for CRDCs, but they should pay off for debtors. And what I mean by that is the way that we've designed our CRDCs is that they are net present value neutral. So it allows countries to spread the cost over, say, 5 years, and there's adjustments made in the interest, but there's no pricing cost that is applied to debtors as well. And we think that does allow them the additional room, but also an incentive for the uptake of CRDCs, which is really important because we've got to practice what we preach. Thank you.
Thank you. Alberto, you already mentioned the engagement with Council of Ministers in relation to Spain's journey adopting this mechanism. But can I ask each of you to expand a little bit on the policy approvals and political journey that you had to travel to be able to offer this to borrowing countries? And maybe there's something you want to highlight for other lending countries that may be embarking on this journey, drawn from your experience.
Thank you. Well, as I was saying before, the policy approval in Spain is quite complex, as is often the case in a highly guarantees-based system. So we have to convince a lot of people and go to a lot of committees, no? But at the very beginning, as I was saying before, we had to convince the many departments that are involved within our ministry. No, we have to explain them what we're thinking about, no, what we're intending to do, and it took us some months to do that, not just internally. Then we have to talk with other ministries, mainly the foreign ministry, because it's very much related with this kind of clauses. And once we have depicted the general framework, then we went to the different committees. No? As I was saying before, also we have 2 different funds that are applying the clauses. So we seek the approval of these committees, the FIEM committee, the FONPRODE committee. This is the committees that oversees the functioning of the funds. And once we had this approval, we went to another level, that is the economic ministry level of economic affairs. And then we went to the Council of Ministers to seek their approval. So I think we began the process more or less right after the Paris Forum in 2023. And we finalized the internal approval in April 2024. That is to say 9 months, I think is very, very, very fast for what is normally in Spain. But after that, we had to do also the practical of the clauses. And we took advantage of the excellent work that the UK was doing. As Elliot said before, that UK have done a tremendous job defining exactly what kind of triggers, the legal system and all of that. So what we had to do is just to adapt it, to fit it into our ideas and into our legal system. And I want to thank UK for the excellent job that they have done so far. And right now we are working also in the internal manuals in order to see how we want to procedure once the clauses are activated. So the job is not done. We are also looking to see what kind of tweaks we have to do associated to our internal procedures. And the improving is continued. We have to continuously improve our procedures, and we are maybe in the middle of all of that. Thank you.
I love the collaboration. Elliot.
Thanks very much. We maybe have a slight advantage in that because we're talking about, for France, government-to-government loans, all the sort of decision-making essentially sits in the Ministry of Economy. So it allowed us to move quite quickly. So for France, it's we include CRDCs, as I said, on our concessional government-to-government loans, which may, and in cases of 100% pure financing by the French state abroad. So it meant that ultimately sort of the minister only had to make a kind of judgment based on the advice that was provided by our by the services, and which allowed us to move rather quickly and start including CRDCs from December 2022. I mean, 2 points maybe I just wanted to bring out and maybe riff off the point that Rue made. I mean, I think when we were sort of explaining, also in the context of all the work that was ongoing, whether and the 4P call of action that was upcoming, other leadership in this space, I think part of the explanation to the minister was this is a useful thing for France to do. It will be helpful for the borrower countries if they are hit by a climate shock, because our clauses are delimited to climate shocks, and it can also be helpful for us in looking after our credits over the long term. But fundamentally, the real value of these clauses is ensuring that, as Rue said, that CRDCs are available across the capital stack of a borrower country. Like, it's useful if you're a borrower, as I see it, for, you know, if you have one loan from France, it's great that you can apply a CRDC on it if you're hit by a hurricane, or you have a drought, or you have massive floods. But it's more useful and it's more helpful if actually across your range of creditors you have, you know, the private sector, IFIs, and other bilateral creditors are also doing the same thing. And so that was, I think, one of the key arguments we made, and it's why we really strongly believe and support all the ongoing work to try and drive uptake. And then maybe finally the point I was just going to very briefly make was it is more complicated in terms of, for France, when we talk about joint lending with the private sector. So there was a risk around juniorization of our loans, so we offer them in concessional loans, but not in non-concessional loans from the French Treasury, because in a non-concessional loan, often we'll be making a government loan where it's 50% of the financing is coming from the French government and the French Treasury, and another 50% is coming from private sector and other sources of finance. And there was a concern, I think there is a concern around how do you manage that sort of loan where you're both on a project and maybe one of you might have a clause but the private sector don't. And I think there's a little bit of work left there to kind of continue developing. There's a bit of a first mover challenge that we'd be keen to continue working on. But short and sweet, it was quite easy for us, fortunately.
Christoph.
Maybe just three things quickly, you know, not knowing the absolute certain story of how it came to be, but having spent a fair bit of time with ministers and at the center of government, I think, to be honest, the fact that we saw this as a leadership opportunity for Canada made quite a difference, and identifying it at the G7 certainly helped to align bodies within government. Interestingly, it's managed out of our Ministry of Foreign Affairs, obviously with a lot of support from finance. And we had a development policy review in 2016 where the main outcome of that was a refocus particularly on women, a feminist foreign policy, but also on, you know, new innovations in development finance. And I think that helped to spearhead things. Obviously, we had a major climate and sustainability agenda in our government. It probably didn't hurt either that we had a Minister of Foreign Affairs that then went on to become Minister of Finance. I was happy to announce and understood the files well. And she was also Deputy Prime Minister, so that provided a lot of leadership at the top. And then finally, pointing again back to Deborah's work, you know, we were able to drag and drop, so to speak, these term sheets and build on that. So my understanding is that they're in there virtually unchanged from what was recommended through your work, which I think probably assuaged a lot of people. Finally, we do, in our system, although I'm not aware of any major loans that have been done yet, do public-private lending with these clauses through Export Development Canada. Be interesting to see if some of those greater concerns exist in our system too, and maybe that's why they haven't happened as quickly. But we're committed to doing them. Yeah.
Rue.
Right. Well, I think one of the common themes of today will be collaboration. I won't bore you sort of with the bureaucratic technicalities of how we got through our system, but I think there's three important points here. So the first of which is like working internally with our partner agencies in the UK government. So we worked very closely with UK Export Finance because they have both the contacts and the risk management expertise to understand how these would be rolled out in practice. and naturally worked very close with our colleagues in the Foreign, Commonwealth and Development Office as well to understand what the impact of these policies would be on the ground. My second thought was that it is really helpful to push pause clauses through political initiatives. So for us, I think holding the G20 and G7 2021 meant that we had that impetus, and crucially you have deadlines with teeth, because we all know that these initiatives can sometimes go on, so it's important to have that sense of momentum, and it's good to see that for upcoming FFD4 and things like the Bridgetown initiative that's carrying on. And I think the third thing that kind of we benefited from was working very closely with the ecosystem in the City of London. So we obviously have financial advisors, we have sort of leading legal services and experts like Barbara to help out with the process from Cover Chance to ensure that we've got a form of wording and drafting that can be integrated into contracts in an effective way. Thanks.
So turning on to my next question, I think you've all briefly touched on which countries are eligible for debt pause clauses, CRDCs, but can I just ask you to just go over that one more time so everyone's clear in the room. Rue, I think you said the UK was making the mechanism available in relation to existing arrangements, as well as new lending, but I wonder if I could ask the rest of you to comment on that. And you've briefly touched on the take-up, but I want to get a sense as to whether you think that there is an increasing understanding at the debtor country level that these mechanisms are being offered, and whether you're seeing the demand coming from them, or whether you are at the stage actually where you're having to raise it as something that you're offering debtor countries. And I think that will give us a good sense of how the ecosystem stands at the moment. Alberto, if you could start off.
Yes, thank you. Regarding eligibility, as I was saying before, we apply this kind of clauses to low-income countries as well as lower middle-income countries. We apply also the clauses to new sovereign loans, both concessional and commercial, as well as debt restructuring agreements. We have not included existing financing agreements in our policy, and the reason is mainly technical. Our assessment is that we don't have the resources needed to do all that job. We think that renegotiate past arrangement, explaining the rationale of the modification, changing the legal documentation, it would be very time-consuming, and we don't have the resources. Maybe, yes, maybe if the clauses are more standardized, more well-known, maybe in the future we can do that, no? Because it will be much more easier. But right now, our assessment is that we don't have the resources to do that. Regarding the take-up and awareness, we think that there are a lot to be done, because I think debtor countries don't know exactly how the clauses work and what are the implications of adding this type of clauses to the financial arrangement. This is the reason why we are holding this kind of meeting. And I think I have to take the opportunity now to ask the MDBs that are represented here today and not represented here today to do and to organize similar seminars during the annual meetings or during the conference, because I think we have to raise more awareness to debtor countries about how these clauses work and the benefits of the clauses, both for debtors and creditors, as Elliot was saying before. I'll stop here. Thank you.
Thanks. I think our experience is very similar actually to the Spanish experience. So in terms of eligibility, we offer our CRDCs on low-income countries and certain middle-income countries. So there's a little bit of a case-by-case approach. We include them automatically in new lending to those countries. So there's no need to sort of request them specifically. They're automatically included in the new lending, the new contracts that we prepare, and for exactly the same reasons that you just described, we don't include them in existing loans. We haven't wanted to reopen and renegotiate historic agreements that have already been signed. I think this point on the demand though is really quite interesting because it's not something that we've seen when we are talking about a particular project in a country that is eligible. You know, it's not one of the first things that the borrower country is requesting. And actually often it's our team who do the lending who are pointing out that, oh, by the way, in this contract that we've provided you, there's this thing down here in paragraph 407C or whatever it is that says this is a clause that might provide a bit of fiscal support, a bit of flexibility in case you were hit by an exogenous shock. So it's not something we're seeing where the demand is large, but I think the fact of the more we do, the more we roll out, and the more we roll out together as a broader share of bilateral, but also wider creditors, the more I think it becomes interesting and socialized, and the clauses become understood as something that's useful. Because broadly speaking, when we've done that, it's been, you know, very positively received. There have been a few countries, I think entirely legitimately, who have actually, because it's new to them, have just wanted to spend a bit of time to understand exactly how they're triggered, what it means in practice. And once we've gone through that process, been very happy that it's in there. But I think there is a bit of socializing that still needs to be done.
I think we're quite aligned in this area as far as I can see. To my understanding, we are not looking at existing sovereign debt loans, but it is now, as I said before, the default for all of our new loans. Yeah, when we announced with Guyana and with Ecuador, just to give you a sense of the take-up, even though, as you said, it was probably, you know, paragraph 402 of the agreement, it was in the main press release and touted not just by us, but by by the president or foreign minister who was making the announcement. So it does seem to be well received. There you go.
I think, I mean, just a personal comment, I think if countries start to be familiar with the mechanisms in the official bilateral lending space, it will also give them the confidence to then raise and be familiar with them, in commercial lending arrangements. So I think that ecosystem will spread further.
Interesting. Yeah.
But really, your observations on this?
Yeah, and so spoke previously about how we included them in existing loans and as default like the rest. And for new contracts and new loans and restructured agreements. I think there's two challenges here why there's not been greater demand for the uptake. Although it has been heterogeneous, there have been some countries and some areas, like you said, where there's been more interest in these, and perhaps in other frontier markets there's been less interest. And I think, going back to your point, Deborah, first of all, there's a need to clarify what the purpose of these clauses are, to make sure that there's an understanding of the value of them and how they'd be used in practice, and ensure that it's not something that you're going to have sort of years of debate over, that when you actually experience an exogenous climate shock that you can use them promptly. And I think that is important. I think the second thing, and this is kind of crucial, and speaks back to a point that I made earlier. I think there is a fear that if you ask for these CRDCs in your contracts, maybe less so for official creditors, more on the private sector side that will be discussed later, that there could be additional costs or penalties by including them. And I think from our perspective, it's important to make clear that the additional liquidity makes it less likely that a country is going to be in debt distress later on. So rather than sort of compounding some of those interest costs that they're facing at the time, as long as there are certain guardrails around that, so you can't continuously move them, or you can only use the trigger twice. So from our perspective, we think it has been really important to sort of engage with sort of debtor countries to sort of improve that wider awareness, but also make sure they realise that there's not going to be a penalty for either triggering the clause or including them in the contracts themselves.
Okay, briefly, can we turn to the clauses themselves? Can you comment, Alberto, I was very interested in your food security component, but I think for most countries, the clauses are going to be more broad than might at this stage have been foreseen in commercial and private sector arrangements, because there is that bilateral relationship between the debtor and creditor country that allows for a conversation if there's an exogenous event. But can you briefly comment for the audience on the shape of your clauses, whether principal and interest can be deferred, whether there's a discretion at the creditor country level, or whether it's pretty in the bag that if the debtor country triggers the mechanism, it will be agreed? And are there limits to how many times the deferral can take place? And if I could very briefly, I think, Elliot, you've commented already, but each of you have ECAs. Do you see some of this work being progressed into the ECA space going forward?
Thank you. A lot of questions, Deborah. Now, I'm going to be brief. No, in terms of scope, we go a little bit beyond climate change-related shocks. We apply these policies to natural disasters, public health emergencies, and food crisis, just provided that the event is exogenous and it affects the capability of the debtor country to debt service. The activation is subject to Spain's discretionary approval, so it's a little bit discretionary in this point, but it's based on objective criteria. The process began when the debtor requests to ICO. ICO is our financial agent of both funds that I was referring to, so it's the main counterpart of the debtor country. So the debtor country requests ICO the activation of the clause. It has to say what kind of shock it has suffered, the implications in the debt service, and the country has to commit to devote the freed up resources to fight the shock that it has been caused. So once that ICO receives this kind of request, we go through the different interministerial committee to seek approval. And once we have the approval of these committees, we go to the Council of Ministers for final approval. This is one of the things that we have to work in the future, because the process is quite large, and I think we have to rationalize a little bit the process. Regarding the clause itself, we apply 100% of principal and interest deferral during a 12-month period. These amounts are not cancelled, but they are recapitalized and repaid under extended terms. We differentiate if the loan is commercial or concessional. For commercial loans, we apply 1 year of a grace period followed by 5 years of linear amortization. And for concessional loans, we applied 2 years of grace period and 6 years of linear amortization. That said, if the remaining maturity period of the loan is not large enough to adapt to this period, we do not extend the loan schedule, but we fit into the remaining amortization schedule. We do not apply any surcharge. We apply also net present value. And we also have introduced the possibility to go to the Paris Club in order to seek more coordination and more transparency about the activation of the clauses. Regarding the possibility to include this kind of clauses in account-backed loans, we are working on that. What we have found is that the main obstacles are related to prudential and accounting issues. So what we have to ensure is when the clauses are integrated or activated, it cannot trigger an automatic reclassification of the loan or any kind of provisioning, because if not, it will deter the banks not to adopt this kind of clauses. I think we have experiences in the past regarding to the COVID-19 moratoria and the application of the DSSI. So we are working with the regulatory and the supervisory bodies here in Spain and also at the European level in order to see some kind of, I don't know, maybe legal documentation or just an approval in principle that this may work, because it's essential, that the banks are perfectly ensured that it will not trigger a reclassification of the loans. So.
Thank you. And obviously being MPV neutral will help with that assessment. Yeah.
I mean, maybe the good fortune is, given we work so often together under various auguses, that I think a lot of our processes are quite similar. So for the French one, similarly, we have a 12-month debt service suspension of principal and interest, which is then repaid over 5 years subsequently. It's MPV neutral, and we define MPV neutral as using the contractual interest rate that the loan was originally provided at. It can be triggered over the lifetime of a loan. So if we're talking about a project that's a 20-year, 30-year project, if there's 3 hurricanes or 3 tropical cyclones, it can be triggered up to 3 times. And just in terms of the eligibility, so France, we focus very much on climate eligibility only. So it's for cases of drought, of flooding, of cyclones, of hurricanes, and that's sort of the those are the overall sort of terms. And then I think we very briefly mentioned ECAs, but again, because of this sort of juniorization issue, we are currently focused on concessional rather than non-concessional blended finance.
I think that sounds right. Just a couple points I mentioned already that we have these loans available through our own Export Development Canada agency, although I'm not sure if any have been issued yet. And there is some ongoing debate, as far as I understand, about some of the interest related stuff. But as for now, it's very much as you explained, and we're focused on natural disaster, climate and natural disaster related stuff for the time being. And again, some healthy debate, I think, within our system on what it looks like to eventually expand out of that.
I think the benefit of going last is that everyone steals all the good points. But from our perspective, I mean, again, in alignment, but there was a debate that we had at the time about parametric versus non-parametric clauses. So should there be an automatic trigger in the event there's, say, a declaration of a pandemic at the WHO, or if the wind speed hits a certain rate? I think we decided against that and went for the common sense approach, like the rest of the panel. I think that's important because while it might not hit some of those parametric triggers, as long as the impact is reasonably said to have an impact on the ability of a country to service its debts, then it's a reasonable expectation that that country is able to use a CRDC. And so that's kind of why we took that approach. On your question about working with ECAs, we work extremely closely with UK Export Finance on this. They're ultimately the ones who will be engaging directly with debtors. They're the ones who would be in receipt of a request. And they're also doing some further work to consider adoption. So we kind of work very closely hand in glove on CRDCs.
Super. So I think we've had a couple of questions through, and I'll turn to those in a moment. But before I do that, I wanted to recognise that Australia has announced it will also introduce CRDCs in new sovereign lending by the end of 2025. Australia is still finalising its approach, but I would like to invite Will Allen from the Department of Foreign Affairs and Trade of Australia to share a few words with us today. Yes, please.
Can you hear me? Yeah? Yep. Okay, excellent. Thank you, Deborah, and thank you to the panelists today for this useful discussion, and no doubt this will feed into our own development of the CRDCs that we're currently developing. We're very pleased that Foreign Minister Wong announced this commitment at High Level Week last year, and Australia is joining a number of bilateral and multilateral lenders that are offering CRDCs. We are committed to addressing climate change by taking action to support climate vulnerable countries in our region. CRDCs will help small and vulnerable countries build economic resilience, allowing them to pause debt repayments in the event of disasters. Unfortunately, we're not in a position to go into further details about our CRDC assigned at this stage, but we are keen to take on board the lessons from today in feeding into this design. We are committed to implementing the CRDCs by the end of this year, and will provide further information when we can in due course. Thank you.
Right, welcome back, everyone. It's my pleasure to introduce Marta Mulas, Senior Advisor at the Ministry of Economy, to introduce our panelists for session 2 on MDBs. Marta, the floor is yours. Before that, maybe we'll start with some welcoming remarks from the Treasurer of the Inter-American Development Bank.
Oh, there you go. Good morning, everyone. Let me start by saying that my name is Ramon Ruiz. I'm the Treasurer of the Inter-American Development Bank, and I'm going to be talking a little bit about our experience with CRDCs. Well, first of all, I wanted to give you a little bit of context and of history of why we started working on CRDCs. And this goes back to the late 2010s or early 2020 when Barbados publicly said that they had started adding their hurricane clauses in their bonds in the market, and they wanted MDBs to start looking into this and see if we could apply CRDCs in our loans. My boss asked me to start looking into this immediately, and we started working on this idea. Why do we do this? Well, as all of you know, countries need fiscal space when they are hit by an event. And at the IDB, we not only look at weather-related events, we also cover hurricanes or any type of catastrophe in which the country is interested to have protection. So we started looking into ways to generate that fiscal space for the countries in order for them to be able to deal with the consequences, help the population, rebuild infrastructure. There are many different topics that they need to cover. So that's the reason why we thought it was important for us to start working in CRDCs. For the IDB and for my colleagues here who cover this type of instruments in the other MDBs, we typically talk to countries and we want to help them building a holistic approach in which they have a good strategy to manage these risks. And when you look at, for example, if you pick hurricane as an example, typically countries have small storms during the year that are quite frequent. They may have a high intensity storm, they may have a small hurricane, or they may have big hurricanes. And in this order in which I mentioned them, the first ones are very frequent, but with a small intensity, and the last ones are very infrequent, but with a very high impact in the countries. So the strategy to manage this risk has taken into account that the countries may have all of these different events. So as you can see in the presentation, the lower level, the lower layers of the approach basically cover the events that have a small impact but with high frequency. And you typically would expect the country to have an item in their budget to have the money to deal with those small storms, with those small damages. As you go up in this structure of layers, then countries need to have risk retention instruments, which is basically meaning that the country needs some money, some extra money that they borrow in a way to be able to pay for the expenses of the event. And there are two types of instruments that follow this approach. One is a plain vanilla loan that is linked to the event and is disbursed when the event happens. Typically, in our case, we have the credit contingent facility that disburses based on a parametric approach. So when there's certain intensity that is reached, the loan is disbursed. But we also added what we call the PPO, which is our version of the CRDC. And it's basically an option for the borrowers to stop paying principal for 2 years. So if they are hit by a hurricane, an earthquake, or whatever type of event that they want to cover, it can be floods. There are many perils that we cover. They stop paying principal for 2 years. The fact that it's only principal makes very easy for us to prove neutrality, which was discussed in the previous panel. So that's one of the key things for us. It has to be neutral. We cannot lose money in a way. One thing that is very important for you to keep in mind when you look at CRDCs at financial institutions like us versus countries is that for us, not having a restructure of the loan is critical. The IDB was funded in 1959, and in the history of the bank, we've never written off a single dollar of government-guaranteed debt. So not restructuring the loan and not consider this event as a restructure was critical for us to make sure that we don't break that principle that gives us the ability to be able to source money very cheap and to be able to lend to the countries very cheap. And then the last layer is basically transferring the risk to the market. And we have two tools to that. One is cat bonds and the other one is insurance. Insurance is the last one that we've approved internally, and right now I know World Bank, for example, but also us can cover any of these tools that you can see in this page. Not every solution works for every client. If you talk to a client like Uruguay in Latin America that is rated BBB+, they told us, well, perhaps I'm not that interested in the CRDC because I have a very good rating and I can go to the markets and source money. But the vast majority of our countries think it's interesting and are interested in using them. So, like everything in life, if it's not free, you will have different opinions. And if you talk to 20 countries, you will get 10 different views on the product. But in our case, so far, we are having a very good reception from our borrowers, and we've been able to implement in a few countries, as you will see later. And as I was mentioning before, not every implementation of a CRDC works for a bank like us. It has to allow us to maintain our strong financial position. So we cannot build a product that would be considered a restructure of the loan. That is why, when we internally analyzed the product, we decided we had to charge a very small fee. When you look at the fee that we charge, it's the same fee that we charge for any modification of the loan. So if a client comes to us and asks us to change currencies, we charge them a small fee. If they ask us to fix the rate in the loan, we typically lend on a SOFR basis, we ask for a small fee. And the reason is that we want to cover the cost, the administrative cost of the operation. We don't want these activities that we do in Treasury to be a drag for the capital of the bank. So we calibrate a small fee to be able to cover the cost. And then that also helps us to defend in front of our accounting teams, our auditors, and potentially rating agencies that this is not a restructuring. This is a feature of the loan that is used by the borrower. And they pay for it in anticipation. They don't come to us saying, I have an earthquake, I want to activate the clause. The clause has to be active before the event happens. So they have a period in which they can activate the clause, which is typically during the disbursement period. This is a little bit a summary of how this feature in our loan works. As you can see in the graphs, there is a 2-year period in which they don't pay, and then the payment has to be distributed in the future, and it's up to the borrower to decide how they want to do it. There are 2 principles that they have to comply with, which is not going above and beyond the original maturity approved by the board, and not exceeding the approved maximum average life of the loan, because any of those 2 constraints could be seen as a restructure of the loan. So again, to protect the institution, that's the limitation that they have. And you will see that there are 2 periods in which they cannot use the feature. One is at the very beginning of the loan, and the other period is at the end of the loan. At the very beginning, we don't allow them to use it because they can do it for free. our loans have the feature that during the disbursement period, during the first few years, a client can come to us and say, I have a big maturity in 2035. There is a bond that matures at that time. I don't want to have payments that year. And they can reshuffle the cash flows without exceeding the average life and the maturity date. So they can do that for free during the disbursement period that is typically 5 years. And then in the last 5 years, if they have to postpone payments to not exceed the average life, they don't have material time to move payments around and not exceed the approved average life. So those are the two main restrictions. But other than that, they have plenty of flexibility to play with the cash flows once they are hit by the event. As I mentioned before, we cover plenty of perils. And one of the things that we've done as part of this approach, as I was mentioning at the beginning, to cover a holistic view for the countries, is that we typically try to tell the countries, you have lines of credit, you also have clauses. You have to take an approach that is consistent, in which you can determine when do you want the loan to be disbursed, when do you want the clauses to be triggered. So you need to have consistency in your triggers among the different products. So what we do is we design the triggers for these clauses using the same definitions that we use for our loans. So we ask the countries to have our credit contingent facility, and we have around 15 countries that have that line of credit with us. So we extrapolate those same triggers, and we allow the country to define if they want to trigger at the same time that the loan triggers, or if they want to have a higher intensity for these clauses to trigger. We help them develop that strategy, and that's part of the discussion that we have with them. These are the 7 countries that already have those clauses. Of course, Barbados asked for it and was the first one that started using it. And you can see the perils. We have hurricane, we have excess rainfall, we have earthquake. So we try to be quite comprehensive. The one that probably we couldn't take is pandemics, because suddenly we have all the countries not paying us, and that would put the bank in a difficult situation, especially from a liquidity perspective. I would have to go from issuing 20 billion to issue 35 billion in one day, changing completely my funding program, and that may be an issue for me. But other than that, as you can see, we can cover many different perils. And as you can see, the amount of loans that have the clause is increasing exponentially. So there is a good take-up from our clients. They are really interested. And 5 basis points, when they are paying 550 basis points all in, doesn't make a big difference in terms of how much money they pay. And we even have ways to try to accommodate that payment, changing features of the loan, like changing currencies to currencies with a smaller interest rates, or fixing rate for a few years when the fixed rate is lower than SOFR. So we have ways to try to accommodate that and make it more palatable for the countries. And lastly, what is next? We think that if we go back to that page in which I was talking about the holistic strategy, cat bonds and insurance was the last layer in which we haven't been very active in the past, and we now really want to become active. So we are adding insurance clauses to our loans. Since 2019, our loans have the clauses to be able to incorporate insurance, and we got approval from our board. So now we can also tell the clients, you can postpone payments, but you can just not paying an additional fee in the loan. So that's the next step. And we are working on putting together a regional platform, and we are looking for partners like Spain, for example, or the UK, or the ones that were sitting here before, to finance that facility, because putting together that strategy requires effort and money. So I can talk about Latin America, which is my region. Many countries don't have the resources. When you go to visit the Ministry of Finance, when you go to visit their teams in the government, many times they are very small. I can tell you there are countries that they have the public credit division that handles all the financing of the country, maybe 2-3 people. So talking to them, they know about borrowing. They don't know about how to mix the CRDC world with the pure financing world. That's a difficult challenge for them. Many times you have to put together 3-4 ministers in the table to discuss these things, because it's impacting finance, but it's impacting whoever, if we are talking about hurricanes, is whoever manages the infrastructures and other teams, other ministries that manage different topics. They all need to sit to the table to agree among all of them those strategies. So help from partners is really critical at this point to try to push this forward and to make not only increase the plain vanilla CRDCs, but all these innovations that become part of the strategy that we think is critical for the countries, not only in Latin America, but in the world, to manage their CAT risk, not only climate-related, but in general catastrophe-related risk, because it's really critical for them. And we all know with climate change, this thing is becoming more and more important for many of our clients. That's it.
So thank you. Thank you very much, Ramon. So now we move to the panel. So we because in the end, it's not only the IDB, the Inter-American Development Bank, who is offering indeed debt pause clauses, mainly linked to climate disaster. That's why they call it climate resilient debt clauses. There's other banks. We have the World Bank already offering, also the European Bank for Reconstruction and Development, the European Investment Bank, the African Development Bank, who has already announced, but they are working on that. But also the Asian Development Bank and the Asian Investment and Infrastructure Bank. So almost all the MDBs are already either offering already or working on that. And so that's very relevant, these panels, because we get the really kind of large overview of all of them. Some of them have quite a large experience, as the IDB, as Ramon has explained. Others not so many, but not so much. But at the end, they all have enough experience, background, to share with us. And for that, we have a very esteemed panel here. First, I would like to introduce our World Bank representative, Mahmoud Ruston-Shin, manager at the EBRD IDEA Corporate Finance at the World Bank Group. Thank you, Mahmoud, for being here. Then we have Dimitri Halapowski, Principal Business and Product Development, Climate Strategy and Delivery at the European Bank for Reconstruction and Development. Thank you, Dimitri, for being with us. Then we have Victoria Kistri, from Head of Division at the Strategy and Policy at the European Investment Bank. Thank you, Victoria. And finally, Harold Lewis, the manager from the Ministry of Finance, Economic Planning and Information Technology of St. Vincent and the Grenadines. So thank you very much for all of them to come all the way to Spain for one day, which is really much appreciate panel day and of event. So how we going to move on? Every single panelist we're going to produce will give us small and brief presentation to explain to you how the CDCs and how they look at it. Particularly, the MDBs will look at the why they consider relevant to have them and to offer to the clients, which are the key features, the characteristics, also the benefits and the challenge that these clauses pose, and also the way forward. And finally, we have a very unique presentation, which is from St. Vincent and the Grenadines, because they will provide its experience, because it's one of the few countries that have kind of closed the loop, we will say, because they have included in loans, but also activated. And I think they will provide very interesting overview on how this means experience and what can others learn about it. So let's then start by starting to discuss with this panel. But finally, also I would like to highlight the African Development Bank will provide us with a small short comment to also highlight what they're doing to implement those clauses in their bank. So first, let's move to Mahmoud. So yes, thank you.
Okay, well, thank you very much, and thanks for the great presentation, Ramon. I think it sets the stage pretty well. Everything that you heard from Ramon is something that we do too, so I will just rely on that great presentation and just build upon it. So the first one is, what is CRDC? So briefly, it is an option that we give to our eligible borrowers to put a clause in all their loans, both the new loans and the existing loans, so that they can defer their payments. And those payments are interest, principal, and any other charges when eligible event hit their economy. So in a nutshell, that is the deferral. Now the second one that briefly I want to touch is, what is the benefit to our borrowers? I think it is obvious that when there is a disaster hitting your economy, the last thing you want to worry about is the payments you make on your creditors, on your interest and principal payments. So these clauses, once they triggered, they provide speedy fiscal space for our borrowers to channel their resources into disaster recovery. And and also, once you are really badly hit, then you can very well be in a situation of making this terrible trade-off, whether you default or miss your payments to risk your credit rating, or you channel your resources into crisis response. So this also gives them the space to really avoid these difficult trade-offs that they may make. In terms of eligibility, for the reasons that I will be covering in my next slide, we are offering this to small states. There is varieties of definitions of small states, but we include to the small states as defined by the World Bank, but also as defined by the Small States Forum, and the UN has its own definitions as well. We are offering it to both new and the existing loans. I can tell the history on what was our line of thought when we came to the conclusion that we felt comfortable in extending to the existing loans as well. And also, as Ramon said, we allow them to be triggered, those classes, only when they start their first principal payment and before the 50th year of the maturity, before the maturity. A little bit statistics here. We have around 45 eligible countries when we look into for both IBRD and IDA borrowers, and out of that, 21 has already signed, and they already put these contracts in their loans. And the total outstanding loans that has these loans is about a little over $4 billion that is already there. In terms of covered disasters, we had an evolution in our line of thought as well. Currently, we are covering virtually all exogenous shocks that an economy may be exposed to. Any natural disasters, and also the pandemics, the biological events that hits them. We deliberately excluded events like, let's say, civil war that a country may initiate. Not that willingly, but anything that has internal cause, those are currently not eligible. But otherwise, any natural disasters that you can think of, that is now taking me to my next point, that cause the nation to declare a national emergency is going to be eligible. And then how it works, we had quite an evolving thought on that as well. Initially, we started with parametric triggers, which made us very restrictive in terms of what perils that we cover. That was the earthquakes and the hurricanes, which are disaster risk experts, so that you can quantify them. But you cannot quantify every catastrophe, and even if you can quantify methodologically, you don't have data. You need data for local purposes. So we got rid of it. Basically, right now, our requirement is that at any point, a nation declares an emergency and then submits that they have declared an emergency for whatever the reasons are. It comes to us, we review it, and then once it's a quite often light review process from our side, prudent but light, then it becomes eligible. In fact, in case of St. Vincent and Grenadines, and I'm actually quite looking forward to what comment we are going to hear from Harold, but it took about 5-6 business days for us to decide the moment St. Vincent approached the bank, and for us to say that, yes, you are eligible, and then a couple additional days to get into what kind of parameters we are getting into. Now let me talk a little bit on our key considerations. I'm not going to be getting into detail deliberately. We have very limited time here. There are lots of parameters that we have added, but I think it is important to appreciate what are the key considerations that yielded to where we are right now. And the first one is our preferred creditor treatment. Ramon already touched upon it. We take no action where it would even put in doubt, even it would raise the question of the preferred creditor treatment. For those of you that are not familiar with MDB's financial architecture, I want to leave you with a key message that PCT is a key pillar for our financial architecture. And in other terms, in absence of that, the amount of financing that we can do will only be a fraction of what we are doing right now with the capital that we have. So we have varieties of parameters. I put some of them on the slides. You'll read them. So some of the constraints that we implement are so that we do not dilute our preferred creditor treatment. So that is one key consideration in pretty much any financial policy that we develop, that we do not jeopardize it. Number two, we don't want to get undue risk to World Bank's finances. Let me be clear here. We are not necessarily a risk-averse institution, but we want to design this so that we don't get undue risk, because any excessive risk we put on our balance sheet due to CRDCs will necessarily get the financing away from the broader clients that we are serving. And even those borrowers that benefit from CRDCs will actually be worse off. So again, we have some considerations there, and you see on the slide. The third consideration is that we don't also want to put undue risk to our borrowers. It is important to realize that we do this in a PV neutral basis. There is no forfeit of any type of obligation. We don't extend maturities and etc. But the moment you keep pushing the payments forward and forward, and you fix the average maturity at a certain point in time, then what it necessarily implies that the payments will be just balloons. And we don't want to see our borrowers in a situation that because of the postponements, they get a massive shock of their payment obligations to the World Bank. So we have few considerations on that one too. Now, when you put all this together, then we ask the questions to ourselves, then to whom we can offer this product, given the constraints and the limitations that we have, so that we can create the maximum impact. We have data. We did a lot of analysis in terms of the impact, and our data, the analysis that we have done, is showing that I need to wrap it up. Yes, are showing that it's the small states that are the most vulnerable, and they have the least capacity to react when a crisis happens. I have a few more, but I'll respect and I'll pause here. Sorry for that.
Thank you, Marta, for inviting us to this event to speak on behalf of the European Bank for Reconstruction and Development, EBRD, on our experience with designing and putting in place our instruments. I'll just cover a few elements I keep hearing from this session, but also from the preceding. There's a lot of coherence in some of the approaches, not on the others. So I think this space is still very much evolving, so we'll have to see where we'll end, where there's a common landing ground for all. But I think, let me just start with the outlining kind of our conceptual framework, how we started with thinking about this back in, I think it was 2023. And for us, I think some of the key considerations that we had was, and we knew at the time of the experience of the pioneering experience of IDB that they've already taken, but we operate in a completely different geographical region. So EBRD operates in Eastern Europe, Central Asia, Northern Africa, sort of what we call the CEMED region. So our countries are not exposed to the same type, particularly the cyclones and hurricanes that the IDB regions is exposed. So that provided one of the kind of backgrounds to our thinking. The second one is EBRD is primarily private sector focused bank. Over 80% of our business, annual business, is in private sector. And CRDC is primarily or largely a tool that is used of benefit to sovereigns, to governments. On the other hand, EBRD, through our operations in the private sector, have already developed a wealth of instruments which allow flexibility to our private sector clients. And also then the point which Mahmoud already brought up, our preferred creditor status, PCT, was also a critical consideration. We did not want to compromise that, and we did not want to compromise our AAA rating, which would then increase the cost of borrowing. So all that led to the formulation of our approach, which you can see here on this slide, which covers the key elements of our structure. So maybe to start with, we had to pick a sort of a reasonable subset of our countries where offering these clauses would make sense to the countries. And again, echoing to what Mahmoud already said, in terms of these being more meaningful and reasonable in countries which have less fiscal space, who are more vulnerable fiscally, but also climatically. So therefore, we decided to go with a kind of something that would be not self-imposed, but independently verifiable. So we've chosen the World Bank's income classification, GDP per capita, as the proxy for the country's ability and the flexibility of the country and ability to deal with the fiscal shocks. So we have chosen the LMI, lower middle income countries, which is the lowest, which was at the time the lowest income category of our countries of operation. Okay, obviously now EBRD has just announced that we're expanding to sub-Saharan Africa, 5 more countries, so that will need to be given due consideration. But at the time when the system, the instrument was designed, these were the most relevant countries that we could offer it to. On the borrower side, so again, considering the peculiarity of how we operate, so we are offering it to sovereign clients, sovereign guaranteed, but also very kind of specific to EBRD, municipalities and regions. So the decision was made that these are some of the kind of the entities that we have as our immediate counterparts, where they can also make the most benefit. But then they need to be located in those lower middle income countries. In terms of the hazard, again, I won't cover much. So we're currently covering only 3 hazards: so floods, droughts, and earthquakes. So this is again more natural disaster, not just climate. Again, speaking to the fact that this is again CRDCs is probably already a misnomer in a sense. In terms of the triggers, again, having gone to the analysis, okay, we also tried to look into parametric, but then realizing we're going to have the data available in our region for the triggers that we were proposing, for the hazards that we were envisaging. Therefore, and also then I think more critically, bear in mind the potential risk that we will be bearing in case the perception risk, where the country requests the clause, but we are not able to trigger. So the decision was made to go with the soft triggers, whereby the country would be putting the onus on the government to declare a state of emergency and then request the deferral, which will just pass through some quick administrative check, where there is no any additional kind of checks or contingencies on our side. This is technically automatic, subject to compliance with the submission requirement. We're only offering to the new loans, and here I think we're a bit deviating from what the World Bank is looking at, the way we're looking at it. For us, touching our existing loans would be akin to debt restructuring, which is not the area we would be even willing to consider. So therefore, it's only new loans. And also, from the perspective of, again, we heard it in the previous panel from several, I think, speakers, the juniorization of the debt is a particular concern. So therefore, we're only offering it to the transactions we are acting as a sole lender, at the moment at least. In terms of deferral modalities, it's, I think, largely similar across other agencies. We're only offering principal deferral, and here our thinking is having visibility on at least the interest payments give us a good sense of how healthy the deal is. Because we've seen the cases where it's a kind of a first sign of potential default, where the borrower is not even able to service the interest payments. It's only available to be triggered once during the tenure of the loan. We have an automatic fixed 2-year deferred period, which again minimizes the administrative burden. There is no questions raised with the borrower. It's a 2 years fix, either you take it or not. Similarly to others, the deferred debt is being capitalized and repaid until the original maturity. And there is also a fee. Yeah, we also kind of here, I think, aligning in terms of thinking. We're offering this as a service, as an option that the borrower elects to choose or not, and it carries some administrative burden on our side. And this, yeah, on the total kind of scheme of the size of the loan, this is we're not expecting to be a barrier in itself in terms of the uptake. We haven't had any at the moment. Yeah, we haven't had any loans with the CRDC included yet. So our banking teams are actively sort of going out, and it's a question of the demand, I guess. Also, demand and supply is there, so we're exploring the demand, and yeah, we're looking forward to signing this for first deals with this, calls included. Thank you.
Victoria, please.
Sure.
Thank you. First of all, thank you so much for the invitation. It's great to be in such a great place. Casa de Americas is fantastic. And congratulations to Spain for taking the initiative on promoting CRDCs, which is in itself an interesting proposal, a proposal that could have impact. So from the European Investment Bank, we are very supportive of the initiative. And before I get into the specifics of the CRDC clauses, and I know that we have limited time, but maybe I would like to first put in context the way that EIB operates for outside Europe. So a very quick introduction on EIB Global, so the part of the European Investment Bank that focuses on outside Europe. We are, let's say, the part that supports EU's external investment strategy. So we work very closely with the European Commission, particularly when it comes to outside Europe. What does this mean? It means that for let's say, 70% more or less of our annual financing volumes, these benefit from a European Commission guarantee, and they are typically focused on the sovereign sector. There is a bit of private sector too, but it's most of the, let's say, operations that we do with the coverage of the Commission are on the sovereign space. In terms of volumes, just to give you an idea, because this also links to certain credit considerations, EIB Global has annual financing volumes in the region of 8 to 9 billion out of a total annual financial volume for the whole EIB group of around 90 to 95 billion. So more or less, we are speaking about 10% of the EIB group's annual financing volumes. As part of our operations outside Europe, and again in full alignment with EU priorities, we support less developed countries. Round about 42% of what we do is in the countries. Now, I hope in a very, very quick summary, I hope I have given you a good idea of what we do in EIB Global and how, in terms of balance sheet, it compares to the overall EIB group. And now I would like to delve into the specifics of the climate resilient debt clauses. Similar to most of the colleagues here, and we had spent a lot of time back in 2023, we approved the CRDC product in EIB Global. For us, and again, speaking to our DNA as the climate bank, the product has a clear climate element to it. So the trigger events are linked to climate. It has been approved, the product has been approved as a pilot. Why is that? Well, the important thing is again, to keep in mind that most of the things that we are doing in the sovereign sector, in the sovereign space, are done with the Commission's guarantee. So whatever we support, we are in a way, the EC is our partner. Which countries have we agreed with the European Commission to propose? Well, for us, is the less developed countries and the small island developing states. And we have had the honor and pleasure to work together with the Inter-American Development Bank on the first operation in Barbados that featured climate resilient debt clauses. Similar to all of the other colleagues, the option of it is up to the borrower to ask for the climate resilient debt clause to be activated, so it's not automatic. In terms of deferral, again, also for us, it's about principal deferral and within the original maturity of the loan. So I think that For us, the important thing is very close to the thinking of EBRD, as mentioned earlier by Dmitry. We consider that interest payments are a good indicator of the healthiness of the counterpart. So in a way, this, when we are speaking about challenges, Marta, I think that vis-a-vis the Commission, but also vis-a-vis the rating agencies, and that our AAA rating is a very important element of the overall proposition that allows us to have the impact, is important to give the assurances that there is no moral hazard, and we believe that the payment of continuous payment of interest is an indication and an indicator for that. Deferral period up to 2 years, and in terms of challenges that we saw, well, for us there are 2 challenges, and this also ties with what we have heard in the previous panel, which was also very interesting. For Barbados, it was a very particular operation. It was an operation that, in terms of that, featured also a debt swap. It had a number of elements. On our side, and fully supportive of the initiative from Spain to increase the usage of CRDCs, it's important that this becomes a mainstream product. That is not just for a very complex, and again, I mean, the Barbados operation was innovative, was a trailblazer, but it's true that if we want to increase the usage, this needs to be part of the overall product offering. Which means that in a number of cases, particularly when we are speaking about LDCs, the value of technical assistance in terms of helping the borrowers to actually utilize these clauses, utilize them in a way that also the private sector can actually feel that it's something that could be done. I think that's one challenge. And the second one is in terms of uptake. I think that the combination right now, in terms of demand, we do see demand in seeds, but not so much on LDCs. And I think the point of technical assistance could help unlock the use of CRDCs. So thank you very much.
Thank you, Victor. Go ahead.
Thank you, Marta. Thank you to the sponsors for inviting me here to represent St. Vincent and the Grenadines. I'm in a unique position as representing St. Vincent as the only country to have triggered the CRDC. So I will explain briefly our DRS strategy. Basically includes the options. When a disaster hits, what happens? Where do we get the resources? So we get the resources basically from our budgetary reallocation. We have a contingencies fund where we put our monies in. We have contingency line of credit, which is our CAT DDO. We have a parametric insurance, which is PRIF. And finally, the use of CRDC. We actually signed the CRDC a month before it was triggered, as you can see, on the 5th of June. Hi. 1, 2, 1, 2.
You can use mine.
No. 1, 2. Okay, good. So we actually signed, thank you. We actually signed the CRD on the 5th of June, 2024. What happened? We were hit by a tropical hurricane, Beryl, on the 1st of July. It's good? Okay. On the 1st of July. And then we had discussions with the World Bank to basically trigger the CRDC. And why did we do it? First, we met all the criteria. We were eligible. We were servicing our debt. We declared a national disaster, as Mahmoud indicated, and we were successful in getting the World Bank to basically sign off on St. Vincent and the Grenadines being eligible to activate the CRDC. So we had basically a week or two of negotiations between the World Bank and our technical team to explain to us the impact of the 2-year deferral in terms of the debt service payment on both principal and the service charges. So that was very important because it's critical. When you're in distress, you want as much liquidity as possible. So we were grateful that the entire principal and service charge were deferred. The World Bank did the analysis. They basically indicated to us what was the impact of deferring our eligible loans. We had 31 loans in the portfolio that were deemed to be CRDC eligible. Out of that 31, 15 basically met the criteria. St. Vincent and the Grenadines opted out of the 15 to defer 10. We did that because when we did the analysis in terms of what was the cost saving and what was the total cash flow that would be impacted, we opted to defer basically 10 out of the 15 loans. We agreed basically to defer that for the 3-year period as indicated by the World Bank. So what happens thereafter is that you then have to pay your debt service after the suspension period, which is the 2 years. So it is critical in terms of observations going forward. And I note these observations in the sense of one, countries need to understand when they make the analysis, what is the magnitude of the deferred payment in terms of dollar value, and make a decision as to, are you going to be able to afford repaying these loans in 2 years' time? So you have to set up your own cash flow management to see whether or not you will put aside monies to meet those deferred, because a suspension is not a debt relief. It's just a postponement of both principal and interest for when that period comes. But you have to prepare for when that period comes. So that is one of the most important things. We think as well countries should enact CRDCs in their loan agreements because it acts as an ex-ante form of bolstering your mechanism for meeting any fiscal risk from disasters. And it also signals to your creditors, if your creditors basically have mechanisms in place that would allow you to ease your burden, why not utilize those? Because if you have to go to your creditors and to borrow a loan, they will say, well, we had an option, we had a mechanism available in terms of CRDC, you didn't take it. So clearly, they would look at you in a much more different light. So that's important. I would strongly also advocate for more widespread use of CRDCs across the spectrum, not just by MDBs, in this case the World Bank, but by other IFIs, large commercial private creditors, and also other creditors. We do understand as borrowers that there's a perception of when you activate these type of clauses, it signals to the market that it's a debt restructuring. So education is needed in that respect from both the creditors and the borrowers. I think that is critical.
Yeah. So thank you very much.
That's it. Yeah.
Thank you. Yeah, finished.
Yeah.
So thank you indeed. Yeah, quite true. No? So now I invite Mr. Ricardo Caballero, from manager of the LM team, African Development Bank, to make a short comment on what they would do and what they're working on. So please, could you come to the either stand up or come to the atrium? I think maybe it's just easier for you as you wish, and I really think. So there's not going to be much time, unfortunately, for question and answer. So I invite you, if you do want to have a question, to write it in the app. I will pose a first round of questions, but I will please to hear your voice and your questions, and to translate to the panel. So go ahead, please.
Okay. I don't know. Is this mic working? Yeah.
Yes.
I tend to speak very softly, so please excuse that. So good morning, everyone. I will just make a brief statement that discusses where the African Development Bank stands with respect to CRDCs. First, I would like to start by saying that the African Development Bank remains at the forefront of climate-conscious development, ensuring that Africa's growth is economically empowering, decarbonized, environmentally sustainable, and socially inclusive. Climate considerations are now fully integrated in our operations, and we have set ourselves the goal to target at least 40% of all investments made by the bank are dedicated to climate financing. And we are committed and have consistently met and at times exceeded that target. Since 2018, the bank has established the Africa Disaster Risk Financing Initiative, an initiative that is designed to improve climate disaster risk management and to strengthen resilience across the continent. Additionally, the bank facilitates the payment of insurance premiums to the African Union's African Risk Capacity, or ARC, and that ARC helps African governments enhance preparedness and to respond to extreme weather events and natural disasters. The AFDB is committed to implement CRDCs, at first focusing on a small set of countries, and these clauses will complement the broader portfolio of financial solutions that we have deployed to enhance the bank's climate risk management. To ensure the effective implementation of CRDCs, we are currently working on defining the types of disasters that can be covered, the trigger levels for financial activation, the validation mechanisms for severe weather events and natural disasters. The key challenge that we are facing at the moment is accessing comprehensive climate risk data. And this is needed to accurately define the triggers and to model the financial impact of CRDCs on the bank's liquidity. This is quite important for us as we are rated AAA, and liquidity position is one of the key variables that supports our AAA. So we are currently working on obtaining historical climate risks, or at least synthesized trends of disaster frequency across the continent, as well as severity metrics such as earthquake magnitude or GDP loss percentages due to the occurrence of severe weather events or natural disasters. Mm-hmm. To do so, AFDB is actively engaging with climate-focused organizations operating on the continent, including ARC, which I mentioned before, to obtain these essential data sets that will enable us to finalize our CRDC framework. We believe that by harnessing data-driven insights and financial innovations, AFDB is optimistic about successfully implementing CRDCs in the short to medium term, further strengthening Africa's ability to withstand future climate shocks.
Thank you. Thank you
Sorry
much.
about reading.
Thank you, Ricardo. Thank you to all the panel for their presentations. Now we move to the Q&A session, and of course I'm already starting to find out there is many questions. So we'll see. So I really beg you to be short and to be, to limit your intervention. So now I'll move to Ramon. So what we can see, with these panels, that all the MDBs, or most of them, particularly the ones who are here represented, they are working on CDCs. On that front, which will be the way to cooperate among you to foster standardization on the terms of the text, on the triggers, on the parameters, how this can be done, how could this work, and could help to implement and also for the borrowers to include the CDCs in their laws?
Well, I think at least on the MDB community, we've been collaborating for quite some time. Not only in this, but in many topics, so the collaboration already exists. I think standardization is always positive, but up to a point. I think you cannot compare a 25-year loan provided by an MDB with a 7-year bond issued in the market, so we have to be mindful that there is a limit that we can reach in terms of that, in terms of standardization, but and even ICMA has already published their own versions of the CRDC, so standardization will help, but I don't think that will be a deal breaker in order for a country to take, or for a borrower or lender to use them or not. I think we have to move in that direction to make things easy for everyone. But I think we also need to keep in mind that not every product is equal, and there will be a slight difference between the different ones.
Thank you. So now moving to you, to Mahmoud. So as we say, road to Seville, because at the end of the day, this event is thinking on Seville, and it's going to be this conference in just a few weeks. And as the minister highlighted, one of the priorities of Spain is to push for these debt post clauses to be offered by many creditors, not just from official creditors as the first panel, or to multilaterals, also to others, and particularly the private sector. So from your point of view, so which arguments or which should we enhance or should we stress for others to come, particularly the private sector, which is more lagging behind?
Yeah. I mean, for us to have a direct influence on private sector is a bit difficult, but nevertheless, let me tell you how we went to our board. When we went to our board, in a span of less than 2 years, we went 4 times, continuously improving the product, the CRDCs. In pretty much every single time, we said that what we do at the World Bank is a drop in the ocean. It will not move the needle a lot. It will move the needle for small states. That's why we are focusing on them. But these products are impactful only if there is a broader utilization of it across the spectrum, including the private sector. I think probably our engagement with the rating agencies and helping rating agencies to realize that these are not really debt restructuring, and that's a taboo for us. We don't do this as a debt restructuring. St. Vincent and Grenadines' obligation to the World Bank did not diminish. It just we reprofiled. And if we come to the realization that these are, number one, not debt restructuring, and number two, I think there is a bit of an education that needs to take place. Unfortunately, we don't have time. We can talk a lot more on the sidelines, but lots of work needs to be done in educating different stakeholders that these clauses help prevention of debt restructuring. That is the way we see it. Again, if you are hit by a crisis and you have kids suffering, your economies are collapsing, your bridges are nowhere, they are all damaged, probably the last thing you will consider is how you service your debt, and you don't want to be in that difficult situation. Let's do it in a reasonable way, in a disciplined way, in a structured way, on an ex ante, that we reprofile this when the events happen, so that the countries will put their economies together so that they can really honor. I think it is more the communication and the outreach that needs to take place, and we are very supportive of expansion.
So I'm very glad to hear that, because we are doing this today. So, and also we're going to have a credit rating agency session. So hopefully this indeed goes the direction that you're praising. So now moving to Dimitri, and indeed, no, as you said, the private sectors, the one leg in hand, the BRD has a strong focus on it. How could the bank, as they work closely with the private sector, to encourage and to let them know why it's important for them to include it? Thank you.
Yeah, thank you, Marta. As I've kind of indicated in the earliest intervention, essentially, so with almost 80% of our business in private sector, our conclusion was we do not need, at least the private sector in our countries of do not need a clause like CRDC, because we already have the flexibility embedded in our operations. We have the liquidity frameworks, we have the restructuring actually also available, we have the payment deferrals or working capital options. All that is already, all those tools are already available to the private sector clients in our countries, not so much on the sovereign side. And we can give an example of a Turkey earthquake. So EBRD has managed to mobilize around 600 million euro within the span of a month, and the funding was available to disburse within the next 2 months. So the speed of disbursement and the ability to mobilize liquidity on a sizable amount was equal or comparable to what the CRDC could offer. So therefore, we do not see, at least from our perspective, we do not see the need to have a special private sector focused, private sector clients focused CRDC tool in our toolbox, because we already have the tools available. But on the sovereign side, definitely, that's a totally different story, and that's where we see the kind of direction of travel.
Yeah, so I'm glad also to hear that. And that from Victoria was really, I think your point on technical assistance is really relevant, because you were already highlighting, it's not just about the credit rating, it's also the borrowers. They do need to know about these clauses and how they work, how they will benefit them, and there is also how to manage them. And I think this technical assistance that you will highlight in your presentation is quite relevant. So how do you think should be fostered, and how, and take into account your experience, what do you think is relevant to highlight whenever you approach a borrower, debtor, regarding CRDCs without debt post clauses?
Sure. So I do believe that one point before the technical assistance, and I know that we don't have a lot of time, standardization. You mentioned the standardization, and I fully agree with Ramon's point. We in EIB have had the pleasure to work together with Inter-American Development Bank. So we see that when two MDBs work together, there is an element of capacity building vis-a-vis the borrower. Having said that, the MDBs have a large scope of different technical assistance pockets, be it through donor financing, through commission funds that could be used in order to build this capacity, to build an understanding. So to my mind, standardization is actually a gradual process. MDBs are being asked and are working together as a system. More recently with EBRD, for example, we signed a mutual reliance agreement, not in terms of CRDCs, but in terms of modus operandi, of working more efficiently for a client. And how does this link with the CRDCs? Because ultimately, if a client has less things to worry about in terms of interactions with the MDBs, it's clear that they are more willing to take on new challenges, CRDC being one of them. So I would say this would be an important stage. And standardization in terms of clauses when it comes to the private sector, up to a point, being able for a quick reaction, all of these are elements that there could be a preparatory stage through the use of technical assistance in support of the partner countries.
Thank you, Victoria. And Harold, so it was really interesting, your presentation. And I think your experience really brings a value but to all of us, but for sure for the borrowers. So taking into account considering your experience, what lesson learned and what recommendation and what you will say to a borrower, to a debtor who's considering to include these clauses into their loans, but also even to their issuance. So thank you.
Well, I mean, I think having the option available is what is critical. In other words, you do not have it in your toolkit now. So the best thing to do is try and have it available. So in the event if a natural disaster hit, you have that additional option to use to get that liquidity support. And as I mentioned as well, it sends a signal of credibility to your creditors. Because if your creditors are offering this option and you as a borrower is not availing yourself of that option, clearly, if and when an event happens and you need that liquidity support, then you cannot go to your creditor for an emergency loan, because the first thing they'll ask you, why didn't you take up the CRDC, and so on and so forth. Clearly, as well, each sovereign, each Ministry of Finance, each debt manager will have to look at its loan portfolio and make those calibration accordingly to see exactly how you're going to fit your CRDC in your debt management strategy, and so on and so forth. But overall, I think it's an important tool in your toolkit, and you should make the best use of it.
Thank you. So now I'm taking the questions from the floor. So thank you for those who have posed some questions. So now the first one is returned again to you, Ramon. So how do you discriminate between a disaster affecting the whole country and an event of the same magnitude but affecting only one province?
So that's part of the work that we do together with the country when we define the triggers. And this is part of the Great Contingent Facility and of these clauses, where we define there are countries in which the trigger has consideration about the number of people that have been affected or the area that was impacted by the event. So those considerations are part of the triggers.
Mm-hmm. So now there's no focus to anyone, but just to continue with you, Mahmoud. Indeed, they are focused on how this effect, the clauses, will affect to the credit rating in recipient countries. While we do have a specific session on credit rating later on, I think it would be relevant to have the perspective of an MDB, and not only probably for borrowers, but also as a bank. So how have you managed to be reassured that credit ratings will have any impact to your credit rating?
So I mentioned a couple key considerations, and one of them was no undue risk to borrowers. If you remember, one bullet in my slide was that in particular. So it's not only that we want to minimize the undue risk on us, but we don't want to minimize it to our borrowers too. So we had consultations with rating agencies, and when you talk to them, they tell their concerns, they tell you their red lines. The biggest problem in debt clauses like the CRDCs is that you reduce the obligations and you create the discretion in the reprofiling. The moment these are all done on a rule-based basis, that everybody knows when certain events happen at certain points and there are defined rules, the feedback we got from our rating agencies' interactions is that they would not consider them as debt restructuring. Therefore, there will be no impact on the rating agencies. Let me give you a bit of an interesting thing. The World Bank is a AAA rating, I mean, colleagues here, but we issue single A rated bonds as well. I mean, not that we are single A rated, but sometimes the structure, the bond that we issue has the embedded risk, and it's all understood on an ex ante basis. It doesn't affect our credibility, it doesn't affect our rating, but then the product may be that. So that communication we have done, and we got the comfort that this will not be affecting the rating of the borrowers.
So thank you. So now, Ramon, I do have to turn again to you because it's focused to you. So the IDB mentioned, indeed, it's not, indeed, it's more for you, Mahmoud. I have to return because in this EDB has mentioned the challenge of including pandemic in the covered event of its CRDCs. How has the World Bank approached this, as you are including pandemic as well?
So I think what I heard from Ramon, please correct me, is that when a pandemic happened, imagine COVID, that it hit everybody simultaneously, right? The whole world was locked down. Now, imagine that you allowed all your borrowers to put the CRDC in their clauses, and then they are simultaneously exercising it. Then, rightly, you will, and I think that's a concern from IADB, that you will be getting into liquidity crunch. Your liquidity will be stressed. You have to go to the markets and issue then your funding program. It can get into this vicious circle. The way we look into is that we also do stress analysis when we calibrated what parameters we choose, what countries and etc. We said that is a scenario that we cannot tolerate. But for us to address that was not to exclude the pandemics, but for us to exclude the countries or define the narrower set of countries where even if all those 45 countries that I said simultaneously exercise CRDC, what we know is that our balance sheet can accommodate it. So for us, managing that was containing CRDCs to the countries where we know that there will be the biggest impact for them and the least impact on our balance sheet.
So thank you. And now I pose this question, so as you already spoke again, and I think to Dimitri or to Victoria, and Naomi Chomet from FCDO. So it says on the 5 basic points charged by some MDBs, while this is indeed very small, it might still act as a deferment for some client. Is this fee necessary? So I'm posing to you because I will be pleased to hear everyone's a little bit, and also as we're already approaching the end, so kind of a final statement from your side. Thank you.
Yeah, thank you. Well, since EBRD, since EBRD plans to charge this fee, so I guess we'll have to address it. So, as I mentioned previously, so we are considering this as an option, which we're offering the tool itself. So, therefore, for us, having as this being non-free option has to carry a fee because also there is some admin fee for us. So the client has also to understand that they need to be aware of the kind of implications. They need to weigh the pros and cons of using it, triggering it, comparing to the returns they're getting, and then make an informed decision on whether to use it or not. And therefore, it has to be there has to be an incentive for the client to consider using. So therefore, that's the way we've been looking at it, I guess.
On our side, on the EIB side, the point of an option is an important element, and the point of incurring certain administrative costs, this is what this marginal cost reflects. Having said that, as part of the all of the discussions that we are having now, of the panel before and of the whole day forward, ultimately the goal is to standardize as much as possible so that even this cost can go down, because ultimately something that it becomes an off-the-shelf type of offering can mean less cost. So what I want to say is that yes, there is a lot of value in what you're trying to do, Marta, and Spain, because it would actually result in the MDBs finding more efficient ways of working together, and this would be reflected towards the saving for the clients and the borrowers.
So Mahmoud, do you want to add something on that, or Ramon on the fees that how you have been approaching that for the World Bank?
Yeah, effectively it's a cost-free to our borrowers. We don't say it as such, but there is a fee. However, the fee we expect donors to cover. I don't know if there is any UK delegate here, but we already UK. We already got some generous support from UK put into a trust fund that is covering the cost. And the reason for that is, although we believe the cost needs to be covered, but we also heard concerns from our borrowers that the fee was a deterrent for them, and we did not want it because we believe in adding the CRDCs. So even if UK were not to come, let me be very direct. Would we still offer the CRDC? Yes. There would be a scenario where we would get no fee, but we would still be offering it. It's effectively cost-free to the borrowers.
So Ramon, anything to add to that? Or just let's do it very quick. Let's try to make, we are turning 4 minutes beyond what we expected, but I think we can take it. 1 minute last statement. What do you like to give us a key message from this event, today's event?
I think the key for me is that every support that we can get from our partners is always welcome, because as was mentioned before, everything that we can do it cheaper for the borrowers that really need it would be much appreciated by the institutions and also by the borrowers who are the ones that are suffering the consequences.
Thank you. Mahmoud, last statement, just less than a minute.
CRDC is part of a bigger puzzle. We believe in it, we advocate for it, we did lots of good work, we are content with what we do, but it is not a solution for the bigger problem that we are looking into. Countries need to look into bigger toolkits, plus they need to have emergency plans in advance and probably focus on building resilient economies and infrastructures included. It's a good product, but part of a solution, not the solution in itself.
Dimitri? Something to add?
Yeah, I guess I would just echo what Mahmoud was saying. Essentially, this is a bespoke tool which is to be used in specific circumstances. It doesn't fit all circumstances, as we're also seeing in the case of EBRD with our private sector focused approach. But definitely, this is still, I think, an emerging tool that still needs work and then coordination of all the stakeholders. And I think these forums, like you're organizing, is very helpful in this regard.
Victoria?
I think my main sort of plea is that this product, indeed, it's not the the solution to all the problems, but it is let's say an instrument where countries, MDBs, private sector, so across the different layers of the capital stack, can work together towards a solution that would improve the way of working, and it's and could ultimately mean a better, greater impact for the countries. Not the whole solution, but an important step toward that.
So Harold, finalize.
Yeah, just to reinforce that you use all the tools in your toolkit. CRDC is available, put it in your toolkit. Obviously, the impact of a disaster outweighs any liquidity that you'll get, but at least it will help you.
So thank you. I like that sentence. Put it in your toolkit. I will keep it as a message for our marketing. So thank you to all of you. I think a big applause for our panel, amazing panel today. Thank you.
So my name is Isabelle Braley-Cartillier. I work for the IDB, and we are just before the early lunch from Spain. I think only Mexico is worse than Spain for lunchtime. So we're going to try keep you entertained. We're going to do some storytelling, because the focus of this panel is case studies, right? So the idea is to tell you each stories and then try to take some lessons from those stories to move towards the scaling up of the clauses. So we have gathered a panel that I think will be able to tell stories from a very different angle. I will briefly introduce them to you. Sebastian Espinosa is a managing director at White Oak Advisory. More than 25 years experience advising governments around the world on complex financial matters. I think I've listed more than 9 countries, but I'm sure there are more than that. He's been working on the clauses. He's been working on debt swaps. He's working on transparency in lending, et cetera, and he serves on the G7 private sector working group. Then Catherine Gibson serves as a financial advisor for capital markets, commercial banking, and tax exchange implementation at the Ministry of Finance in the Bahamas in January 2015. Currently, her focus is on central government, external and local financing, and she's been very involved in the clauses, so she will tell the Bahamas experience. Deborah is a partner at Clifford Chance when she leads the sovereign debt advisory and restructuring practice. She specializes in sovereign debt restructuring, sovereign debt financing for all types, really. She regularly advises in the policy space, supporting market innovation as climate resilient debt clauses. Shakira is the head of evidence at the, I love the title, at the Center for Disaster Protection. She's a recognized expert in development and public finance. She's specializing in public debt management and disaster risk finance. And Kelsa Canterbury from the Ministry of Finance and Economic Affairs of Barbados. She's built a robust career in public financial management since joining the ministry in 2011. And she's responsible now for ensuring the consistency of fiscal forecast, analyzing fiscal outcome against policy targets. And she's working a lot on climate risk too. So I'm going to start with my first round of questions. And Sebastian, you're the oldest. No, not the oldest, but you're the oldest in the world of clauses. So I'd like to start with you. You worked on the first one, the Granada one. So I'd like you to share the story of the clauses as you've seen it, from Granada to the last one. And I would like you to explain the evolution you've seen in the structuring of those clauses, in the use of those clauses too.
Thanks, Isabel. Good afternoon, everyone. Absolutely be happy to do that. Really just to give you a bit of a sense of the story of pause clauses really from ground zero, and primarily as insofar as they relate to commercial debt. In essence, I'm a debt restructuring banker, and in fact, pause clauses did originate in a restructuring context. So take it back to 2013, 2014. Grenada was in a very difficult situation, having complex debt restructuring negotiations with its creditors following a default in 2013. In fact, it was the second time Grenada was restructuring in a relatively brief period of time. Hurricane Ivan hit the country in 2004, a devastating hurricane, which left the country unable to pay its debts. It then implemented a very light restructuring, which really didn't hold. So fast forward 10 years, it was faced with the need to restructure again. And the principal secretary at the time, a gentleman called Timothy Antoine, who's now the governor of the East Caribbean Central Bank, said to us as his advisors that he knew that it was only a matter of time before another natural disaster would hit Grenada, and he would love to find a way to make it less likely that would lead to default again, into an inability to pay debt. And I think that's quite interesting, because it just reminds us that the origin of these clauses and the spirit is not an attempt by sovereigns to find ways to defer payments or pay less for the sake of it, but really because they actually want to avoid restructurings, which tend to be very costly, not just for creditors, but also for lenders. So together with the country's legal advisors at the time, we came up with really what became the world's first pause clause, which really is pretty similar to the one that is being used today. It was interesting now, first of all, put into a restructuring agreement with the Export-Import Bank of Taiwan. They immediately saw the benefit of it for themselves as well as for Grenada, and agreed to it very quickly. Then it was inserted into the discussions with bondholders, both external and regional. The discussion there was a little bit more difficult. Some bondholders were instinctively saw it as another ask that Grenada was making. Some tried to value it. But eventually, the country won the day. In the context of a negotiation, the clauses were included. I think Elliot this morning mentioned the Paris Club. The last stage of Grenada's restructuring was a Paris Club negotiation, and there was a soft pause clause that was inserted in the agreed minutes, meaning that there's no automaticity to it, but it was still certainly a step in the right direction. Then when Barbados came to restructure its own debt in 2018, 2020, again following a major BOP crisis, we were advising the authorities there. The Prime Minister Mia Mottley was aware of Grenada's innovations, was very keen to follow suit. The request for a pause clause was again included in the negotiations with bondholders. Most of Barbados' debt is commercial. Roughly $6 billion worth of debt was restructured. Broadly speaking, 2/3 domestic, 1/3 external. And in the end, pause clauses were included in pretty much the entirety of the country's debts. First time they've been used in a domestic debt situation. There were some differences with the Grenada version. I think the deferral period went from 1 year to 2 years. And importantly, in the Barbados version, in the case of the Eurobonds that came out of the restructuring, a majority of bondholders, meaning 50+1, can instruct the trustee to block the activation of the clause if they, for whatever reason, feel that it's being misused. And it was just something that the country had to give in the context of a negotiation, but it felt it was actually not necessarily a bad thing to be giving away. So I think now that made Barbados, and I'll let obviously my friend Kelsa here talk about this more in a minute, became the first country really to have pause clauses pretty much in the entirety of its debt stock, and certainly it's now made changes so that any future borrowing that takes place will have pause clauses in it as a matter of policy. Now, fast forward to 2023, Barbados executed its first debt swap, which was focused on freeing up resources to fund marine conservation. As part of that debt swap, financing was raised from private sector sources, mainly in the form of private placements. And Barbados used that opportunity to insert pause clauses in those new debt contracts, as well as pandemic clauses. In fact, the first such use of pandemic clauses. But really, this became the first the first time pause clauses were being used in commercial debt instruments outside a restructuring context, in a primary market issuance. Admittedly, there weren't Eurobond issuances, there were private placements, relatively small in size, but it still marked a very important moment in the development of pause clauses. Barbados executed a second debt swap last November. First debt swap to move beyond conservation is actually going to fund the climate resilient infrastructure. And again, pause clauses were inserted in the end pandemic clauses in all financing contracts. One thing which I'll point out here, which is interesting, is important to flag, is that when the country began the process of arranging the financing, RFPs went out to pretty much all investment banks, all the bulge bracket banks, asking them to make proposals. And the country in that RFP made it very clear that all financing to be agreed to would have to carry both pause clauses and pandemic clauses. And not once was there any form of complaint or concern, and certainly no indication there was any impact on pricing. So I think that's pretty important to keep in mind. And certainly when the country eventually returns to the Eurobond markets, it will be inserting pause clauses in the bond indentures. I think the last point that I'll mention in the story of CRDCs is really the Grenada triggering of the pause clause, which took place last summer after the devastation caused by Hurricane Beryl, which our friend from St. Vincent and Grenadines has already talked about. In the case of Grenada, the hurricane caused damage of almost 17% of GDP, so it's extensive. And the parametric insurance under CRIF, which is the regional insurance facility which serves as a trigger for both the Grenada and the Barbados clauses, all the triggers were met, and the country quickly moved to activate the clauses both for its US dollar bonds as well as its Eastern Caribbean dollar bonds. They both had different mechanisms for activation, and which means that the country is now enjoying, benefiting from 12 months worth of deferrals, which obviously have been critical in helping the government to direct much needed resources to the reconstruction, in particular the two outer islands that were badly hit by the hurricane. Shortly after the activation, calls were held with investors just to talk them through the process, the implications. We can bear in mind that this is the first ever activation of a pause clause in a commercial debt instrument. And the call was very well attended. And the response unanimously was positive. Every single bondholder, including US-based bondholders that were on the call, expressed approval and support for the government's decision to activate the clause. And I think there's also a fair degree of relief because many of them would have taken the view that had that clause not been there, they could well have been looking at potentially at a default situation or a restructuring, which certainly would have been more costly to them than a short-term deferral of specific maturities. So I'll stop there for now, let others speak, and I'm happy to answer any questions later on.
Perfect storytelling. Thank you so much. I'm going to move to Kelsa. So you've worked on all the Barbados cases, right? But from different angles. First you were in DMO, and then now you're looking at it from the fiscal policy angle. You're working on the climate risk management from the country, right? Mm-hmm. On a holistic way. Can you give us your version of the Barbados story with the clauses? How the political signal has been so important, not only for you, but for everywhere, mm-hmm. I think. And how you've now embedded the clauses in the law. Can you tell the story?
Sure. Thank you first for the organizers for inviting us to be part of this event. As mentioned, I'm a fiscal policy analyst in the Ministry of Finance in Barbados. I was actually part of the debt management team working with Sebastian when Barbados first introduced the debt clauses, and now I'm on the fiscal team where climate resilience and adaptation is central to our policy design. So I've had the privilege of seeing from concept, the evolution from concept to having them embedded in our fiscal framework. So back in 2018, Barbados really was facing, as Sebastian said, a debt crisis. And at the same time, we were, and we still are, at the front line of climate change. So, you know, the Caribbean is extremely vulnerable to natural disasters. So the thought process was, the realization was that Barbados needed a way to safeguard the economy without defaulting on its obligations. So it was determined under the leadership of Prime Minister Motley that we would build resilience into our debt framework. And the natural disaster clauses, these are how they came about. So we incorporated across, as Sebastian had said, the majority of our debt had this natural disaster clause incorporated into it. So it is a 2-year deferral. Interest is capitalized. There's a limit to how many times we can defer. I think it's 3. And Sebastian would have spoke about the veto that bondholders can use. But we didn't stop there. After we incorporated it across our debt, we institutionalized it. So Barbados passed legislation to embed these clauses in all new debt issuances, both domestic and external. So we also extended the trigger to include pandemics. But these clauses are now a standard feature in our fiscal architecture. This is just what is for us. As Sebastian said, when we send out RFPs, we tell them these clauses are part of the deal. This is it. From a debt management angle, it helped us to manage debt more prudently. From a fiscal policy perspective, it was transformative for us. Not only would it assist in debt sustainability, it was planning certainty because it forms part of our medium-term debt strategy. It's aligned with our overall goal of reducing debt to 60% of GDP by 2035. And it also provided liquidity relief, where now we are able to redirect funds for emergency response and recovery in the event of a natural disaster. And I think an important point too was that it gave us agency, and that we are the persons that decide when they're triggered, when to trigger them. So I think that flexibility is crucial in a crisis for us. The political will, as you were saying, was very instrumental under Prime Minister Motley's leadership. It was very, very instrumental in having these clauses embedded within our debt portfolio. Domestically, I guess it signaled that the government was putting the well-being of the economy and the citizens first. They were prioritizing the well-being of its citizens. Globally, we know Prime Minister Motley, she champions the Bristow Initiative. So she's elevated the climate finance discussion on the global stage. So she practices what she preaches. So coming down, we didn't have, I should say, any resistance somewhat. It wasn't a difficult task for us to have these put in law and legislation for us. Really, in short, I think what Barbados' journey with the debt pause clauses reflects not only the technical innovation, but a national commitment to resilience. From the early stages, from the conceptualization to having them embedded in law, the approach was deliberate and forward-looking. So it wasn't only about managing the risk, it was about empowering the fiscal framework to withstand a shock. It was about protecting its citizens, and it was about maintaining stability, because I think by institutionalizing these clauses, we created a buffer where we can respond swiftly in times of crisis while staying on track and achieving our overall long-term fiscal goals. So it really is a testament to what determined leadership and strategic policy reform can achieve. I think I'll stop there.
That's fascinating. Bahamas is also an amazing example. So, Catherine, you've used the clauses many times now with different stakeholders. Can you tell us the Bahamas journey? Can you tell us also the challenges that you see for a country like Bahamas to scale up the use of those clauses across all your instruments?
Okay. Thank you. And first of all, let me thank you for the invitation to be here. It's definitely a pleasure. I think this is very necessary, and I'm happy to be a part of it. So before I tell you about our journey, I'll tell you a little bit about the geography of the Bahamas. So we have 700 islands and some 2,000 islets or keys, covering 260,000 square kilometers in the West Atlantic. Only 5% of this is land, okay, some 14,000 square kilometers. And to tell you how small it is, I remember some years ago in university in California, very late or very early in the morning, during a study session, there was a young lady who was looking at a map on a wall, and she says, look at these tiny islands off the coast of Florida. Do you think anyone lives there? And of course, she was shocked that I did. Okay? So the Bahamas stretches about 100 kilometers southeast of Florida and to about 80 kilometers northeast of Cuba. So it's a massive area, stretches the length of Cuba, really. And growing up in the Bahamas, most of my life, hurricane warnings basically meant a free day and some extra puddles to play in. And of course, more recently, that's changed. Sorry, and we had our own law around why the Bahamas was going to be protected from hurricanes. We thought the mountains in Cuba and Haiti would protect us, because a lot of times, coming in, they would dissipate over those mountains. But then came 1992, and that was the first hurricane in recent memory that caused extensive damage. And it was on the island of Eleuthera, which is not a major population center, but 250 million in damages, and we were aghast. 4 people died, and we were horrified. But since then, there were more hurricanes, Francis, Jean, and of course the monster Dorian, which you may have heard of, 3.4 billion in damages. And those damages were incurred in the 2 of the northern islands, which are the 2nd and 3rd largest commercial centers of the Bahamas, but still, small compared to New Providence, which is the center. So over the years, we've become more aware of the impact of climate change on the Bahamas. So for us, low-lying islands, the challenge is sea level rise and increased intensity in storms. So it's estimated that by 2050, we will lose 60% of our shorelines, and by 2100, 80% of our land mass. So the government has become more proactive over the years in putting things in place to mitigate against the impact of climate change. Sebastian mentioned CRIF, the parametric insurance for the region. We have pandemic relief, not pandemic relief lines, but disaster relief lines with the IDB and World Bank. There's a government agency that's set up to take care of disaster relief, climate resilience, and then the laws were changed to increase resilience in the built environment, so there's a whole new building code, and then there are exercises like replanting mangroves that would reduce the impact of flooding on our low-lying islands. So we see debt pause clauses as a part of the natural progression in that. This is another way that we can build resilience and recovery, improve recovery in the event of disaster. When we heard of it being included in the Barbados transaction, we began exploring the possibility of including it in some of our transactions. The first of those was an IDB guaranteed bond issuance. And we went to market in June 2022. And we raised the matter with our bankers. And the feedback at the time was, oh, that'll be too expensive and investors won't go for it. So we put it on hold. And over the years, we raised it again. The first time we entered any kind of debt pause clause was with the IDB, and that was around November of 2022. And the triggers were the same as those for the CRIF coverage that we have. We can defer principal payment for 2 years. Interest is paid during that time, and the tenor can't be changed. So increase principal payments over the remaining life. IDB is our largest lender right now, so that has a meaningful impact on our position. So we have that in place with IDB. More recently, we did a debt for nature swap, and we were able to include a natural disaster and pandemic relief clause in that transaction. So it's one of the items in our toolkit. We view it as that in any event. I think, yeah.
Perfect, thank you so much.
Okay.
I'm going to move to Deborah. So you've seen all of them, except maybe Grenada, I don't know. But I think you've seen most of them, but from a very different angle. So you're looking at it from the lens of the bankers. So I'm very interested in hearing your version of the story, and how did you see the evolution from the first you worked on to the last one, from your perspective? How do you see that evolution? And you've heard, the countries' stories. What is it in their story that you think could help you structure the next one?
Thank you. Yes, so we at Clifford Chance advised on the debt for nature swaps that Sebastian and Katie have mentioned, and on the Bahamas debt for nature swap, acting for the underwriters and arranging banks in those transactions. So the first thing I would say is that I'm sure because of the inclusion in the RFP, but the reaction from banks has, in my experience, been positive. We've traveled the journey with Credit Suisse, UBS, SCB, some local Caribbean banks, etc. And banks have questions, but I've never heard someone say this can't be done. So leadership from the top is absolutely essential, both from the country teams, but of course also the financial advisors. And so those financial advisors that are very active in the sovereign debt management space, I think can also play a key role in socializing the work and encouraging their clients to raise this early on in the process. But there are, of course, questions, as I said, that come up. One of them is on NPV implications. And the way we present this work is that it provides liquidity relief. It's not a replacement for debt restructuring in the face of solvency concerns. So to the extent possible, the mechanisms should be MPV neutral. But within that objective, you can still achieve a lot of good, I think, for both parties. So the discussion is typically around whether deferred payments will be recapitalized. And as has been mentioned, I think, on all the panels, that the original maturity date is respected. So if you have an instrument that has a 10-year maturity with a potential 2-year deferral, banks and investors are really looking for the 8-year limit on the trigger of that deferral, which of course is unfortunate if timing-wise that doesn't coincide with the climate event, etc. But I think it's just something that we comes up all the time, and that's the sort of approach at the moment. The other question that comes up is how many times should the triggers be permitted? And this really came into its own actually after COVID-19, because in particular once we started to see the adoption of the pandemic clause, which was published as part of the private sector working group that was done under the aegis of the UK G7 presidency, people would ask, well, what if there's a climate event and then there's a pandemic? How do the two things work together? And so I think that there is an acceptance among banks and investors that a trigger more than once is acceptable, but then that ties in with, well, how long is the deferral? And if you start going down the territory, say, of you can activate the triggers 3 times and have deferrals for 2 years, it starts to move the spectrum away from a solvency, from a liquidity anchored mechanism to a solvency look through. So there's a fine balance to be struck there. So I think, typically we would expect a couple of times as being the level that can be triggered, and maybe for a year or 2, but anything beyond that I think becomes more tricky for people. We touched, I think, already quite a lot on whether principal only is deferred or whether it's principal and interest also. In the context of those discussions, I think in the private sector, interest deferral becomes a little bit difficult sometimes for, say, pension funds that are trying to match their assets and liabilities pursuant to regulatory requirements, and if there's an interest cash flow that could suddenly be interrupted, that will raise some questions. I don't think it's unsurmountable, and I think what's interesting is now that we're seeing sustainability-linked bonds with different cash flows depending on step-ups and step-downs. I think there'll be a discussion to be had as to how to move, along with the times. But certainly the bank space, we've done some work on bank regulatory implications of having these deferrals, and as long as you maintain the MPV neutrality approach, I think it'll be possible to get there and for the mechanisms to be neutral from that perspective. The other thing that comes up is, are the triggers verifiable, independent, not subject to manipulation? So there has been, in live deals, focus on what the triggers are anchored to, so whether it's CRIF, whether it's the World Health Organization, whether it's a look through to MDB triggers, etc. And I think that will continue to be a point of discussion. What certifications does the country have to give, and what third-party evidence supports that? I think mention has been made by Sebastian and others about blocking rights. That's something that has come up a lot. underwriters and commercial banks are willing to contemplate this, but there's still a little bit of nervousness, particularly if you're an underwriter, you're not really putting your own commercial interests into the pot. You're doing it on behalf of investors. And so banks get comfort from knowing that there is a mechanism which, if there was a concern around the implementation or activation of the triggers, could lead to blocking it. But the voting requirements relating to those blocking rights have been 50% plus, which in the bond world is relatively high. For more than 50% of the holders of more than 50% of the bonds to come together and block something is something that requires a fair degree of proactiveness among investors. So it's something that I think is balanced in the right place. One final point I would make is CRDCs, especially if they're focused on deferral of principal, are going to be more powerful in the loan space because loans often have amortizing features. If you're a country issuing a bond with a bullet repayment or a soft bullet, actually your gain from being able to defer principal is really much reduced, while in the loan space you can make greater use of that mechanism because it's much more common to have amortizing principal payments. I think rating agencies are, the implications of having these triggers and their activation for rating agency analysis are very important. And in the context of bonds, whether it will in any way limit inclusion in sort of the JP Morgan index and so on. But I think we have panels on those topics later, so I'm really looking forward to those.
Yeah, we're waiting for the panel on CRAS. I don't know where you are in the room, but yeah, everybody is waiting for that. But I think your intervention shows how much work is being put in the structuring of those clauses. So we've come such a long way, right? Shakira, I'm going to finish with you. You're the head of evidence, right? So from a research perspective, you've been looking at the impact of those clauses and the benefits for the countries, right? Can you tell us about your findings, maybe taking the example of how they were used for Hurricane Beryl, which is one of the bad ones. Tell us a little bit the findings of your work on that particular one, please.
Sure, Isabel. I'm really happy to be here today and part of this panel. For most of my professional career, about 15 years now, I've either worked in two topics, public debt or disaster risk. And I think it's maybe because I'm Caribbean, so it's in my blood, basically, those two things. And since I joined the Center for Disaster Protection, I've been increasingly working at the intersection of both debt and disaster risk. And we've been very much involved in advising the UK government on how they operationalize these clauses, and I'm also part of the CRDC working group. So back to your question.
Do you want to put your slides?
Oh, yeah, sorry. Yeah. I don't need it right now, but maybe, how do I?
Just make sure it works.
Right. So back to your question. When Beryl was approaching the Caribbean last summer, I did two things. First, I called my family and friends. I have family and friends in St. Vincent, and I have family and friends in Trinidad. I was like, are you guys ready if something really bad happens? Yeah? Okay. Put the phone down. The second thing I did, quickly just reminding myself which instruments the countries had, because then I'll have an idea of how prepared they possibly are for the worst. The reality in trigger-based financing, in pre-arranged financing, you only really know if things work when something horrible happens, and you hope it works, right? So I was interested in two instruments, the debt pause clauses, because of course Grenada had it, and they hadn't used it since they first adopted it. And also, while Beryl was approaching, the World Bank worked tirelessly with government officials in 6 Caribbean countries to get them into their debt contracts before Beryl made landfall. I was a bit confused that they did it while Beryl was approaching, and that's a question I have for the credit rating agencies, because I thought it had to be before, but yeah, that's separate. So 6 countries had it from the World Bank, and Grenada had it. The next instrument I was interested in was the cat bond. Jamaica is the only small island state to have sponsored a cat bond. It's the second cat bond they've had. They paid for most of the premium. It was 60% more expensive than the first purchase that donors paid for. So I was really interested in what was going to happen. So what happened? Two countries successfully triggered their debt pause clauses from two different types of creditors. Grenada from its bondholders, I think it was 12.5 million, Sebastian, and St. Vincent from World Bank. And I think Harold, it was around 3 million US. So that's good. Jamaica cat bond didn't trigger, but it came really close. At the same time, I don't think it not triggering was a sign of failure, but I want to talk about it a bit because it has some important lessons for CRDCs. So a key lesson from St. Vincent and Grenada was the importance of having these clauses as part of a broader risk layering strategy that combined different instruments. In neither of these cases were the pause clauses the only instruments. And from this slide, I put the main DRF instruments both governments had. The very light gray, that's the payouts, well, sorry, the deferral from the pause clauses. The blue in the St. Vincent case, they had I love this, they had a very well-capitalized national contingency disaster fund. I see Harold, but it was majority of the DRF instruments, right? And it was about 18.5 million, just remember, 3 million was the deferral from the World Bank. And they got a very small payout from CRIF, only 1.8 million. So every little bit helps. I'm not trying to minimize the debt pause, but I'm just saying the combination of instruments was really vital for St. Vincent. They didn't have a contingent loan from the IDB and World Bank at that time, and I was disappointed about that because, sorry Harold, I'm very blunt. They got it in 2025 and he used it for the volcano in 2021, right? But it wasn't renewed until 2025. Yes, one is there and it's 20 million and it's an IDA loan, so it's very, very cheap compared to other instruments. And in the case of Grenada, they got a huge payout from CRIF, 44 million US, and that's shown by the yellow. And as I said, the debt pause is the gray, and then they also got a CAT DDO loan, a payout of 20 million. So it's really important that when we're talking about CRDCs for financing disaster response and recovery, that we really consider the ecosystem. One instrument is, first of all, don't put all your eggs in one basket, right? And really, like the CRDCs are for most likely are going to be for low frequency, high severity impacts. That's how the World Bank and the IDB talk about it. That may change over time, I'm not sure, but it's really, to me, I see it like an oxygen mask in an airplane. I hope all the years I fly, I never have to use it, but if it's there, I want it to be there. So what I'm trying to say is that when I advise countries on which instruments they have at their potentially that they could use, I don't start, you need to have this instrument. I think, what is the purpose you're trying to achieve? What are the potential instruments you could use? And what's the most cost-effective and effective way for you to close your production gap? That's the technical. There's also the political stuff, but I won't talk about that now. There are some red flags that currently may prevent me from advising a country to do a CRDC. Just a very simple one is that how none of your main creditors are offering it. So, don't go after the very small ones. Like, I used to work in debt recording and reporting. It's very hard to update your debt records and talk to budget department and make sure the deferred payment is included in the next budget cycle for 2 years. So I'm like, know the costs and benefits, basically, right? As I said, the reality is the clause will be more valuable for some countries than others, and in most cases, it won't be enough. So the second point I want to note is, what can we learn from Grenada? A lot of people ask me, Shakira, did it get downgraded by the credit rating agencies? Did the cost of borrowing increase? And I was like, I don't know, because Grenada hasn't been rated by a credit rating agency since 2017. They actually, I think S&P did it, and then they withdrew it in 2017. Also, Grenada hasn't gone back to the international capital market since it restructured its bonds. So I really can't, the sample size of evidence is, as I said, I'm having evidence, like I can't say based empirically what has happened. And that uncertainty is, of course, a deterrent to other governments to go along this path. So that's but we, it's evidence will gradually build up. But I just wanted to flag that it is a deterrent. The last point I want to make is Jamaica, because they didn't have a debt pause clause. It has one of the most sophisticated DRR strategies in the Caribbean. And I wanted to highlight it because it didn't trigger, and because of that, it got a lot of bad publicity. It was a near miss. But it was, if the storm track, if it was 15 kilometers further north, or if the reported central pressure was 10 millibars lower, the attachment threshold would have been met, and they would have gotten a payout of 45 million. Personally, I don't think it was the trigger. They did a bad job in the trigger. These cat bonds, given this is the top layer of that risk layering diagram that I think Ramon probably showed earlier. But these are instruments with investors who want, it's not for profit, right? They want a return, right? And basically, the level of attachment determines the price that you pay for that protection. And that cat bond was for protection for a 1 in 42 event, based on the magnitude of barrel, but that's like probably a 1 in 5 event. So I do not personally, this is my personal opinion, it wasn't designed to trigger for that. But as I said, it got a lot of bad publicity, and that's something that trigger-based mechanisms need to, the providers need to recognize that there's that reputational risk. And the nuances of the cost and benefits, you have to be careful of managing that public relations, I guess. And I'll stop there.
No, thank you very much. I think we've heard that many times. CRDCs are only one tool in the toolbox, and then you need them to be, spread among, many of your debtors if you want them to have an impact. So, my second round of question, I'm going to ask the same question to each of you, because we are Road to Seville. I don't know where that is, but it's Road to Seville, and we need some kind of a to-do list or roadmap to how we get to scale up those instruments, like for real, right? So my question is to each of you. So to truly advance the scaling up of the use of suspension clauses, can you give me one small, easy action that could be done, like an easy win, a low-hanging fruit that could help, and then something more, more challenging task that, while it's difficult, it would have a significant impact. So feel free to agree with each other, because we need, at the end, a small to-do list, right? But yes, one small thing and one more challenging thing that would have a lot of impact. I'm going to start with Catherine.
Okay, sure. I think a part of the challenge with CRDCs, the reason why some countries don't press for them, is that the first ones were done in the context of restructuring. So people may have concerns about reputational risk if they go to their lenders and say, we want this thing that people that are in restructuring are using. So it may be that reputational element. So I think what we need to do to address that is really to expand the discussion to include everyone that could be a part of this market. So bond investors, banks, the official creditors, Ex-Im banks, the rating agencies, for sure. So just expanding the discussion. And I think as borrowers, for sovereigns, we always have so much going on and not enough resources to do the things that we really need to do that have to be done now. So we may not press so much on things that are nice to have, as opposed to those things that you absolutely have to do right now. So I think we need to be more focused in our effort to address this and make it more available. Yeah. And in terms of more difficult, I kind of think like this seems to be something that insurance companies could be brought into. Now I know they have probably way more than enough of their exposure to natural disasters, but I think there may be room for them or some role that they could play in this space.
Yeah, going beyond the clauses, yeah.
Yeah.
Thank you. Sebastian?
I'll give a couple of things to come to mind, both of which probably on the surface may be relatively easy to do, but probably deep down are quite difficult. But I think we all agree that probably the next frontier is trying to get these mechanisms into Eurobond market issuances. That's kind of really the next frontier. First of all, and I know this won't go down too with some in the room, but I think please try and avoid making the pause clause into a product, because obviously products attract fees, costs, and I think invariably that will put off their wide-scale uptake by those countries that need them most. I think we just have to remember the kind of the origins of pause clauses is that these features tend to benefit both creditors and borrowers alike. I do accept that when it comes to MDBs, the cost-benefit analysis is different because as a multilateral, as a preferred creditor, you don't expect to be asked to restructure your debts. But I think certainly in the case of commercial lenders, these pause clauses should, if designed well, make it less likely you'll be facing a costly restructuring, which will involve potentially big PV losses. And I think the moment we make them into products that attract fees, you start wading into the realm of insurance, as Catherine mentioned, and I just do think that the uptick there will be limited. And it'll raise questions of, why, if you're a small, vulnerable country, the front line of climate change, why should we be paying to protect ourselves from climate change, which really hasn't been caused by us? And this, is a powerful position to take. So I think we just have to be mindful of that. Secondly, I think I'm a bit old-fashioned in thinking that, really, do you change things by doing? So I think earlier this morning, as a couple of people mentioned the first mover problem. That's really, in essence, what we are facing. When Barbados does come back to market outside a debt swap, it will be including natural pause clauses in its bonds. But I think we obviously need a far greater momentum. And I would have thought that the way to do it is to really, probably for the official sector, the IMF, to encourage some of the obvious candidates to look quite seriously at including pause clauses in future bond issuances. If need be, you can create a consortium of pilot countries to do that. They'll commit to doing that. And there are also some parallels if you go back more than 20 years ago when there was a push within the international financial community to include collective action, to introduce collective action clauses into bond contracts. There's a lot of nervousness amongst potential issuers, worries about impact on pricing and so on. And eventually, the US Treasury and the IMF lent quite heavily on the Mexicans, and off they went and issued their first bond with a CAC. Very little of any discernible impact on pricing. And 20 years on, it's rare to see a bond now going out without a collective action clause. So I think it's some of the same kind of dynamics we need to employ, and similar sort of problems that we need to emerge. But I think it is just by just finding a group of countries that commit to doing this in the foreseeable, as soon as in the near term. I'll stop there.
Thanks so much. Shakira, what's your wish list?
Oh, so in terms of
just two things. Huh?
Yeah, sure. Immediate changes. I think there needs to be more guidelines and principles for the effective design and implementation of these clauses. We heard a bit from the earlier panel about the MDBs and the official bilateral creditors, and I do sometimes, sitting there, I get a bit confused because each actor is different and they have different considerations to take into account when they design these clauses. So, but in general, what is it that we're all adhering to, because this is what we want the pause clauses to be used for? And when I say guidelines and principles, I don't mean specifically in terms of whether it's principal or interest and whether there's the length of this deferral. I think it's like, what information should you be giving to sovereigns so that they can make informed decisions? What information should you be publishing so there's wider accountability to the public? How do you ensure the pause clauses are complementing other existing DRF instruments as part of a risk layering strategy? How do you ensure that it doesn't undermine debt management, debt sustainability? And I think Harold spoke about how important that was. I did a lot of debt, debt recording. It is an exhausting process, but it's sometimes forgotten. But obviously, if your debt records aren't correct, then all your analysis will be flawed. So really, like, how do we ensure that debt management practices are being improved to that we could ensure that we're using debt pause clauses responsibly? Good practices and trigger design. A lot of countries actually don't have full access to their parametric models from the regional risk pools. So if an instrument doesn't trigger, a lot of times they don't really understand why. And to me, like, if we could get those things more transparent. So that's, guidelines and principles. And the final thing, the big change is we currently live in a system where being proactive is sometimes punished. Or there's a perception that it's punished, and it doesn't really reward good behavior. So that, that being proactive isn't seen as a sign of vulnerability and isn't punished with higher borrowing costs and downgrades. I think right now pause clauses are being seen as a small island development states thing, which means vulnerability, which means if I am Mexico and I take this, am I flagging that I'm being vulnerable? So just making sure we're getting the optics and perceptions right.
Thank you very much. Deborah, from the banker side, what do you think would be an easy thing to work on and a more difficult?
Well, I think, going back to the point about RFPs and sovereigns and financial advisors, including, these mechanisms as a must for the proposed transaction is a low-hanging fruit that can deliver, quite quickly very positive results. I think actually extending the work of my fellow panelists this morning to the rest of the G7 and G20 is quite important, because it's quite difficult to ask the private sector to come on board to this initiative if there isn't more developed countries' sort of uptake of the protection mechanism itself. A difficult challenge, but I think one we can all rise to, is moving away from the Caribbean Catastrophe Risk Facility and moving away from anchors that are maybe purely regional. We need this work to move into Africa, into Asia, into small island nations that are not in the Caribbean. And at the moment, all of the precedents we have are anchored on CRIF. We moved the dial a little bit by having the pandemic triggers linked to the work of the World Health Organization. But we need to, I think, be more ambitious. And I think, this is one of the key objectives of the London Coalition. I think we're going to hear more about their work later in some of the panels to come, but a bondholder working group has been set up to look at how the existing work could be established to not just be region-based, but to be, applicable for any country that is eligible for these protective mechanisms, even outside of the Caribbean. And I think the engagement that we're going to have with some of their thinking over the next few months, which will also build on the G7 private sector working group, is going to be a game changer. Because I think if we can get the bondholder community sort of really taking ownership from their perspective of what they can contribute and how, and to do that in tandem with positive rating agency inputs, then that will really open this protection mechanism far more broadly.
Thank you very much. I think G20, G7, they all are pushing the topics to what I see from requests on presentations and talking points, and so that's a good signal. But yeah, I think it's crucial. Finishing with Kelsa, so Barbados, you've been very good at saying what you needed. What would be your advice to the global community on how to push for the use of those clauses?
Well, I think I agree with both Catherine and Deborah. It's expanded discussion. Some persons, obviously, as the reputational risk, the perception that is out there that it is a form of debt restructuring, and they don't really want that to be perceived as the country is going through that. But I think expanding the discussion helps that, as well as just requesting it in the RFP. It's a contractual, tell them that this clause is going to be embedded. I think that that is a low-hanging fruit. Just tell them this is what is going to be part of the issuance. And which may be a bit more complex is to institutionalize it. I've heard panelists earlier say standardize it. It needs to be standardized throughout. And it makes it easier. There's a precedent. It is what it is. You may need it may be a bit more complex because you need the political buy-in and the drive, because you need parliamentary approval and stuff. But I think that after you've passed that stage, then it's smooth sailing,
We're going to finish with smooth sailing. Thank you very much. I thought we would have time for Q&A. We don't, because it's lunchtime. So please send your questions through the app, and so we'll make sure that your question get answered. Thank you very much. Thank you to the 5 of you. It was really interesting.
Thank you very much for this after-lunch panel. Always difficult to bring people back in the room, but the panelists were very eager, which is a very good sign. So they're ready to share their views. This panel, we have the pleasure of having the credit rating agencies. It's crucial to have credit rating agencies on board. It's really their leadership as well that can bring to having more buy-in by other stakeholders, like the private sector investors. It's also crucial to have the leadership of, for example, the financial advisors. I will introduce soon the panel. So we are really trying to get all of the stakeholders together to be propositive and find solutions that can push this agenda forward. So let me introduce to you my panelists today. Let's start from Marisol. Marisol Blasquez is an analyst in the sovereign and sub-sovereign team at Moody's Investor Services based in Madrid. We have Lapo. Lapo Guadagnolo is a managing director at S&P Global Ratings. Eric. In the middle, Eric is a partner and executive chairman at the Sovereign Advisory at Rothschild & Co. Then we have Aureliano Fernandez. Aureliano should have been in the MDB panel maybe because he represents one of the MDBs, in particular the Development Bank of Latin America and the Caribbean. But it is great to have him here, so we have a multi-stakeholder panel. It's great to see how the different actors actually interact and engage with each other. And finally, we have Carlos Masip from Fitch Ratings. Carlos is Senior Director in the Global Sovereign and Supranational. Now, we have some slides. I think the 3 credit rating agencies will give a little introduction of how they treat debt or sovereign debt when there are CRDCs. And then we are going to kick off with some questions, and then hear from Aureliano about the new suite of solutions that include pause clauses in that. Marisol, maybe I will start with you, if you would like.
Thank you, Barbara, and thank you. Can you hear me? Yes. And thank you to the organization for inviting Moody's. So we have a presentation. I don't know where is it, but here. Okay. So, what's Moody's view? So, Moody's views of the inclusion of climate resilient debt clauses as a positive feature for borrowing countries, as they provide liquidity relief and protect the borrowing country during severe climate events. So, they allow the borrowing countries to pause debt payments for an agreed period after a natural disaster and avoid liquidity issues and focus on recovery efforts. So, but there are several elements to take into consideration to assess the impact of these clauses on the credit profile of the issuer. To have a real impact on the issuer's credit profile, instruments with such clauses will have to represent a significant portion of the government's debt, or to cover a large amount of payments due, or offer material protection, for instance, through a wide range of disasters coverage and relatively low limits for activation. So on the other hand, we will also analyze whether the inclusion of these clauses and ultimately triggering them will affect other parts of the issuer's credit profile, including by limiting growth volatility, given that the government resources will be more focused on available resources for reconstruction. Another important element is to rate sovereign bonds with these clauses. Clear definitions and specifications in the documentations are essential. This should include, first, the verifiable events that trigger a payment suspension. We typically will want to have an external reputable party confirm that the trigger has been met. This should not be in the hands of the sovereign. Another important element is the terms of payment deferral, typically between 1 and 2 years. And also something very important for us is that the payment deferral is neutral in net present value terms, as the principal repayments will increase after the pause period, maintaining the loan's average life unchanged. To be clear, clear contractual definitions are essential to avoid defaults. So this ensures that the activation of these clauses is not considered a default, given that the repayments continues after the temporary pause. As such, we see these clauses are very different compared to debt for nature or debt for climate swaps, as they typically are considered a distress exchange. So such swaps involve undertaking outside the original contractual arrangement and involve ex-post changes to the original terms of a bond contract. So typically resulting in financial losses for creditors and are treated as an event of default. So in summary, what is important to highlight here is that if the clauses and the exact triggers are not part of the original bond contract, we will probably consider payment deferral as a default. But this is something that we need to analyze in depth. And finally, well, this morning we have heard many countries that have included these clauses in their debt instruments. So the first entity that we rated with including these clauses was Barbados. But there are others also now included that have included these clauses, which are Bahamas, Grenada, and Belize, for example. We have already heard this morning that the majority of the multilateral development banks have incorporated these clauses. So I just wanted to highlight that we expect these clauses to become more common in countries more vulnerable to physical climate risk, such as small islands or low-income countries in sub-Saharan Africa and South Asia. Just to mention that this is a very recent, these clauses are very recent and are not yet part of our methodology. However, we will probably include it in future updates. And just to finalize, mention that adding these clauses to the sovereign debt could improve financial resilience to the country's credit profile.
Thank you. I really appreciate how you started with the credit positive and how you ended with the improving the credit profile about resilience. So really good starting point. I like the positivity. Maybe we can now switch to LAPO. How does Standard & Poor's treat debt with CRDCs or pause clauses more general?
Keep on going? Okay. Can you hear me? I think so, yeah, good. So first of all, thanks for having me here. I will be brief, I only have one slide. I just wanted to really focus on the key features of this debt when we look at it from S&P point of view. But before I do that, very, very briefly. So we take a lot of importance of what the market developments are. So unfortunately, he said a few times that maybe not here today, but the rating agency tried to block or not to do things for the market that is evolving. I want to assure you, probably my colleagues rating agency will do the same, that we spend a lot of time, absolutely a lot of time, to try to think what is new in the market, how can we change our methodology, criteria, how we see things to accommodate new risk if we believe that that's the right thing to do. So what we did, especially what we did in December 2024, just last year, we changed our rating definition. Just for people that don't know, in S&P at least, but I'm pretty sure that in other agencies as well, we have what we call the criteria body, you know, what we use to rate banks, to rate corporates, to rate sovereigns, everything. And then there is what we call rating definition, which is like a meta criteria, something that sits on top of everything, which basically defines, according to S&P, what is a rating, what is not, what it addresses, what it doesn't address, what are the conditions, the characteristics, right? This is what rating definition is. To change rating definition, it takes quite a lot of thinking. Even from a procedural point of view, it takes a lot. We need to do it through a lot of committees. And that's what we did in December last year. So after discussions with a lot of market participants, we decided that for the sovereign space it was important to define what these clauses are and what we accept. Because let's not forget, temporary absorber of shock is not new in finance, okay? Structured finance has been doing that for the last 20, 25 years. Hybrids are incorporated in banks that have always been there. These are similar things of, you know, temporary shock absorber. The sovereign space is a new thing of allowing an entity not to pay timely. As you know, our rating speaks to timely payment of interest, the ultimate payment of principal. So we felt that it was important to actually state something in the rating definition very clear to the market. So basically what you see in front of you is really the key features, which are not dissimilar to what my colleagues in Moody's said. So first of all, we say they are targeted to what we heard this morning, which are countries, low and middle income countries, especially small under countries, but countries that are exposed to extreme shocks, okay? Typically the ones that are rated low sub-investment grade. Default, so if the clause is triggered, it's not a default. Just want to be clear. Somebody also repeated this word, it's not a default. Now, if then the bond doesn't pay according to its own terms, then it will be a default. Hopefully that's clear. So if the deferral is 2 years and after 2 years the bond hasn't paid, that will become a default. But in and of itself, the deferral clause is not a default, okay? And then we rate that bond, we typically rate that bond at the same level of the rating of the sovereign, which we call it the issuer credit rating, if the conditions you see are met, which is similar to what you've heard this morning in our panel, which is the deferrable of interest and also principal is caused by an extreme shock event, that there is an independent party that determines whether this trigger has been met or not. The interest costs are fully capitalized. So again, as we heard this morning, there is this concept of neutrality to the MPV. And also, the last point is hopefully obvious, we are not in the situations where as these deferral clauses happens, other bonds are in default, because if that's the case, that might bring the entire problem of default for the country into the mix. So I'll just stop here. Hopefully it's clear. So it's not a default if it's done according to the condition. We have seen 2 years. To be perfectly honest, we have agreed on the 2 years because that's what we understand that the market is happy with. And I think it's important also, before I pass to the other panelists, that we as rating agencies, surely S&P, we don't have defined predetermined views except our high-level concepts that we have in our rating definition. We clearly need to listen to the market and what the market wants. Now, in the market of people that invest in sovereign, and I'm talking about sovereign bonds, by the way, it's not bilateral loans. Bilateral loans is a completely different animal. We don't rate bilateral loans historically for obvious reasons, right? Because it's just a contract between two parties. So in bonds, the fact that there is not a timely payment It's new in the sovereign space, okay? So I just want to be very clear, but it's not new in terms of concept from a S&P rating point of view. We do that in structured finance, we do that in hybrids, so on and so forth. But those things bring different things. So they bring in the concept of subordination, right? Which is in low investment grade sovereign or sovereigns in general, the concept of subordination is not really there. So hopefully this will come up clear as we go along in the panel.
Thank you, Lapo. Very clear so far. Carlos.
Oh, sure.
Let's see how Fitch
Thank you very much.
treatment is compared to the others, or differently.
Okay, thank you very much. I'm Carlos Masip. I'm coming from Fitch. I want to walk you through how we look at CRDCs, both in sovereigns and also in supranationals, because it affects both ratings. Obviously, we have a different. Thank you, Lapo, for introducing what our criteria is and how it works. So we have different methodologies to rate sovereigns and to rate supranationals, obviously, because you're different animals, but CRDCs play a role in both of them. But before I do, I wanted to kind of give a bit of context, because CRDCs don't come out of the blue. They come in a context in which, and I'm going to use a word that has been at fashion today, is toolkit. The toolkit available is not always working for emerging markets. It's not always working. So because it is not always working, there are new financial instruments being developed. And similarly, supranational entities, they need to adapt to their new capital adequacy framework. So they are also issuing new type of debt instruments. So in sovereigns, we have seen CRDCs, obviously, but we have also seen debt for nature swaps, or we have seen partially guaranteed bonds, or macro-linked bonds, things that we were not used to see, that were common in other areas, as Lapo was saying, but not necessarily in sovereigns. And similarly, supranationals have started to issue hybrid bonds, or even synthetic securitizations of their portfolio. And what has been Fitch's response to all of this? So we wanted to make sure that we develop a credit view that is of service to the market. Our credit view is ours. People are happy to agree or disagree with our credit view, but at least we want to have that credit view open in the market so everyone can decide if they want to look at our ratings or not. And we see ourselves as a bit of early adopters on these methodologies, on CRDCs, for example. So this is a very brief summary. Don't worry, I'm not going to walk you through our sovereign rating criteria. I wouldn't do that to you at siesta time. But since April 2023, we included in our rating methodology, it's public, you can go and check it, how we look at CRDCs, or we call it deferrable bonds to make it more broad than CRDCs only. And there were two key questions to be answered when we were discussing this internally. And the first one is, and it's been happening today, or we've been talking about it today, and the first one is a deferral an event of default? That was the first question. And the second question, very key, is can that instrument be rated at the same level of the sovereign? So the first question is no, it's not an event of default, as long as that happens within the parameters defined in the documentation. So that's critical for when people ask, is this going to be, how is the market going to look at this? We don't know how the market is going to look at it. We know how we're going to look at it. And that's not an event of default, as long as it's obviously within the parameters defined in the documentation. And the second question is, can it have the same rating, that instrument that is deferrable, as the sovereign? And the answer to that is yes, as long as certain conditions are met. And those conditions are there on the screen. So it needs to be triggered by a predefined set of events. It needs to be NPV neutral. No principal haircut needs to be contemplated. And we even go one step farther, that is, if there is maturity extension, that maturity extension needs to be limited. And the reason why we included this, I think, kind of speaks about how much of an early adopter we are. Because we developed these criteria, we put these criteria out there when some of the working groups that are going on, some of them led by Barbara and others, but previous ones that precede you, the UK G7-led one, didn't even have finalized their criteria to what they wanted to put or what they wanted to recommend to the market. So we had to do all of our analysis without even having in front of us a specific case that we can refer to. So that's why we even kind of analyze those maturity extensions, and that's why it's one of the criteria that we look at when looking if we can rate the instrument at the same level as the sovereign. And supranationals, completely different animal. Obviously, supranationals don't issue bonds with a liquidity or with deferrable clauses because they don't need to. I'm not going to walk you through how we rate supranationals, but you can imagine that of all the things that we look at as supranational, obviously this has to do with what we call a standalone credit profile. So without support, what is the rating of that multilateral development bank? And to do that, we look at two things, for the most part. I'm simplifying. We look at solvency and we look at liquidity. We don't think solvency is affected by CRDCs because basically it doesn't impact the CRDCs when they are triggered. It doesn't affect the preferred creditor status, precisely because it's not an event of default. I'm always talking if that is within the transaction documents. And then it's neutral for capitalization because our expectation is also that it's NPV neutral. So what is, of those two legs, what is the one that is affected, that could potentially be affected? It's liquidity. And I think it was mentioned during the MDB panel. Someone mentioned, okay, what happens if all our loans get deferred at the same time? That would be a liquidity crash for the entity. So what we want is to understand what percentage of the portfolio includes deferrable bonds, what events can happen so they kind of, those deferrable loans trigger their deferability at the same time, what can happen, and what are the liquidity buffers available, how it would affect their liquidity, and if there are any liquidity buffers in place, or if there are going to be new liquidity buffers added through a third-party liquidity line or additional buffers added by the multilateral development bank. And so those are the elements we look at when we look at supranationals. This one we adopted, or we published it in our methodology, again, public in June 2024. So you have it in internet. You can check it if you need. And with this, I think I pause because.
Thank you very much. Let me remind everybody for later, we will have some question time. So if you want to put your questions in the app, I'll be able to read them. So let's move on now to our next panelist. Eric, you have a breadth and depth of knowledge and of experience in deals in sovereign debt. Can you talk to your experience of engaging with the credit rating agencies when working on deals that involve pause clauses or more generally debt contingent to exogenous shocks?
Yeah, thanks, Barbara. I think on stage, I'm living a dream. I'm living a dream to see that the three rating agencies are saying an event of default is not accomplished if there is a deferral or an activation of the CRDC. And that, unless I got it wrong, we can rate the bonds at the same level as the sovereign. Jesus, well, I think we want more of those conferences because the area of contingent debt in the sovereign space, at least, has been booming up. Sometimes, fortunately or unfortunately, mostly in the context of debt restructurings, and getting rating agencies to rate contingent debt instruments has been challenging, let's say. There's been various experiences in 24. 24 was, as you know, the year of complex sovereign debt restructurings. And with Deborah, we've experienced some. So, you know, I'm very, very happy that at least on the CRDC issue, there's no issue anymore. Now, the devil, as always, is in the details, but the methodology, the slides are pretty compelling, pretty convincing, and I think the next step is, wow, more countries should print CRDC or posable bonds. They will get the same rating. they will not be, it will not be tainted too much as being an issue of default. So the next real question will be if the rating is the same for a posable bond versus a non-posable bond, will the pricing in the market be the same for posable versus non-posable? Because credit risk is what, or credit risk differential is what is normally reflected in the price. If there is the same rating, why should there be a price differential? Maybe because of NPV neutrality. But you know, I'm very happy that at least on the credit rating agency side, chapter closed, problem solved.
Amazing.
Amazing.
We are very happy to know. I must say we've been able, I mean, within the London Coalition and the bondholder working group, which we have mentioned throughout the day, the engagement with CRAs has been positive. There's always been openness to talk and to understand. So I must say there are some positive signals, and glad that you all accepted to be here. Just one question. Has anybody got any reaction to what Eric just said about the pricing, about maybe a distortion of the yield curve in case of some bonds having CRDCs and some not having them? Anyone?
Yeah, no, I would just add, probably you were alluding to that. I mean, it's you know, surely credit risk is a big component of any pricing. We're not pricing experts, but we all know there are other things that market participants can price in and out. So I wouldn't necessarily say, I know that's not what you were saying, that they could still be differential for whatever reason. Liquidity reason, or just the perception that...
That's exactly what I wanted to say.
Yes, so liquidity reason, or the perception that somebody else mentioned, I think it was one of the MDBs, and saying if we were to enter into this, those were bilateral loans, I get it, but they were saying that we would want to be the sole lender, because if we are not, we might be perceived to be in a subordination position. Well, if you have that mentality, most probably, if you go in the bond market, you might want to price this differently. So I'm probably going to state the obvious. Pricing could be affected by other considerations.
Good. Then maybe we can move on to Aureliano. You can present how the Development Bank of Latin America and Caribbean is working on new solutions that include pause clauses for the Caribbean countries. So maybe I leave it to you. Thank you.
Thank you. Thank you, Barbara. And thank you, everyone, for giving me the opportunity to present this toolkit for the Caribbean. It was a product, but after listening to Harold and Shakira, now it's the toolkit for the Caribbean. And we call it Fletch Nature. Of course, you can see the image of the beautiful beach that takes you to, to a beautiful place where you have it's a happy place, and even for the country, you can think how can represent the income that they receive only for tourism. No? But when we see the other pictures, it's quite the opposite, right? We know all the negative effects that these disasters have in the specifically for the small island. Just to mention a few: the destruction of infrastructure, loss of life, decline of the economy, the scarcity of food and drinking water, and there is a forced displacement of the population. And at the end, from the development perspective, what usually happens is that they start to cut the investment in social and education programs. So we're going to have, generally, that translates to a financial stress where the countries have lower revenues, but have higher needs, to recover from the disaster. And there is a high probability that the cost of the debt going to increase because the perception of this, the damage that the country going to have after the disaster. So this is the same that all the other NDBs were talking about in the morning, the CRDC, how it's work is to pause the payments for a small period. In our case, we are considering up to 2 years. And we are considering to defer principal amortization, and also as an option, the interest payments. What will be the conditions that have to be met is what everybody has mentioned, the net present value neutrality. So we have to guarantee that there is not going to be any loss after the modification, after the deferral of the payments. And also the average life of the loan must do not suffer any major modification. No? And it's very important to consider as well what Carlos just mentioned about the liquidity, how a specific trigger what's gonna be the new position of the liquidity after the event is called. So that's gonna be the condition that we're gonna have behind the toolkit. Well, the main characteristics, what are the eligible countries are our member countries on the Caribbean. So what is important in that eligibility is that the island of the Caribbean are more frequently impacted by disaster events. Actually, this year, the expectation is that the number of hurricanes going to be above the average. And the impact every year is getting worse. So, and the second reason is even from the liquidity perspective, currently the Caribbean region represent on our loan portfolio less than 1%, and represent like 1%. Sorry, 1% on our liquidity, and 0.5% on the loan portfolio. So it's going to be very easy to handle it, even in the worst scenario where everybody asks for a deferral. The events that we are considering, this can change, but until now, going to be hurricane, pandemics, and floods. As I mentioned, the debt pause is going to be up to 2 years. The triggers, we are considering a combination of parametric triggers that going to be, that can be measured independently, and also proxy triggers like a declaration of emergency from the country as a national emergency. Then we are considering to charge a fee of 5 basis points. Let's say that the other MDBs are in the same range. And this is going to be start to be charging since the activation of the clause, and not until the end of the loan, but little short than that. So, well, the last thing is that the condition that I already explained. So that's the
Thank you.
product.
Let me just ask you a follow-up question related to one of the comments this morning. It was raised how important is that MDBs also offer technical assistance to the countries. Is that something you do?
Definitely, yes. This is just one way to mitigate these events. But we also, of course, this is just a part of other measures that we have great contingency lines, we have technical assistance. But I believe the main message is that CRDCs going to be very effective if the whole industry move on this direction. So you can imagine when we pass a loan to any Caribbean country, it's important, but probably the amount is not going to be so significant against the whole need to recover. But if at the same time there are 6, 7 entities, plus the bonds that they issue contains these clauses, that's going to help a lot to free up some needs in the budget to address to recover the country.
Thank you. We have plenty of questions, so I'll start with a question and then I'll ask you for some actionable actions to move forward on the agenda. Could the CRAs comment on pause clauses that are not tied to climate and disaster, such as epidemic, pandemic, or other related pauses, so the broad trigger? Who wants to have a go?
I can go. We have an example. We say, for example, those linked to climate events, we don't necessarily exclude any. It depends if you think about it from a sovereigns or supranationals. If you think about supranationals and you have like a pandemic event, that would mean a wipeout of their entire cash flows. So I wonder what liquidity measures there will be in place to substitute all those cash flows. So that will require a lot of thinking. We haven't been confronted with that. For a sovereign, we are not in the business of telling anyone what to do. We're happy to analyze whatever products they launch and whatever bonds they launch. We'll look at them at the conditions of that bond, and we would analyze it under our tools. But in principle, we don't have a specific exclusion. What we do, and it's very important, is that it needs to be a set of predefined events, the ones that trigger that. And one of the things we get comfort from is also that it's validated by a third party. So those are two elements. And then talking about contingency bonds, as the colleague was talking before, that the principle is protected, which is one of the key discussions when talking about contingency bonds. But yeah, so the conditions that I went through.
Thank you. Maybe a question for Eric. It's about pricing and secondary markets. You might be more ready to answer that. A secondary market with little or no experience with these new instruments makes pricing forecasting more difficult. Which ways are there to overcome this?
Well, I think take the example of one Caribbean or Central American country which has received insurance payments coming from CRIF. Plenty of them have. Outside of those plenty, only less than 8 which received indemnification from CRIF have bonds outstanding. Some countries, it's very simple. Grenada, Barbados, they have one bond. So there was a question earlier today on the pricing impact, very difficult to measure. Only when the country will issue a new bond will the country be in a position to see what's the price differential. But take other examples. Honduras, they got many payments from CRIF. They have 3 bonds outstanding. Bahamas, they got, as was mentioned by Catherine this morning, they got the big Hurricane Dorian. They got also a significant indemnification. They have 8 bonds outstanding. So the universe of countries which can have an interest in CRDCs, generally, it's countries with a small number of bonds. And that should not be restricted to Caribbean or Latin America. Because if you look at the ICMA 2022 term sheet, it does also include drought. Now, in the Caribbean, you don't hear about drought, but in Africa, you do. So let's take the universe of climate vulnerable countries, either for excess rainfalls or the opposite. Except maybe for 2, 3 countries, the stock of debt and the number of instruments is very limited. So how can you eliminate? Well, it's only by launching an RFP or talking to bond investors. Some my little finger tells me that some investors, when asked what could be the price differential, are tempted to say, well, yeah, it's difficult, but NPV neutrality, it doesn't work. Yes, it does work. The contractual interest is capitalized. Yes, but if there is the need to activate the CRDC, it means there is a distressed situation. So the yields on the bonds will go to the roof. So to have NPV neutrality, I don't want to accept that the interest and the principal maybe will be capitalized at the contractual rate, but at the then prevailing market yield. So NPV neutrality, theoretically, it's very sexy, but it's not something that bond markets like very much when the reference is the contractual rate. So how can you compensate? Well, coming with the emergence of state contingent debt clauses that have boomed in 24, you have also seen the explosion of non-financial clauses. One of the big topic, I think it was organized by the IMF legal department a couple of weeks ago, was around debt transparency. There is a price that the market can ascribe to non-financial clauses. Good governance, under the framework of the IMF governance diagnostic report, was priced 75 bips. With the governance-linked bonds issued by Sri Lanka, better governance was given 75 bips coupon reduction by the market. So the market says, better governance, okay, I lower my bond coupon by 75 bips. If you improve debt transparency, if you improve debt disclosure, I'm pretty convinced that all those non-financial clauses can completely outweigh the ask of any bond investor for the printing of a CRDC. I'm 100% convinced. Big question mark is, who will be the first mover?
Yeah. Thank you. That's very interesting, and we will hear more about that, I think, in follow-up panels by my colleague. There are a few questions about the fees. Basically, can you confirm, this is for the credit rating agencies, can you confirm the fact that MDBs charged for the clause do not have an impact in the way you look at the clauses on the MDB itself? So do CRAs look into these charges with any specific view? The charges that the MDB charge to the borrowers?
I think the first thing to clarify there is, because of the things I've been hearing, so we, at Fitch, but I think our colleagues neither, we don't require anything. We just look at the capital structure, how they generate income, etc. And if they generate income via fees, that's something we look at, but we don't require anything. And in particular, and this is for Fitch, our focus is mostly on liquidity, because this internal capital generation capacity that would be what streams from these fees, we will look at that under the capitalization. And as I said, the capitalization leg is not really, in our view, affected. So our main focus is on liquidity. So I cannot really say much more than that.
I think it's the same for us. I mean, at the end of the day, liquidity analysis for those type of entities is critical. It's obvious, right? So if there is one entity that brings the fact that by their own mandate, they charge something more that might reduce their liquidity, then it's going to be part of our analysis of liquidity. But it's one of those things. I mean, it's not, because sometimes we do hear that we have to do it, otherwise rating agencies do it. That's not true, as most of the time. It's easy to blame somebody else, but that's not the case. It's a liquidity analysis. if by doing this you bring in more money or less money compared to another entity, that is going to be part of the many hundreds of other elements that we look when we rate an MDB.
Yeah, so it's the same for Moody's. So liquidity is an important part of our methodology, so we need to analyze in detail. So if we have these clauses that provide liquidity relief, good, but on the other hand, if the liquidity is reduced because they have an additional charge, this is something that we need to see and to analyze. I mean, the combination of both elements.
Thank you. And maybe to close, I will ask all of you, what are some actionable plans that can facilitate the scaling up of posable bonds or deferral bonds, including and especially new issuance? Eric, would you like to start?
Well, I think the structure is there. Market environment is there. There's been considerable progress towards, in certain legal aspects. Bond investors are becoming more sophisticated, capable of pricing the very unknown by probabilistic approaches. So everything is there to launch on a real scale the CRDCs. As was said in the previous panel, we need the first mover. In 2003, with the CACs, it was Mexico, but it was interesting to hear Sebastian mentioning that Mexico was not given a choice. Mexico had to be the first mover. So who will have to be the first mover for CRDCs? In theory, it should come from LATAM. But maybe if LATAM doesn't act, it could come from Africa.
So Aureliano, talking about LATAM, we put you on the spot. What do you think are actionable plans to scale this market?
Thank you, Barbara. Yes, well, I believe what we are doing here is one of the important steps, and continue the collaboration and coordination that we already have with the MDBs, and to offer this in a clear way to our country members. And secondly, I would say what in the session in the morning, I believe Harold as well, who say that the education process between lenders and the countries is important.
Absolutely. Lapo?
Yeah, from our point of view, I'm going to state the obvious. I'm going to start with that, saying we cannot say who should be the first mover or not. We are observers of what we get. But I guess, generally speaking, S&P, the more we have transparency, the more we know things well in advance, and we are called in to have views well in advance, it always helps. And to be honest, also from our side, maybe we have to do even more and more and more of connecting with the market, as the market understanding exactly what our ratings address and they don't address. I still today hear that there is a massive misconception of what the rating actually stands for, doesn't stand for. And to be honest, I put ourselves in the mix. I mean, maybe we haven't done a great job over the years to explain actually what we do. And so we are here today, as we did today, to explain exactly. And you're going to have my phone number. You can all call me anytime. But definitely, it's not just one side. So we are part of the market. So we want to make sure that it is clear what we address and what we don't address in our ratings.
Yeah, or maybe things are changing and there is more leadership also from the MDBs to try and make this work and to accept new instruments in the market. Marisol, do you have anything to add?
Yeah, so same as Labo, not our role to make recommendations, but I will point at the need for investors to be very clear in the original bond documentation what the triggers are. This is very important. And second, payment deferral is time limited. It's not endless. And they need to be very clear that there is a temporary liquidity support, and the debt is not going to be reduced. So net present value neutrality is very important to bear in mind. and also the fact that the inclusion of these clauses will mean a charge or an additional cost for the borrower.
Thank you. And Carlos, last words.
Yeah, I would say that in terms of early adopters, we do have some early adopters. We have some in the room, but I'm going to talk about the ones that we rate. So we rate Barbados. We rate their deferrable bond in Barbados. So there has been some early adopters. I think the point now is standardization. And for standardization, kind of in line with what Lepo was saying, I think we need transparency. We have, I'm sure we can do more, but we have the feeling that we've been very transparent. We've published our criteria. Our criteria has been out there for a couple of years already, explaining how we look at things. So the word that I will use to close this is a term sheet. If we have a term sheet, then I can take that term sheet, go back to follow all my procedures that are very long and tedious, and work on enhancing our methodology to make sure that we are able to provide an opinion. We're in the business of providing opinions, and so we need something very specific to provide an opinion on. And I think that term sheet that will bring a standardization across the market is what I think it will be a great step for us at Fitch.
Can I add something very quickly? Because what I think is important is, especially when you're in the beginning, and this is true in any market, this is true in anything that is new. Something that is new is coming up, is always, at least for S&P, but when you are an observer, it's always very challenging when you are brought to in front of you something that is a lot of possibilities. When the possibility of things changes is very broad. I know people like being broad, but think from our point of view, it becomes almost impossible sometimes to even have a starting point, because you haven't seen this happening, it hasn't been done, it's new, you only have open-endedness. You have to understand, hopefully, that for us it becomes very difficult to actually take a view. And so sometimes you might hear from an agency you might not like and say, well, it depends if this or this or that, which might be perceived as us being defensive of not having a view. Sometimes it's just our way to answer to the fact that if it's too open, there's not much that we can say to the market with a certain precision.
And I will compliment that lack of specificity sometimes brings the perception from the market of lack of consistency. Like, why did you treat this way? Because they were different. So the more this term sheet will bring consistency to the market and a consistent way in the way we look at things.
So I hear there needs to be more engagement among the different stakeholders, sort of listening to the input of the investors, the sovereigns, and of the CRAs on the other side as well, to try and create some products that are more standardized and can make everybody happy. Good luck. Thank you very much, Spain, for organizing this extremely relevant event, and all of the other organizers. And I think I can pass the floor back to Yara.
Thank you very much, Yara. Thank you to Spain and to the organizers for providing this opportunity to discuss this issue today. I am amazed at the fact that we pulled this together and that many of you have come to talk about debt pause clauses today. I mean, who would have thought? We certainly weren't convinced when we started talking to Spain about this idea some months ago. But anyway, I'm so pleased, and I think the conversation has been so rich and interesting. I hope that you've all found that to be the case as well. So our panel is supposed to address the question that was just posed, really, by the ratings agencies. How do you standardize this product in order to scale it? Is standardization the right thing? We've heard many, many different views today. From Sebastian, we've heard we don't want to make a product that gets priced differently because it's only for vulnerable countries. So we don't want a product that, you know, is going to have those pricing implications. We do have the rating agencies on board, so I think that's a big relief for everybody. But you know, there are many, many issues that we need to overcome in order to really see this scale. We know that bondholders were early adopters with Grenada and Barbados examples, but we really haven't seen a scaling up since then. So let's figure out why. We have a wonderful panel to discuss these issues, so I'll quickly introduce everyone and then jump in with questions. So to my direct left, I have Sonia Gibbs, who is Managing Director and Head of Sustainable Finance at the Institute of International Finance, where she leads the IIF's work on sovereign debt policy and sustainable finance. Next, we have Professor Rodrigo Olivares Caminal. Rodrigo is the chair in Banking and Finance Law at Queen Mary University of London, and he's also of counsel at Kempler Karst Law Firm and a renowned sovereign debt expert. Next, we have John Amwazi, who is Senior Vice President at Neuberger Berman, a global investment firm active in emerging markets. John is a stewardship and sustainable investing specialist on the emerging markets debt investment team and is responsible for key ESG initiatives across the platform. Next, I'm happy to say we have a representative of the debt capital markets, the investment banks that bring these issues to market, Angel Beltran. He heads the ESG Debt Capital Market Solutions team at Santander, corporate and investment banking. And prior to this, Angel was part of the fixed income group in London, focused on capital advisory, and also was responsible for bond issuances in Latin America as part of Santander in Chile. So he's advised multiple issuers, particularly in Latin America. And then very happy to have Sarah Jane Ahmed. She is the managing director of the CVF V20 Secretariat, hails from the Philippines and Bangladesh, so has personal interest in this issue. The V20 finance ministers, with Barbados as its chair, represent 74 climate vulnerable developing countries working together to advance financial and economic solutions for climate resilience. So hopefully CRDCs are one of those that you're thinking of. Great, so turning first to Sonia. The IIF represents a very significant proportion of private creditors across the globe. And for decades, I know that you have been involved intimately in debates promoting responsible borrowing and lending to reduce debt vulnerabilities. You also have a privileged seat at the Global Sovereign Debt Roundtable. So you're hearing discussions around these issues in real time. From your perspective, how do you see forward trends around debt pause clauses as a tool to address debt vulnerabilities? And how do private creditors view them in your discussions at the IIF? Thanks.
Thank you so much, Starla. It's a great pleasure to be here. And you'll forgive me taking a step back. I mean, a lot of our discussions are, by definition, very technical. But I think having a little better sense of the policy and market context around this might be helpful at this stage, especially this late in the afternoon. But you ask a really profound question about the role of the financial sector in responsible lending or responsible investment. Ultimately, as we all know, it comes down to fiduciary duty, but with kind of a twist here, right? Our understanding of fiduciary duty has really changed over time. And over the past couple of decades, it's shifted, obviously, to include greater consideration of climate, environmental, and social factors. And the latter, I think, really focuses on the burden of record high debt levels. So there's a lot more recognition of the risks of what you might call reckless lending or lending that doesn't take these factors into consideration. And this shift, I think, has laid the groundwork for solutions like CRDCs and pause clauses. And I want to focus on two necessary conditions to scale these up. One being market development, and that's what we've spent a lot of time on today. The other being policy support. And, you know, when you think about sort of market development and so on, the devil has always been in the details of how solutions like CRDCs are developed and implemented. And as we've been hearing, there's been a lot of progress. So the market pace is moving forward at a pretty strong clip. Another piece of good news, the sustainable debt universe, as Barbara can tell you, has really grown in recent years, almost quadrupling to $7.1 trillion US dollars in 2024 from just 1.9 trillion in 2020. So that's a lot of market growth. And the market expansion has laid the groundwork, again, for take-up of things like CRDCs. However, we've also got, there's an elephant in the room, always, they've got to take into consideration the pretty remarkable shift in U.S. economic and foreign policy and the response from the rest of the world. And that has obviously made multilateral solutions more challenging. Something like CRDCs at scale has got to have a multilateral approach, and that's going to be much harder. And this greater policy uncertainty is fed into higher risk premia and higher borrowing costs, including for emerging and developing economies. That just makes all these conversations that much more difficult. Let me also say a few words on the international policy front. You mentioned the Global Sovereign Debt Roundtable. The discussions have certainly included state contingent instruments like CRDCs and others like VRIs and GDP-linked bonds and so on. And I think the interesting part about the Global Sovereign Debt Roundtable is that it's at ministerial level, and yet it's supported by these very pragmatic technical working groups that do deep dives on issues like this. So there's kind of a three-pillar approach, they call it, to debt restructuring and broader debt sustainability considerations at the GSDR. First one is structural reforms and domestic resource mobilization. Second is ensuring sufficient support from bilateral and multilateral partners. And the third one is on reducing debt service burdens, including risk-sharing instruments to incentivize private capital inflows. And that's where conversations around CRDCs and pause clauses fit in, because the liquidity, the time that these can buy, is super important. I think one other thing I'd mention on the policy front, apart from the GSDR, is the shift. It's really quite compelling toward financing for adaptation and resilience. It's a much more pragmatic, a kind of a here and now focus than mitigation and 2050 climate goals. And, it's obviously we need both, right? And it's unfortunate that the departure of the U.S. from institutions like the Paris Agreement and the Network for Greening the Financial Systems has shifted the focus toward adaptation and resilience, but that focus isn't bad either, because we also need adaptation finance. So that should mean and help promote a bigger investor base for CRDCs, which ultimately are a form of adaptation financing, if you will. The bottom line is that these innovative tools, like CRDCs and pause clauses, have tremendous appeal, particularly as stakeholders, including governments and regulators and financial firms, reassess future climate risk in the wake of the policy changes that have taken place over the past year or so. We've got our well-known challenges. We've talked about these many times: trigger design, thresholds, pricing, legal risks. Deborah, you were talking earlier about the work of the UK Private Sector Debt Working Group. None of this stuff is new, and there are still very practical problems to be solved. But the good news is, I think, that we already have a lot of these solutions for promoting take-up in hand. There's growing awareness of these remedies, not least because of events like this one. So the solution set, and I'll finish here, includes strong instrument design, particularly around verifiable triggers and NPV neutrality to support pricing and clear investor preference for simplicity and clarity. Progress as far as possible towards standardization, given that every case is going to be unique here, while keeping that flexibility we need. And that should be helpful in keeping costs down, particularly for issuers, as Sebastian remarked earlier. Working with index providers, we discussed at the spring meetings to facilitate index inclusion, because that's an important unlock here in promotion of these clauses. Credit rating agencies, we've been talking about that. Education of borrowers. We talked about capacity building in the last panel. Absolutely critical on the benefits of using these instruments as part of a broader climate risk management strategy. Addressing any kind of legal or regulatory barriers to take up, cross-default clauses, for example. And strong policy support. You've got to have endorsement at all possible levels. I can't stress this enough. Seville is going to be important here. The G20, the G7, COP, the development finance community, finance in common. This is critical to getting private sector support as well. So in short, to mainstream CRDCs and pause clauses and generate private investor appetite, we need effective design, good market infrastructure, official creditor and MDB support, as we heard on our last panel, and policy endorsement.
Great, that was pretty much sums it up, Sonia, but I have several more panelists to turn to, but thank you so much. And I really liked your characterization of CRDCs as a type of adaptation finance.
It is.
I think that's a really good way of thinking about it. Let's focus in a little bit more now on the triggers and instrument design, because I think one of the questions around scaling is scaling what? Rodrigo, you have an interesting life because you're both a practitioner, for many reasons, but you're both a practitioner and also an academic. So you can encounter real life issues, you can advise on them, and then you can go back to the university, think about them, deliberate. So I know you've been doing just that, and you have been thinking particularly about what problem are you trying to solve with debt pause clauses, and therefore what should it look like? What should a debt pause clause look like? So in light of precedent, what we've seen, what have you come up with? I know you have slides, so perhaps if you could get the clicker, that would be great.
Thank you.
Thank you so much.
Thank you, Starla. The slide is just a background image to kind of illustrate the point. I'm not going to go in detail through the slide, but as a good lawyer that I consider myself, I will start with a disclaimer. I believe in these post clauses. I think by this huge progress has been achieved on post clauses. But I'm a little bit critical of where we are at the moment. And I think basically there's a lot that still needs to be done. And basically there's a lot of experience that we can borrow from transactions on the ground, some of the transactions that were discussed earlier today, and also from the experience that we have from collective action clauses. And I think that basically, and again, a little bit like borrowing from what Sonia was saying, basically, let's go back a step. And basically, why do we create these clauses? How do they come into existence in the first place? And the issue here is to reallocate resources to face a large-scale disruptive situation, right? And that's the immediate reason why we include these clauses in our debt instruments. And then the second level is probably to prevent a full-blown crisis, be it health, social, or economic, that can trigger a political crisis. But so far, what we have been witnessing is that these clauses are related to climatic events, be it an earthquake, a hurricane, a drought, a flood. Then the evolution of the clause took us to pandemics. But what happens if, for example, we have a locust infestation? It is climate related, but it might not necessarily be that climatic event that we have contemplated in the drafting of our clause. Believe me, here I'm pushing a little bit boundaries. I've been asked to focus more on the forward-looking, right? So basically, we have a locust infestation doesn't fall within our clause, and basically, we have two problems. One, the triggers have become too narrow. Or, if we need to expand, they start becoming too technical. And the problem that we are facing is basically, this is kind of going towards the path of GDP-linked warrants, where we have seen some difficulties in how they are structured, how they are priced, and growing in complexity and even some cases of data manipulation. So basically, we need to be very conscious of the risks that we are facing with what I think is a great innovation. That's why I started with the disclaimer. But what happens if, as I just mentioned, it is not a climatic-related event? What happens if it's a climatic event that is not covered, locust infestation? What happens if it is not even a climatic event, a pandemic, and I don't have a pandemic clause? Or what happens if it's not even an exogenous, but it is an endogenous cause of this temporal situation that might scale into a crisis? So basically, my point of view is that basically we need to shift the focus from the trigger to probably work on the covenants, the undertakings, and the risk hedging. What I am proposing, and I use a very provocative name for it, I know that there are some detractors in the room, some people that I have had conversations before, I call it a just because clause. in the reason that basically, let's not forget what we are trying to address, a temporary situation that can scale into a full-blown crisis. And it can be a climatic event, it can be a non-climatic event, it can be endogenous or exogenous. Some of you might be asking yourself, Rodrigo, are you saying that probably we should just include a just because clause in the event that we have a bad policy? Why not? Let's go back to the basics. What were we trying to prevent? A full-blown crisis. So basically, again, we will go into the pricing, and I know that some of my co-panelists can go into that into more detail, but basically, what we need to work is more, rather than on the trigger, on the governance and the undertaking. How to prevent abuses, how to establish preconditions to be able to trigger a just because clause. And the trigger being, and again, I know I'm being provocative with it, but because it is just because. Of course, the issue will be on the pricing and the legal drafting, but I have blind faith in economists and financial advisors, as well as legal advisors who can work those details. And I know that the devil is in the details, but basically, we have come up with very, very complex structures. We have come up with some bond documents that run in 300 pages. I am sure that we can sort this out on the drawing board. My final comments. Of course, I'm happy that we are at least protected for a hurricane. Being protected for a hurricane is better than not being protected at all. And as post clauses have been accepted, and that's a reality, of course, and I've been hearing since this morning, kind of with a negative tone that basically there needs to be more uptake. Definitely, but they are here and they have been accepted by the market. That's it. Now it's just a progression. And that's why I think we need to safeguard the integrity of the clauses. We need to prevent manipulation as what happened with GDP-linked warrants, or we need to prevent some structures that become extremely complex. So what we need to do is, of course, work in the buy-in and on convergence. That's something that has been discussed earlier today, and I think basically convergence is key because they are populating like mushrooms, and we have hundreds of clauses out, well, not hundreds, but basically many clauses that are progressing and growing, each one taking its own twist, and that is creating complexity. And the complexity undermines the chances of having a bigger uptake on the clauses. As I told you, prevent overcomplicating and abuses and manipulation. And if we want to address these issues, we need to cover more scenarios. And basically, that's why I am suggesting that we need to work on simplifying the trigger. And even if we are not ready yet to a full just because, at least we should have a general climatic post clause, not distinguishing by specific. And then we can discuss, if you want, on the Q&A, basically how to work on how to qualify to benefit from the clause, but basically if it's a hurricane, who certifies? But if it's a cyclone, who certifies? And if it's a drought, but again, these are mechanics that we can work around. And basically, Sri Lanka is a very good example, and basically, I think there are many lessons to be learned from Sri Lanka. And basically, I think it was the third panel, I think it was the questions by Marta about basically the two takeaways. I think basically simplify the trigger and convergence. I think those are the two key messages, but I'm happy to discuss and get into more details in the Q&A, but the reality is basically having a just because from a general post clause, or from a post clause existing now, cherry pick any one of them, you will realize that when you do the comparison, I was not able to use slides, I was limited to one. I have 5 slides, which is a comparison line by line on the different instruments, the different clauses that are available, and basically you see that the differences are not that big. But the problem is that basically each one has its own mechanics, and that creates greater complexity.
Perfect.
Sorry.
Thank you, Rodrigo. You can see he is a professor, and we'll probably speak on this for hours. But I understand that what you have been thinking, Rodrigo, is something that is has also been in the mind of the bondholders, which I find really interesting in terms of meeting of the minds, because I don't think that you've been talking with all of them. So this is quite interesting organic convergence in thinking. So turning to John, this morning we heard from our colleague Rue Ferguson from the UK Treasury about this initiative, the London Coalition on Sustainable Sovereign Debt, that is trying to create a forum to bring forward private creditors come forward with solutions for some of the more sticky issues in the international financial architecture. I know that Neuberger Berman is actually on the bondholder working group that has been looking at this specific issue. So I think it would be really interesting to hear where that group has gotten in its discussions, understanding that it hasn't yet had deliberations or iterations of their thinking with engagement from issuers, which is another step. However, I know they have been talking with rating agencies, but it would be wonderful to hear where you're coming out in terms of what those triggers might look like. And also, Eric Lalo mentioned about non-financial considerations that you might give weight to or value to so that you're not charging. So I would love to hear where you're coming out. Thanks.
Perfect, thanks. It's good to be here, and thanks for the invite. Also, it's really good to hear similar themes going across different panels in terms of what we've been discussing on the bondholder working group. So the group consists of about 7 or 8 different asset managers, and then we have the London Coalition as well. In total, we manage around $3 trillion of assets under management. So a big group, and we're looking to increase that by inviting others to join the group. Our overall objective, obviously, is to get greater inclusion of debt pause clauses across sovereign debt. We believe that credit risk or climate risk is part of financial risk. So having this in bond contracts is our fiduciary responsibility, ensuring that issuers are going to be able to pay back the debts, and in return, we do our fiduciary responsibility for our clients. In terms of the 2 key points that I wanted to highlight, and like I said, it's been highlighted in other panels, broadening the clauses has been discussed, and then also increased transparency are the 2 key points that I wanted to highlight to this group. The first point, standardizing and creating broad triggers has been covered already. I think it's important to go past just the climate or the hurricane and consider pandemic. Having a broader trigger would make it better for other countries to be able to adopt this in their bond contracts. At the moment, when we look at the market, we do see lots of fragmentation and complexity. Being able to standardize this response will be a way to broadly approach this going forward. The second point is scalability, and it's something, once again, has been discussed. To be able to have a scalable framework which will be used across countries. At the moment, we are seeing the Caribbean and Latin America. That's where we see most of these clauses at the moment. But it'll be nice to see that go across to Africa, Asia, and other regions. Just to give you a sense, when managing a portfolio for our clients, using the JP Morgan MB index, it was highlighted in the earlier panel. There are only 6 countries in that index which is covered by the current CRDCs. So being able to extend this across broaden the triggers, increase the number of countries, will definitely provide increased usage across the board. The third is trying to have a clear and functional contractual provisions. I've talked about fiduciary responsibility. It's important to get trust with these types of debt pause clauses for investors to be able to invest in it. We talked about pricing. Trust helps pricing come down as well if investors get comfortable with the framework. We do think it's possible that we include, for example, one deferral per bond. We also think it's possible to limit activations closer to maturity. And then also we think it's also possible to include bondholder rejection requests. So there'll be like a 50% trigger for investors to say, no, we don't want this debt pause to go on. This is just to prevent misuse of the clause. But overall, like I said, we do believe that this makes a country much stronger in terms of their credit profile and are able to pay back their debts. And then finally, we've talked about transparency as well. We think is really important, being able to get transparency into what the sovereign is doing, increases bondholder the belief in the sovereign. We talked about governance and the fact that if you have good governance, it reduces the spread on the bond by about 75 bips. Governance, transparency, these are key points that we want to highlight within the bondholder working group. So issuers have to commit to providing a little bit more information to bondholders so we are aware of all the risks that are available. If we are aware of the risk, then we can price the bonds properly and be able to do our risk management on our side. But if there are some unknowns, it makes it very difficult for us to look at an issuer, look at a bond, and be able to price it when there are some unknown risks. But yeah, overall, as a group, we obviously still have more work to do. We are speaking to the credit rating agencies. We've engaged with ICMA, and I think there is progress being made. And ultimately, we do believe that having debt pause clauses are credit positive for sovereigns. And that's an area that we want to pursue across the board. I'll pause there and hand over.
Great. That is so interesting to hear. I think oftentimes in fora like this, we don't actually get to hear directly from an investor. So thank you, John. That was really, really interesting and helpful. We also don't often get to hear from the debt capital markets lead managers who play such an important role in helping bring countries to market. And what's different about our panel, I think also just to make sure everyone is clear on this, we're thinking about introducing debt pause clauses, not just via a restructuring, which is the precedent that we have seen thus far, but in primary issuances. Angel, you would play a role in this. So first of all, we heard earlier about the importance of including in the RFP this desire for debt pause clauses. So if you are seeing, first of all, how would you support a country if you received an RFP that says, I want debt pause clauses? What would you do to bring them to market and satisfy what they want? And how do we get from here to there with the borrowers that could benefit from this? Thank you.
Well, thank you very much, Starla. Thank you very much for the invitation, to Barbara as well. It's a pleasure being here and seeing a lot of people passionate about sustainable finance still. We think we have a space that is super important. Probably, the short answer is probably I would call John to see what else that he can show. But jokes aside, the main, and not because of this particular type of structure, but the main consideration that any funding officer will have across the board, regardless if it's a sovereign issuer, financial issuer, or corporate issuer, is one, the conditions of the structure, including the pricing, probably at the top of the list, and secondly, the execution risk. So can you deliver on what it was agreed? And then probably the question is how this clause, and how you probably were speaking the same language. John was probably the first one to speak about basis points, the unknowns. These are the very things that we need to deal with when bringing a sovereign issue to the market and then facing investors that many of them have kind of climate policies and sustainability responsibility principles, but most of them, they don't. So they would like to see what will be the potential impact of this clause in practice. The issue that we have is that we don't have a lot of precedents in the public market. So the challenges, and they have been already addressed, the definition of the event, how this is going to be verified externally is by the same issuer. It will be a third party, like a UN type of agency, etc. And then the materiality of the event. Is it at a regional level, national level, number of people affected, etc. These are all, one way of saying that, and there's a old tale, I will know when I see that. The problem is that we are at the very beginning of the journey, and that's why we have lawyers. I'm a lawyer by background as well. I'm not practicing, but basically we need to try to predict all the possible situation in the future. Some of the things that have been discussed in terms of the mitigants to these unknowns, and what does it mean, unknowns? Unknowns means in practice, in market practice, that you are going to reduce the number of investors that are going to participate. There are some investors that are happy taking a risk to certain unknowns, but the majority is not. And then you go into a place of the market that is called specialists, that are super focused, and they have spent a lot of time in a particular country, in a particular region, or particular type of events. If you want to have a scope with a wider number of investors, I think if you want to access, for example, the junkie market in the US with a benchmark transaction, you need to deal probably with hundreds of investors. And the nature of how transactions are priced or executed is actually during one day, or actually not even a day, it's a morning during a day, where you need to receive the orders, solve the questions, bring further information. You are not going to have time to address all of these unknowns. So having some mitigants, I think, is super helpful. What has been discussed in terms of having a potential third party, making the declaration of the emergency, the potential, although I think it's reasonable, as you also mentioned before, the 50% threshold for investor pushback, limiting this to certain type of issuers that we all agree that are probably in the first line to be affected by the negative consequences of climate change, as well as the direct use of the benefit to addressing the adaptation issues. I think it will make a nice case that could be well understood by the potential investor base. In terms of if we would like to make a case for a successful transaction of this sort, I think we should need to look at, and quote unquote, I will call precedents, in terms of proxies of other type of clauses, maybe not even in the sovereign space, that have in some cases similar consequences. And I'm thinking typically in the capital stack of the financial institutions, if you breach certain capital ratios, you will be able to delay the payments of the interest. There are regulatory clauses for disqualification of the instruments that are used for capital purposes, tax clauses, etc. They had been included, and probably now we don't notice that they are there in the prospectuses or the offer memorandums. They have a history as well, and probably because of the New York and English law that is normally used, the precedents are super important to define what is understood by the underlying event. But overall, there is an understanding of what will happen in the event this is triggered. In any case, in practice, these are clauses that give some leverage to the issuer, regardless they use it or not. Again, using the concept of the toolbox, in order to have a softer or harder negotiation with counterparties when they are facing challenging times. And finally, in terms of the approach to put this into practice, I think probably the key element is transparency regarding both the rationale of why this is important, and then how it is going to be applicable into practice, I think there will be a lot of confidence to investors. I agree on the win-win situation of having an orderly mechanism to deal with a challenging situation that we are all aware of that is going to hit, we don't know when or how, but definitely it's going to hit countries and in a more frequent basis as time passes. And probably the most challenging issue, as I mentioned at the beginning, and I would like for that to have no impact, is the pricing. These are, as I said, it's probably the first questions, the first set of questions that an issuer will make. If we use some of the precedents that I mentioned, these other type of clauses that have been used to delay the payments or make repayment of the principal or give some options to the issuer, they typically involve an extra pricing in terms of basis points that the issuer will have to pay to investors. Even if you think in the most good faith scenario in which an issuer would like to restate some kind of paragraphs of the documentation, and it's not going to have an impact on investors and potentially even could have a positive impact on investors, typically investors will require a little fee, just because this is changing the conditions of the security, and because it's a market, and they are probably looking also at taking care of the reward that they can get from their investments. They will require some level, particularly at the beginning of making these type of clauses more mainstream. Once well understood and applicable across the board, probably we can live more in a business as usual scenario where there is little to no impact in terms of pricing. I like also the rule of thumb that higher or better governance should imply something like 75 basis points, and there are different metrics also in terms of how the social issues are addressed, the level of the debt, etc. They have, even if you have the same rating to a discussion that happened 2 or 3 panels before, they have a difference in terms of how the market perceives that and what is the remuneration that they would like to receive back.
That's great. Thank you so much. Very, very interesting. Moving to Sarah, you represent and assist and support those countries that would potentially be on the front line of issuing these new bonds with CRDCs in them. So if you could sort of place CRDCs within this broader toolbox, because we've heard many from others, from Harold from St. Vincent and Grenadines, and also from Kelsey from Barbados, about how this is part of the toolbox and you need to use policy to move this forward. So how do you see this, and how are you advising and supporting the countries that you represent? Thank you.
Yeah, thank you, Starla. I actually have a slide, if we could maybe... Oh, yeah, perfect. Yeah, it's just one slide, just to give context to which countries we're talking about. But before I begin, just want to thank the Spanish government for getting me here in record time. I think it was a 36-hour visa turnaround, so huge thanks. And I think in terms of where this fits and with the broader architecture, so as you know, Barbados is the chair of V20, and the Bridgetown Initiative and the V20 shared perspectives called super levers earlier this year in January, 10 super levers specifically, and part of that includes prearranged and shock responsive finance. And so where this CRDC fits really is its interaction with other prearranged tools. So for example, CAT DDOs, sovereign insurance, other types of tools. All of this is to provide breathing room and liquidity in order to deal with the crisis. So if we have these tools and then we have this clause, as we heard from the other members, it just buys that breathing room, which is so critical when disasters strike. But in addition to that, I think it would be also very useful to ensure that adaptation piece that investment piece is also covered. And so if we could find a way to sort of scale the prearranged and shock responsive finance to the membership there, which includes Southeast Asia, South Asia, Sub-Saharan Africa. Of course, you have your Latin American, the Caribbean. But I think this would be very useful to interact with the rest of the toolkit. I guess in terms of follow-up steps, so the V20 is not a negotiating block. It's very much a what can we do now situation, and what should we advocate for together within the government. So next steps, we really hope we can work with the Spanish government to make this accessible across the membership, but also work with our legislators. So we also have a global parliaments group within the V20. And as this is being responsible about debt management, it could very well be that they also play a role, just so that the burden isn't just on the finance ministry, but rather the country looking at it from a debt sustainability and how do we be more responsible. I think soft triggers is also quite critical in terms of the toolkit, just because there have been instances of basis risk, and this is what happens when you just have a single instrument available to you, which is why the optionality is really critical here. The other point, and the fact is, ODA is declining. We need private sector participants to come in, but we also need them to know that the government will be able to respond when shocks occur and be able to rebound quicker. And so this toolkit and this clause could be very well part of that solution.
Thanks. I'm starting to get a couple of questions, so please, if you have any, please put them into the app. But Sarah, just to follow up with you directly, so I heard you say that you're supporting soft triggers. That's particularly helpful, I'm sure, across your different countries, so that you can sort of speak to them about a similar instrument and not be like, oh, you're eligible for the hurricane and you're eligible for the drought. But what do you think about the transparency piece that the non-financial provisions that the bondholder working group, for example, is putting forward as maybe a quid pro quo for providing this liquidity support? How do you think your countries would view that?
Yeah, I think a colleague from CDP had mentioned how challenging that piece is. I mean, I don't really see, I mean, we haven't really had that transparency discussions within the membership, but I imagine if we look at it from, we're trying to build a system of support around you, and this is, it's a give and take. I can't see why we can't have that.
So this is something maybe for the MDB, our MDB colleagues around the technical assistance support that might be something useful.
Yeah, actually, just on that point on TA, I also think it's really critical that our debt management offices and our finance ministries have that additional support to better recognize like what portfolio of tools are most appropriate and how they can really optimize them the most effective, like in the most
how it all
way.
fits together.
Yeah,
exactly. Yeah. Brilliant. So I have a question here for the two that talked about the broader pause clause and the CRA panel just before. So we heard from some of the credit rating agencies that they are really looking towards very specific, predefined specific triggers. And you're here talking about maybe there are reasons not to go that route. So how will we reconcile this with the credit rating agencies? Are there other ways to provide some kind of certainty? John, start, and then Rodrigo, maybe? Thank you.
Yes, I think in terms of the rationale for having broader triggers, it's to ensure that we're able to scale this across different countries. If we have a very narrow trigger, for example, like we've talked about the Caribbean, hurricanes, that's great, but you can't use that in other geographies. So being able to have a broader trigger, whether it's including droughts, whether it's including pandemics, that's a better way for us to be able to scale this clause across different different countries. When we're doing our credit analysis, these are things that we look at already. So in terms of the risk management, having a broader, I don't want to say toolkit, but having a broader set of triggers that we can look at is better for our risk management approach.
Thank you, Starla. Before I answer this one, a very quick comment on the issue of transparency. Basically, public debt is public, and basically we should all have access to that information. But going to the specific question on, I personally think that we are looking at two different things. One is pricing and one is rating. Basically, from the credit rating agencies, we saw that basically as long as it's included in the contract, in the terms of the contract, and there's an extension or there's a temporary suspension, that's fine. So basically, I don't think that basically the broader trigger, I'm not a credit rating agency with that disclaimer, but basically I don't think that because basically if we look at how they're reading it at the moment, as long as it's in the term of the contract, there should be no immediate impact. The question would be probably for you, John, and basically, I don't know if I can ask a question to my co-panelists. Okay, basically, how can you price the potential occurrence of a hurricane, let's say, in the lifespan of a 30-year bond? And how many times will it occur? Okay, that is the answer I was expecting, because basically, then I assume that basically pricing the recurrence of hurricanes and the recurrence of a policy blunder is pretty much, that's going to the just because, no? I think that pretty much is very similar. And at least the policy blunder gives you a warning, and market players are even able to trade in the market prior to the actual event, while a hurricane most likely will not give you that luxury of time. A hurricane or an earthquake, locust infestation, or pandemic, you name it. But I don't know if on the pricing, there's something that you can tell us to enlighten on that aspect.
Yeah, I mean, we're not climate specialists, we are investment specialists. So when it comes to trying to understand the impact of hurricanes on investments, it's slightly difficult. We've talked already about credit risk, liquidity risk. The other risk that I'll highlight is the optionality that's having these debt pause clauses introduced into the bond prospectus is something that would add some additional spread to the bond. I mean, we don't expect there to be a big difference between the bond without a debt pause clause and the bond with the debt pause clause, but there will be a slight difference because of the optionality that's being introduced because of the pause.
And it's something that can eventually be offset by greater transparency, better governance?
Mm-hmm. Yeah, it could be offset by, obviously, greater transparency. You can think of blended finance as a way to approach to try and reduce the overall cost, because ultimately we want to ensure that these countries have the liquidity and the money to be able to pay for the crisis rather than paying the interest. So yeah, the ways to reduce transparency, improving governance, blended finance, all these things.
Partial insurance wrapper, or
yes, all these things can help reduce the price.
Great. I want to go one more time to Sonia and then wrap up with Angel, if we can, just before we end. Sonia, I know you want to say something, but I wanted you to, if you can, pull this in also to like your investor relations program, how that relates to transparency, this debt management tool, let's call it, all of that, and whatever else you wanted to add there. Thank you.
Yeah, actually, I think it fits in really nicely, particularly, Sarah, given what you were saying earlier, and that is that transparency, good governance, good investor relations, however you want to label it, is fundamental to the success of any of these types of solutions that we're talking about. It's a difficult problem, right? Because you get into like conditionality and all of the and sovereignty and all of the issues that the multilaterals have struggled with in so long in getting this kind of debt transparency, and yet it is so very fundamental. I mean, it has to be had. And what's encouraging, I think, is that you're hearing more from the private sector about what they need in terms of transparency in order to be able to facilitate their investments. So all of that really matters. I just wanted to comment also quickly on the trigger question, and probably the clever lawyers in the room already have solutions here, but broad triggers and just because, clauses, all of these enhance the utility of this type of instrument, but they make it much harder to price because you have so many different potential triggers. And I wonder if there's some way to like frame a broad trigger with a bunch of narrower triggers underneath that are objective and verifiable and all that kind of stuff, speaking to the, and weave in the governance. So my wish list.
That's super interesting, something to look at with everyone that's looking at the trigger issue. Angel, finally, again, it's such a privilege to have the all-important DCM person in the room. So outside of a live deal, which is really a bad time to start introducing these, really, what do you think we should do to try to go from here to a greater scaling of these clauses? Thanks.
I see as I will take like baby steps, and I think a super nice next step will be liaising with between issuers that might be very good or strong candidates for this type of clauses, and with the bondholder group where John is being involved. Looking at what the apprehensions from one side, where there is some space for middle ground, trying to work out draft clauses that have been incorporated, and probably looking into potentially kind of putting that together into an actual transaction, maybe with blended finance support and or some multilateral as anchor investors. And then you will have at least a line in the sand where investor participants or agencies, etc., can look at how this works into practice. Probably I wouldn't aim to have a benchmark large transaction, including this clause to start with, but I guess that's something on the lines of what I mentioned is something that could be done within the rest of this year.
Great. And Sarah, we may be turning to you to see if we can have some non-deal roadshows with some of the V20 members. It could be very interesting.
Yeah, there's actually a new working group set up in the V20 around this. So I think this is a good time to do that. And also, Pep from Bridgetown would be happy if I also mentioned this. With the CRDCs, obviously came a lot of it. The push forward really came from Bridgetown, and in terms of standardization is really a critical point. And with that standardization of the other products, this is not a product, but in terms of the other toolkit, such as debt for climate swaps and other things, I think is useful. Just so standardization across, just so that we could help with the scaling of these.
Awesome. Thank you so much. I found this very interesting, and I hope you did too. Thank you.
Thank you. Thank you so much. And thank you, everyone, for staying with us through a warm day and a lot of very intense and technical conversation. But it's been really, really fascinating to hear the range of perspectives already today. And I think it's a really great way to end the day talking to a range of panel members here who come from some different countries from the ones that we have already heard from, who can then reflect on how this relates to their reality and to what is most useful for their countries, and how therefore we go forward with debt pause clauses and the wider reform that is required. I'm really honoured today to be joined by such a fantastic range of panellists who can represent a range of countries, all of whom face really significant climate vulnerabilities, but who have a different set of geographic factors, a different set of economic factors with which they need to deal with those. So I will introduce to you Monica Asuna, who is the Director of Planning at the National Treasury and Economic Planning in Kenya. Nana Yanka, Principal Economics Officer with the United Nations Systems Unit from Ghana. Vicky Villacreses, National Director of Negotiation and Public Financing from Ecuador. And Geneva Oliveri, Deputy Director for International Financial Reform and Trade from the V20. Thank you all very much for joining me. We're going to start by asking each of them to speak a little from their country perspective and set out where they are on this question and their current approach to debt pause clauses. We will then go into a Q&A, so if you do have questions for any of these panelists, please do put them into the Slido now, and then we will be able to turn to them after the introductory interventions. So, Monica, can I start with you to tell us a bit about, from your country's experience, how do you see the benefit potentially for debt pause clauses, and how does it fit into your wider set of priorities? Thank you.
Okay, thank you, Miriam. And let me also start by first thanking the Kingdom of Spain for hosting us, and also for the organizers, the financial supporters for making it happen for us to be here. Yeah, so, and I'm very much delighted. This is my first time to be in Madrid, so it's really an experience. So just to maybe give a short background for those who may not know Kenya, but Kenya is widely known. So Kenya is a lower middle income country, and based on that, then right now we attract less of concessional financing, but more of semi-concessional financing, as well as commercial loans. So in the last 2 years, we've gone to the market last year and this year for refinancing of some of our, Eurobonds out there, just as a liability management. So most of them, but our preferred is concessional financing, because it's a bit cheaper in terms of the servicing costs. For Kenya, during the COVID-19 pandemic and with the debt service suspension initiative, where it was the framework was to really give relief to countries at that time, because it disrupted economic systems. It was really a challenge for us, because there are some partners who are, willing, and we quickly signed, into the DSSI. But for some, it was a challenge. Some did not even get into it totally. So, and in that arrangement, it was just to delay repayment for 6 months, though interest was being paid. It was just a suspension on the principal to be paid. So that shows that for partners, quite a number really are not comfortable with this, pausing repayment at that time, because it was a challenge, but we overcame it. So in our financing agreements, what is mostly applied is the termination clauses, where if there's disasters, then you terminate the program. And in that case, again, it is a trigger from the government. You have to sit down with the partners. But debt pause clauses have not been commonly applied at the country level. There are some creditors who say that it is not in their standard template. So they have to have it that the template for loan agreements is standard, and the debt pause clauses have not been introduced. So they cannot apply the debt pause clauses in that, because we've tried in the last 2 years really to have that as a clause in our financing agreements, but it's not working. So for us, flexibility in having these clauses in any new financing would be important, but then awareness raising on these clauses, how we should apply them. And that has been said in most of the panels before us, is that how do we apply it, what is the framework, but also for us, we know that it does not mean that it will maybe easy for us. So also for sovereigns also to be careful about bunching up, those maturities. For example, if it's deferring for 2 years, and then you have other maturities of other credit coming up, then how do you address that without impact on the fiscal space, and also having a fiscal constraint in the end? Because otherwise it may also be a very great burden to the government if it is lumped up together. So pushing those heavy maturities, but looking at the profile, the loan profile in terms of repayment, and how do you program repayments without impacting again on the fiscal framework. So I think this is something that is important. Also, we have the credit rating agencies saying that this will not be deemed as a default, because that is also the fear of most governments, especially us who are a lower middle income country who attract most of our commercial loans. So if it is not deemed as a default, that gives us comfort, because that is now something I'm taking away from here. And then how do we really standardize this going forward? Not really standardizing in terms of having us the same playing field, but what are the clauses, and how do you design those clauses in the financing agreement so that it gives comfort to both the creditor and the borrower? Yeah, thank you. I may stop there.
Thank you very much. And to you, Nana?
Oh, well, yeah, thank you. Good. So for us, these debt pause clauses have not been introduced into our loan agreements. We're having conversations around them. We foresee the benefits of it in terms of the fiscal reliefs that it gives us, the debt sustainability triggering that it gives us, and it gives us room in terms of development spending. So these conversations are going on. We see the debt pause clauses as very instrumental. And whilst we're having these conversations, we're looking at it from three very critical perspectives. That debt pause clauses are not debt cancellation. And I think that my friend Harold mentioned that earlier on. Again, it is an option. It is an option that we can take. It's an option we can take advantage of. And so we are looking at it. And then thirdly, and I think most importantly, once you trigger these debt pause clauses, you must be looking at the broader resource mobilization frameworks. Debt pause clauses are just one measure on the toolkit. It's important to look at the other resource mobilization frameworks. And so for us, these are the conversations that we are having. Thank you.
Thank you very much. And then to you, Vicky, from Ecuador.
Thank you. I don't know. Thank you for the opportunity to be here. It's my first time in Madrid, so I am in love with the city. For Ecuador, it's a great opportunity to be here because Ecuador is in Latin America, so we have a lot of problems with natural disasters. And for us, pause clauses is recently, but we are working with multilaterals to include in the contracts because we have other tools like contingent loans, but it's a different way. So we see these clauses as a mechanism, an important mechanism to enhance fiscal flexibility in the moments of economic stress and give us the opportunity to pause debt payments and redirect these resources toward urgent domestic priorities. And the benefits of these clauses is not automatic because we need to analyze how apply in our framework. We have a specific framework in Ecuador for public debt, so it's difficult for us maybe apply all the clauses that have the multilaterals, but we are working hard with the option that we have. So we are very glad to be here, and we hope that have the opportunity to apply in the future.
Thank you so much. It's really great to hear from such a range of perspectives here. Geneva, I wondered if you could share with us from the perspective of your organization and the number of countries that you work with at the V20, what the experience of implementing debt pause clauses has been so far among members, and how far you think it's going to be relevant and helpful to the much wider range of countries within your group.
Thanks, Miriam, and thank you for having me here. I would like to say that I'm heartened, really, to see so many Caribbean persons in the room representing my countrymen Miss Mustafa. So thank you very much. And of course, my adopted family, Barbados and the Bahamas and others. So for us within the V20, the implementation has been slow. And unevenly distributed. We would have heard earlier that it's more the small island states that would be bringing in. And maybe it's because of the issue of the triggers being too narrow. Perhaps that's the case. Or it could be an issue of knowledge, that we see it in a particular way. There's a perception of it. And as a result, there's a hesitance by governments to then take it on board. So, but we see the demand for the CRDCs within the SIDS grouping, and that speaks volumes, in my opinion, about the day-to-day fiscal precarity and exposure to increasing frequent shocks, external shocks especially, from the pandemic to hurricanes. I'm from Trinidad, I live in Barbados, so I understand, I see it every day. And Catherine from the Bahamas mentioned earlier that she remembers the time when it was rainy season or hurricane season. It was basically rain, just more rain and puddles. But now we are afraid. And I remember when we just had galvanized roofs with wooden anchors. Now everyone has to have steel roofs anchored into the foundation of their houses. It has to be resilient. So that speaks about the intensity of the hurricanes that we're facing. So for us, we welcome it. We agree with it. The ability to breathe when crisis strikes is something that we certainly value. Not more debt, not special treatment, but really the space to respond is what we are looking for. And this really offers that option. However, as my colleague Sarah would have mentioned earlier, we came out with a bunch of super levers, and there's a reason for that, because we don't see it as a kind of silver bullet for everything. It has to be, it buys time, but it doesn't solve structural problems. And without access to timely liquidity and fair debt restructuring and risk-intensive finance, sensitive finance, we're kind of caught in a loop. So we agree, but it has to be part of a broader toolkit. And I know that was kind of labored today, and there's a reason why it was labored, because it's necessary. And for me, I will just end on the most effective CRDC is one embedded in a system that prevents climate shocks from becoming debt traps. And that requires systemic reform, not just contractual innovation. And the CRDC is really kind of a contractual innovation, in my opinion. And that's where I think we need to leverage the FFD process. Because I think once it comes out in the FFD process, in the outcome document, it then signals to the world that there's a time to take this to the next level, whether through standardization, harmonization amongst lenders, and all the different various solutions that we could get from it. And I'll just stop there for now.
Thank you. A really wide range of reflections there, and I really appreciate you all coming with your own particular experiences. Perhaps I can turn to you, Nana, with the next question, which is how in the earlier panels there was quite a lot of discussion about the very specific design of the debt pause clauses, which is about low frequency but very high impact disasters. How do you see that working in a country like Ghana? And what other tools and mechanisms do you think need to be there alongside debt pause clauses for them to really fulfill their purpose? Thank you.
I think that for Ghana, debt pause clauses is the critical first response tool that we can go to. In terms of other mechanisms, I don't know how many countries have included debt pause clauses in their national debt management strategies, but I think that would be important as one of the tools going forward to include that in their debt management strategies. Again, for debt pause, the effectiveness is really in the immediate activation. And I was speaking to Harold earlier on, asking him, between the time they activated and the time they received the funding, what was the time frame? And he said it was, 3 weeks. So I think that these are elements that going forward, between the time that is activated and the time that the funding comes in, these are conversations we can have. Thank you.
Thank you. Yes, I think it's very clear that the speed is one of the most useful things about this particular tool. Can can I also, just as a slight supplement to that question, but maybe I'll turn to you, Monica. We've also been asked by the audience that debt pause clauses are being considered in the case of food security shocks. And do you see a pause as being potentially useful in that kind of situation? And if you don't have a thought on that one, I'm very happy. It looks like Geneva might have a thought. Maybe we'll go to Geneva first, and then you can add to it.
For me, food security is a big issue. I think it's something that we don't take seriously enough. For many of our countries in the V20, especially my countries in the Caribbean, we're net importers of food. And because most of us are tourism-based, we have to meet the demand of the tourism sector by importing even more. And because we're so small and we don't benefit from economies of scale, we have to meet the demand, and we can't really do that. We have been trying within our own grouping, like for instance, CARICOM, the Caribbean community, and other groupings, to see if we could leverage those with the larger land spaces, but it's still not enough. And then we have hurricanes and flooding. So I see this as a way that governments would get the opportunity then to pause and then feed either sectors or meet the basic needs of their particular population. And I think that becomes very important, because when we talk about vulnerability, we talk about the basic needs. Food, clothing, shelter. I grew up hearing about the basic needs, food, clothing, shelter. So we talk about the ability to feed, food, water, and water security, because I don't want to leave water security out of the whole discussion. The ability to keep roofs over their heads or ensure that when a hurricane passes, it doesn't flatten a whole community or displace a whole community. These are the basic needs. So if it is that we are looking at solutions to ensure that governments have the right tools to meet the needs of their population in the wake of crises, food security or the lack thereof is a crisis.
Absolutely,
Yes.
absolutely. And I think, Monica, you and I were talking earlier at lunchtime about the distinction between this kind of situation, which, as you say, Geneva, really becomes about humanitarian needs and basic needs, as distinct from adaptation, which is really much more about the long-term resilience of a country.
Yeah.
So, Monica, from your point of view, are there any further reasons why you think this would or would not be useful in the case of food security issues?
Yeah, thank you. I think just as Geneva said, it is very useful. The practice we have at the country level, which at times, is waiting for partners to act, is that the food security, especially when there's a crisis, is taken as humanitarian. So you wait for, food aid to come in, and then governments do not take timely and proactive action at that time. We still solicit for funding from partners which do not, come in immediately. So this is where, if there's a way of stopping or having a pause, especially to some of the programs in the agricultural sector, and this is where now the toolkit is that, if it is food security, maybe you'll not look for the programs or credit in infrastructure, but then those geared towards food, like in agriculture, and that is where now you direct that support to help mitigate, as you even solicit for more funding from other partners. So I think it's very important, just as has been said, at that time, it's really demeaning. At that time, if you see people dying because they lack food, people should die for other causes, but not dying that because they lack food. It's really very bad. So I think that quick response, apart from just relying on humanitarian, which at times right now we know, going forward with the funding of US cutting its funding, other partners also have followed, other bilaterals have followed suit. So it becomes a challenge that you may not receive, timely response at that time as a government. Yeah, thank you.
Thank you. Really important reflections. Vicky, we talked in the very first panel, some of the representatives talked about the challenges they'd faced in how to do a debt pause clause as a creditor country. And I was interested, as Ecuador has got one of these clauses, although hasn't used it yet, how you found that process, and were there challenges internally to accepting that?
Yes, our first challenges is the analysis of legal framework, because we have a specific law for public debt, and understand how work the clauses and the condition to apply them is important for us, because we have a process, an internal process to apply this. I think that other important challenge that we have is the financial analysis, because we have debt commitment. So we have we need to have the authorization of the commitment first for doing everything with public debt. So it's a challenge to understand what are the other people understanding and try to communicate the right thing. So it's the law and all the process, internal process that we have.
Great, thank you very much. Monica, if I can turn back to you. It's clear from some of the conversations, including from the conversation with the credit rating agencies earlier, that in order for these clauses to be really valuable for countries and to truly be a win-win on both sides, then countries need to be able to use them without an additional penalty, whether that be a rating one or an additional pricing that kind of increases the cost of capital further. So are there kind of particular conditions or ways that this could work for you that you think are important in order to make sure that you don't suffer those kinds of penalties from using such a clause?
Okay, yeah, thank you. First, I think just even the way Nana's saying, it's governments being aware that there are such clauses for those who are not aware, and then having them included. And I think it is good to have them included in the financing agreements that we have, just for precaution, even if they'll be not invoked, noting that the inclusion will not automatically imply that they'll be invoked, but in the event that you really need to invoke them. So also a clear understanding on when do we need to invoke such clauses. Does the disaster warrant that? Like for Kenya, we usually have 3 years of extreme drought and then 3 years of extreme flooding. So it's that cycle. And last year we really had heavy rains. This year it's minimal. So we expect that in 2026, 2027, we may have drought. So in such situation, and we always have the contingency fund. So if the contingency fund cannot really support this, then what are these other solutions? Then something like these debt post clauses can work, but taking into account in that also, governments need to prudently apply this, noting that it is just postponing a liability, yeah? And some costs may apply, just as we've heard also from the previous panelists. So creditors also, and I'm happy also, I think it's John, or if I'm not wrong, yeah, also said that from the private sector, they are embracing this. So taking into account that creditors will also be comfortable with these clauses, and then the how. But also we've had comfort from the credit rating agencies that this will not be deemed as a restructuring, because usually like when we are even issuing Eurobonds, going into the international capital markets, if in your request for proposal you have any word mentioning restructuring, then that automatically, that when they now rate you for that issuance, it's a downgrade and it's a risk. So taking into account that this will not be deemed as a restructuring, but more of a liability management, and will not lead to a downgrade, because any downgrade leads to higher costs in terms of higher premiums when now you go into the market. So for borrower countries, needs to know about this. So it will be important that the credit rating agencies, they understand. But then again, what was said before, if there are clauses that have been agreed, negotiated within the financing agreements that needs to be invoked. I think it's important. But if it is something that is coming ad hoc, then that will be risky, and that may have a different scenario. So that is my thought. Thank you.
Thank you. That's I think really thoughtful and reflective on what is the specific role of debt pause clauses that can do this. They can be very rapid. They give you the access to humanitarian aid whilst ensuring that you don't have to pull money away from your long-term investments, perhaps from your adaptation or mitigation projects, among other development objectives. And so you don't take away from that economic resilience and long-term economic plan that you might have for your country. But as you say, it's not a long-term solution to debt sustainability, because it's postponing a liability. So I wondered maybe, Geneva, if you could say a bit more about how you see this fitting into wider debt reform or international financial architecture reform, and what you think needs to go with this for the scaling up of the clauses to really work as intended.
I think that as now we're in this kind of momentum where we're seeking international financial architecture reform, and we're looking at that sustainability analyses, creditworthiness, and all of these types of instruments, so that resilience investments, for instance, can be properly valued. We're also coming up with tools. I know at the V20 we have the climate prosperity plans. We're looking at bankable projects to invite investment into countries to support resilience. And so we have a number of fantastic options coming out there. But I think that the IMF and the World Bank, they must update their sustainability analyses to include climate vulnerability as a structural risk. And we need to look at adaptation financing a lot more. Credit rating agencies, we have had a number of them in the room today, and I was heartened to really hear the discussions that came out of that, because I don't think I was ever really in a room with all of them, So I should have gotten some autographs. But they must recognize that adaptation resilience spending as risk reducing. And the need to come into the discussions a little bit more when we're talking about reform. Climate smart debt restructuring, we want to look at that. I asked Sarah earlier if I should mention value in natural assets. I know that the Bahamas entered into an agreement recently. They entered into a partnership with Laconic out of Chicago to more or less value their seagrass so that they could get revenue from that. To what extent can countries, especially climate vulnerable countries, can they benefit and get revenue so that they could become more resilient and they could, gain from what is working for them, which is forests and coral reefs and seagrass and mangroves and all the wonderful things. So for me, as I would have mentioned earlier, it's not a kind of silver bullet. It has to work within an ecosystem of reform that we are pushing. So I think the first place to start will be, again, FFD, fix as well, finance in common, where we signal at the multilateral level, whether through outcome documents, whether through different types of agreements, that here's where we would like to start, and this is the minimum standard, and we want this legislated the same way Barbados has done it, so that we can move forward from there.
That's great, thank you. It's great to have some very clear messages as we go into FFD4. I think we are nearly at the wrapping up point now. So I wanted to ask all of my panelists to give some final reflections as we reach the end of a long and intense but incredibly thought-provoking day. This is, I think you're not the first person I've heard say this is a really unique set of people in this room, and just huge congratulations to Spain and to all the host organizations for managing to convene this particular conversation, which I think has been very lacking and very useful for many of us in the room. And so I wanted to give the panelists an opportunity to kind of sum up what their key ask would be of this particular room and who is here, and particularly as they go into FFD4, in order to make debt clauses work. What would your ask to this room be? And then I'm going to add a supplementary question, if you want to, which is also to share what for you will take away from today's conversation, because it occurs to me that I have one, which is that for the Coalition of Finance Ministers, certainly one of the messages I've heard is that finance ministries need more help and expertise on how to fit together the whole range of tools and strategies there are into a kind of coherent and consistent strategy for disaster risk financing that uses all the available tools. So that's something I will take away to my organization. But perhaps, Monica, you could start with what your ask is, and if you would like to, what your takeaway is as well. Thank you.
Yeah, thank you. My takeaway is that I think it is very important to have the CRDCs in our financing agreements. My ask is that for our creditors to have buy-in to allow this in the financing agreements, just in case that extreme, scenario happens. And happy also that we work along with our credit rating agencies so that the ratings are fair. And for Kenya, we are already transparent in terms of our public debt stock. If you go to the National Treasury website, all the information is there. I'm happy Sonia was here because Kenya also undertakes the survey on sovereign rating under the IIF. And we even did one for 2024. And it has really been an eye-opener for us because it has made us know what, as investor relations, we should do. And for your information, I head the investor relations unit. So working with Mauricio and Sonia, and I also attend those meetings. It's important and very good. So we are very transparent. But for the creditors, that is what I'll repeat. For the creditors, let us work together and get buy-in for countries to benefit from these clauses when need be. Thank you.
For me, it's simple. Debt pause work. I mean, the system works. The clauses work. St. Vincent has shown us, Barbados has shown us that they work. So for me, that's my key takeaway. In terms of my ask, we've been talking standardization, but I just want to put across that one size does not fit all. So whilst we look at standardization, we need to be looking at the different country experiences and perspectives. Thank you.
Thank you.
Well, for me, this is a step. I don't know if, yeah. For me, this is a step for a more resilient international financial system. So be here is an opportunity to learn and identify and try to know other ways that have the countries in developing ways.
Thank you. And Geneva.
Just a few things quickly. Shakira mentioned earlier the need for transparency. She alluded to that. And I think that's important in government reporting, because I think that the only way we could get the right solutions or get a sense of what's going on in the country is if governments report properly. And probably it will lean itself into what you said in terms of capacity building. They may need some help with that, some technical assistance, whatever is needed. Or perhaps for political reasons, some governments decide, here's what, if I just speak a number or two, it might look better for the next election. Whatever the reason is, I think that the reporting part of it would be critical. Standardization, as my colleague said, I think standardization across the board would be important. Harmonization amongst the lenders, the MDBs. I realize that there are some areas of convergence, 2 years, 1 to 2 years deferral, and some, well, most are principal only deferral, and you have to pay the interest and all that. But then there was other areas of divergence. So if there's some kind of harmonization across the board, that would be nice, without, of course, giving them too much undue exposure, because I understand they have to protect their balance sheet. So if there's some kind of harmonization, that would be nice as well. And just understanding that we're going into this not as a kind of fix-all with this, that it's part of a wider toolkit, and we want to ensure the entire system works and see where this fits into that, so that it will be the best possible thing for the next 30 years of our lives.
Great. Brilliant. Well, I hope that is helpful to all of you who will be attending FFD4 and to all of you in the room and the fantastic work that everyone is doing on this really important agenda. So thank you so much to the panelists. Thank you to all of you.
I'd like to take a moment to thank the organizers of the event, the Sustainable Sovereign Debt Hub, including a shout out to Mario and Naj, who will be providing the report of the day for everybody. At CECG, thank you very much, Magali and also Yasmin, who've provided amazing logistical support, particularly to get all of the country representatives in the room. Thank you again to Spain for championing this issue, to Marta and your team, Lucia and Teresa, again for all of your help over the past months. Now it's my pleasure to introduce Inés Carpio, Director General for International Finance at Spain's Ministry for Economy, Trade and Business. Ms. Carpio is responsible for the coordination and representation of Spain in international financing matters, particularly in its relationship with the EU and the IFIs. Her department also manages the external debt of the Spanish state as a creditor nation and the representation of Spain in the Paris Club. So Ms. Carpio will now close us off with some concluding remarks, and thank you again.
So, good evening, and well, so thank you. I want also to start by thanking all the team, all my team, and all the supporting partners for this amazing session, exhausting, but really helpful, I think, in the way to Seville and beyond. Over 6 sessions, a clear message emerged. Contingent resilient debt clauses, or debt pause clauses, have evolved from concept to credible instrument. They can deliver liquidity exactly when a country is hit by an external shock without undermining long-term debt sustainability. They protect both sides of the balance sheet. Debtors gain oxygen to finance emergency response and recovery. Creditors preserve value as borrowers stay on track and avoid default. That is why countries like Grenada, Barbados, or the Bahamas have already adopted these clauses in bonds and loans, and why official bilateral creditors and MDBs are now integrating them into their frameworks. Some concerns have been raised today about potential, or had been raised before about potential credit rating downgrades, but what we heard today from leading rating agencies is encouraging. These clauses reduce the probability of disorderly default by creating predictable, rules-based breathing space. Their activation is objective and transparent, based on verifiable shocks. Far from a penalty, their inclusion is increasingly seen as a mark of prudent debt management. In short, rating agencies confirm that debt pause clauses mitigate risk. They don't create it, and they can actually support a country's credit profile. From a bond market perspective, the case is also strong. Instruments with pause clauses clarify outcomes in a crisis, reducing uncertainty and aiding price discovery. They also attract impact-oriented and ESG investors seeking resilience-linked assets. And as we heard in today's sessions, they can result in tighter spreads or larger order books when well explained to the market. But to scale up their use, we need a common language. A shared understanding of what defines a credible pause clause is essential. We need a simple, credible taxonomy. This taxonomy could clarify technical parameters such as eligible triggers, notice periods, pause duration, and interest treatment. Additionally, it could also support integration into market infrastructure, allowing index providers, ESG platforms, and standard-setting bodies to identify and flag these instruments for the right investors. With such a framework, debt pause clauses could follow the path of collective action clauses, from innovation to widely accepted practice. Today, we also presented the Debt Pause Clause Alliance, a coalition of countries, institutions, and civil society partners committed to advancing the use of well-designed pause clauses in sovereign finance. Ahead of the official launch in Seville, the Alliance will endeavor to advance in 4 fronts. First, include debt pause clauses in direct financing and sovereign debt issuances. Second, work towards standardized terms. Third, expand access, particularly for vulnerable countries, including low-income nations and small island developing states. And fourth, where appropriate, broaden their scope beyond climate shocks to reflect today's wider range of external risks. Spain's goal is to ensure that both the Seville Platform for Action, the so-called SPA, and the outcome of the 4th International Conference on Financing for Development recognize debt pause clauses as key tools for disaster risk mitigation, climate adaptation, and SDG financing. Embedding this recognition at the UN level would bring broad political support and accelerate adoption. Of course, challenges remain. 2 priorities should guide our next steps. First, addressing gaps, especially the absence of pause clauses in export credit agencies' financing, which remains a major share of debt for many developing countries. This will require coordination with regulators and supervisors. Second, we must operationalize a taxonomy and disclosure framework that allows investors, rating agencies, and exchanges to clearly identify resilience-aligned instruments, bringing transparency and channeling capital to where it's most needed. Achieving these goals will take coordination, innovation, and political will. But if today's discussions are any indication, we are well on our way. In closing, let me thank Casa America for hosting us and co-organizers as I started the Climate Emergency Collaboration Group, the Children's Investment Fund Foundation, and the Sustainable Sovereign Debt Hub for the support. And of course, all the team of the Ministry of Economia. And above all, thank you for your engagement. Your contributions today have strengthened this agenda and reflect the spirit of collaboration that Spain believes is essential to tackling these shared risks. Muchas gracias, thank you, and see you in Sevilla.